since COVID-19 pandemic, driven by the inability to spend by the great Indian middle class. Now, considerable amount of geopolitical uncertainty with Trump back in office, also his trade and tariff policies vis-a-vis India. So, like I said, not your usual balance sheet to be put out by the finance minister. The focus will need to be on job creation, on boosting the middle class, and also present a roadmap to revive the economic growth. I'm Sonal Mehrotra Kapoor. You are tuned in to the budget headquarters here at Moneycontrol, and joining me is the Moneycontrol markets editor Mahalakshmi. And over the next few minutes, ML, we are going to be understanding how exactly is the excitement building up even on Dalal Street. We've got lots of guests also lined up.
Absolutely. So, Sonal, the first thing is that, all the time, all these years, we have always said the finance minister has to walk a tightrope walk and balance growth and fiscal deficit. This time, there is this consensus building up that the fiscal path the finance minister will stick to, the 4.5%, which is the big number every time, everybody, the macro, don't change it. That's the consistent consensus message. And that's what I'm worried about. When there is so much consensus that 4.5%, everybody believes she's going to stick to that. Will she stick to that? Second thing is the Prime Minister saying, pointing to the poor and middle class and invoking Lakshmi. Is that a giveaway that there is something coming in terms of tax reliefs? And let me give you just one big number that everybody should know. It's very simple math. If you keep the fiscal deficit target at 4.5%, and if you were to keep everything around the same, the capital expenditure budget at 11.11 crores for next year, essentially you have a headroom of about 30,000 crores that gets released in the budget, which you can
just
give away.
Hold that thought, ML. Very interesting bits, and I loved how you've opened the show by just putting perspective over there. If we can go back to those shots, please. That was the Finance Minister Nirmala Sitharaman going in and reaching the Finance Ministry. And at this point, we are expecting her to go inside, meet with her team, then come out and present that budget tablet. Those are the pictures on your screen. She has just about entered the finance ministry over there. She's going to recoup with the team, then come out, present that budget tablet and make her way to Parliament for the 8th consecutive budget. Lots is riding on this. But, ML, I have a very streets view on this. People watching us want to know only one thing on the day of the budget. What about our taxes? That is the crucial be-all and end-all of this budget. Every year when the budget comes in, we talk about tax cut hona chahiye. Idhar, aam aadmi ko relief milna chahiye. But never before has there been a better case for it. Look at the consumption slowdown, especially in urban India. So it's at 2% of taxpayer who's yearning, really looking at finance minister and saying, give us some relief.
Oh, absolutely. So that's the math I was coming to. So if you keep all things equal, you have a headroom of about 30,000 crores. Practically, you have about 3 crore taxpayers. Mota moti, just divide it. There is 10,000 rupees that everybody can hope to get out of this budget if there is some kind of calibration of taxes. Now, from a stock market perspective, there is another number. Suppose I was talking about that 4.5% fiscal deficit target. Suppose she were to sort of prioritize consumption and prioritize the fact that there is some kind, acknowledge the fact that there is stress at, in two sections of the society, the middle and the poor, and she were to do more. That means the fiscal deficit target will have to be scaled down from 4.5% for next year to say 4.3% or 4.4%.
Right.
Each percentage point is 30,000 crores, roughly. So you have 30,000 crores or 60,000 crores or 90,000 crores, all other things being equal.
All options have been laid out. All the finance minister has to do is listen to those numbers. But enough of us talking. Let me bring in our first guest. Joining us this morning is Manu Bhatia, investor and trader, is joining us at this moment. Good morning, Manu. Thank you so much for joining in. It's unlike any other Saturday where we're not just discussing budget, we're also discussing how the markets are pegged to open. We've seen considerable sort of rocky, mood in or sort of a somber mood in the markets. Today morning, as Nirmala Sitharaman steps out with that budget tablet, what are your big hopes?
So, as you rightly said, past few months have been a bit on the downside on the index, and most of the investors, traders have struggled. So, with the start of this month, there are a lot of expectations that we get some relief on the budget side, which can propel the markets up. On the budget day, generally what we've seen over the last few years is that mostly we get a range-bound volatile movement. So that's what we can expect today as well. Rarely do we see.
Manu, actually, while you say that, I'm just going to give a cue to my producers to pop up the graphic which gives us a good view on how markets have fared over the last 10 years on the day of the budget. And it tells you a very interesting story. ML's team actually put that data together. And ML, any specific highlight that comes out on the day of the budget, what is the market movement generally like?
No, I think we put out the story right in the morning also that over the last 10 years on 6 days the budget actually was bad for the market, so it was in negative territory. But I think what we should focus on asking Manish is, Manish, how is how is the derivative market positioning this morning? Last 4 days we had very strong markets, but before that for 4 months we have been sulking. We have had the steepest correction since 2002. Last 4 months very grueling for markets. At least if you look at the post-pandemic period, we have, people who have tracked markets for 20 years have seen much worse. But tell me, how is the trade setup looking today?
So on the budget day, generally we start off with a high volatility, and what we can expect as the speech goes through towards the end, the volatility to come down. So the trade setup generally on the budget days is to short the volatility in the first half. Shorting volatility can be done via various ways. I mean, we can do a straddle on the index or strangles iron condos and such. So that's the trade in the first half. And if you get something nice, positive on the from the finance minister, then during the second half, it's generally a trending move that can be expected.
In terms of, what could the day end like? Are there any cues? Purely going technically.
Technically, we should end in green is what my charts are saying. It's been a rally in the past 4 days, and I expect this to be a flat to slightly positive kind of a day.
Particular trades or charts that are looking nice to you, good from a momentum perspective?
Sure. So as I said, so on the budget day, it's mostly the short vol trade that goes in, and charts. I mean, it's more like a choppy movement, so it's very difficult to actually catch any good momentum as such. Most of the momentum generally comes after the budget day. So on the budget day, one good strategy is to keep your position size low or not trade. And if someone has to kind of take those trades, then the consensus or the general trade is on the short wall side.
Right. Madhu, just hold on to that. I'm just going to request our producers to bring up live visuals that are coming in from the Finance Ministry. The Finance Minister has just stepped out with the budget tablet in hand, the Bahi Khata as it used to be, now in a tablet in that red envelope along with her team. She's just about making her way to Parliament, and the timeline goes something like this. At this point, we know that she's going to step out and leave for the Parliament at around 9:40. Is when we expect the President House to also be leaving. Those are the visuals coming in at this point from Finance Ministry. At about 9:40, we are expecting the President to make their way, and 10 a.m. again we will see the Finance Minister there in front of Parliament, and 11 o'clock right after the Union Cabinet meeting on budget approval has happened is when we will hear her speech. I'm told we also have other guests joining us. Feroz Aziz is with us, Deputy CEO. Hi, good morning, Feroz. Can we quickly get an understanding from you? We are minutes away from markets opening. If you look at the graph that we've pulled up on the past 10 years, it doesn't really paint a very good picture. So what is your expectation on how the markets will react to this budget, or at least open up?
See, I think if you look at how the market would react, if I break it down into smaller components, of course, we're speaking of really short term probably today. There is more skew towards positive than negative because everybody has gone light. FI has gone light in the index futures, have gone light on the cash market. We've seen a very large selling. Most prop FIs have emptied their stock holding. That's what has happened in January. The index fund FIs have held on. Prop FIs have almost emptied most of the small cap stock they had. So they're going light. FII got almost about 350 crores in small cap funds alone yesterday, which is an algorithm which we track in, because small cap is a great barometer of sentiment on the domestic side. They were a net purchase of individuals in small cap funds yesterday. So that's good news. Third, retail hasn't sold too much because retail doesn't sell their stock at 30% lower unless it's from a margin funding book. So most of the three big players, which is retail and others, HUF and corporates is one big daddy. The second one is DII, and third one is FII. So if I compartmentalize, all of them have gone reasonably light before into the budget. So that's why you would see day before yesterday, FII short futures was 88.9 and 11 was long on 30th of Jan, and that's where you got some degree of short covering yesterday. So we're still above 80. So that's a reasonably good mark to go into an event like this rather than over leverage long positions.
Specific sectors and stocks that you were watching out for today, which ones would those be?
See, I would be watching out for transport, defense and rural development kind of stocks because those are the three big heads of expenditure. If you look at last year in the fiscal, for this fiscal financial year, you look at about 11.61 crores of interest expense. The next three is transport, defense and rural development. They have taken a large chunk of almost about 30%. If that were to increase, then you get some fillip on these stocks, which are government expenditure dependent.
Feroz, you said today should be a positive day, but do you see this as a turning point of some sort? Because last 4 months, it's not been good for the markets. In fact, we lost nearly 17% from top to bottom during this correction. Now, of course, last 4 sessions have been great. Have we put the worst behind for this year? Would you say that? Or does this budget even have the power to do something like that?
I think that yes, it's not a very difficult thing to predict if as long as you break it into smaller segments of the market. If you remember on 4th June when the counting on the election day, I told you that 21,000 is going to be the base of the market. Even when the counting was progressing at 11 a.m. in the morning, that was on a certain 4 parameters which I checked. Their predictive capability is reasonable. At least it tells you what it can't fall to. It can't tell you where it goes, but at least it tells you where the bottom is, where you will not go below that. So if you look at how we are poised, I think the worst is behind us. Now, worst does not imply that markets can't fall 3-4%. Market falls 10% every 9 months in the last 24 years. Now, if you look at the broader market, which has been the biggest party spoiler over the last 1 month in January, where the small cap index is down about 11-12%, that was only because of 7, 8, 10 FIIs who are prop traders who emptied brutally their positions. So on the small cap and the mid cap space, I think the worst is behind us. And when I say worst is behind us, doesn't mean that the index can't slip by 1%. Worst is behind us, by which I mean 3-4%, 5% moves, short-term moves are always possible. But knife, free fall kind of catching the knife kind of falls, you will not get.
All right, Feroz, markets have just opened. I'm going to request the producers to put up or go full screen on those numbers coming in. Markets have opened up this morning on a relatively positive note. I'm just going to cut across to Nandita as well to give us more details on how exactly it's faring. At the moment, we see BSE up about 17 points. Also, at this moment, we are seeing numbers sort of come in. And markets have opened up. Kotak Mahindra is up over there. More numbers trickling in. while we bring those numbers out, let me go back to Feroz and also Manu with us. Manu, any particular stock sector that you're watching out for?
Not really. So on the budget day, it's best to kind of not take too many bets, and only post the budget is when we get more clarity as to what are the sectors and stocks that will benefit. So that's not something that I'm looking at right now.
Feroz, for you, FMCG, is that a space, consumption, that could actually be a driver?
Yes, I think depends on how long you want to play these sectors for. I think consumption as a sector is surely going to be one of the sectors, because the government is again going to focus on more money left in people's bank accounts rather than deciding for themselves in terms of kahan paise dalne hain. The government has always taken the route of forcing people towards debt investments to fund the fiscal deficit. I think we're reasonably comfortable, especially with the foreign guys funding our debt side. I would say consumption is a theme which will play out in the next 2-3 years of this Modi government 3.0. So that's one thing I would definitely look out for, because the new tax method of computation of personal income tax leaves a lot of money in hand. And I think if there is going to be more impetus to that, consumption is one thing, both on the rural and the urban side, should get a push. And in turn, any consumption-driven stock for a structural re-rating is a great possibility.
All right, we're also getting in live visuals at the moment, I'm told, from Finance Ministry. While we continue to look at them, let me also just cut across very quickly to Nandita to give you an overview. So those are the pictures on your screens. Finance Minister there on her way to present the first full-term budget for her, the 8th consecutive one as well, with her entire team, and flaunting that Bahi Katha turned into an iPad, making her way to the Parliament. So that's Finance Minister coming in. Nandita, while we look at these pictures and markets are also opening up this Saturday morning, what are the big sectors to look for?
Hi Sunal, it's a working Saturday across the board, of course, and markets, of course. Second time that the budget is really being presented on a Saturday, full trading day, and we've started the day on a positive note, mildly positive, so to say. But remember, yesterday we had a very strong rally coming in. In fact, over the last 1 week, Friday to Friday, we've seen the Nifty rallying to almost 2%. And mind you, that comes after a prolonged period of correction since that started in October. But of course, today, 5th straight day of gains coming in. We are looking at the Nifty up somewhere on 14 points or thereabouts. So we are holding on to that 23,500 mark at the start. The Sensex as well, 77,577 on the screen right now. But let's take a look at the sectors that are taking the lead right now, because important to watch out will be the capex related stocks, the consumption stocks that have been under pressure in the wake of the urban consumption slowdown. So looking at that, the FMCG pack is trading with caution right now. In fact, that's among the sectors which aren't doing all that well at the current juncture. Trading in the negative zone, almost 0.2% kind of a drop coming in on the FMCG pack. Look at the auto pack, that's holding on right now. The Nifty Bank Index is extremely flat. Look at the IT pack, even that's extremely flat. So right now, early days to really say which way the market will move, because of course after the FM speech or during the FM speech, we may see some volatile spikes in the market, which typically happens on a budget day. But in terms of what's doing well on the index, IndusInd Bank, that's the top Nifty gainer at the current juncture, reported numbers yesterday reacting to that. Some pharma names are doing well. So you have Sun Pharma, you have Bharat Electronics, NTPC, Adani Enterprises, Trent, Apollo Hospital. These are some of the gainers on the index. What's not doing well, are some of the auto names, as I mentioned, auto holding out, but Hero MotoCorp, that's the top laggard. Some oil and gas names are not doing well. OMCs will be watched out for, given the fact that, if there is any kind of LPG subsidy announcement or not, that's something that is something that of course will keep oil marketing companies like ONGC, I beg your pardon, IOC, HPCL and BPCL in focus. So right now they are trading with losses. Let's see if there are any announcements to that effect. Aside of that, among the losers, you have Maruti Suzuki. Tata Consumer, that had a good reaction to results, is under pressure right now. And aside of that, if you look at, I want to just pull up some of the railway stocks as to how they are doing. Because we did a story that there could be an 18 to 20% kind of a increase in railway expenditure. So, want to see how stocks like BEL, RVNL are faring right now. Also, stocks like L&T should be in focus, in the wake of the government's capex announcement as well. What kind of an uptick we'll see in the government capex that really had slowed down in the first half. That's expected to pick up. So stocks like L&T should be in focus. But right now, as I had pointed out, BPCL, Tata Consumer, Wipro, these are the top laggards. Sectorally, most of them are trading in the green, but FMCG pack is in the red, and so is the oil and gas basket. So that's the that's the really scene with the markets right now. But let's see how things really progress, because early days to really say which way we'll head. But once the FM speech starts, we'll really know how things really pan out. But with that, I think Sonal, back to you.
I can just sort of hold on to you for one more minute and talk about one particular stock that has got everybody's attention, ITC. It seems to me one that is a major giveaway on how the markets will actually react. Also, FMCG sector on the whole being in such focus. If you could take us through how that's doing this morning.
So ITC, that stock, the most important stock, if you ask me really from a taxation perspective, there hasn't really been an excise duty hike on cigarette for the last 3 years. So this time around there is chatter that there could be a hike, and if it is in excess of 10%, that will be viewed as a negative by the street. So right now ITC is trading up by 2.5%, but which way it moves, of course, will really depend on how things pan out in terms of cigarette taxation.
All right. Thank you so much, Sandita, for joining us. We've got other guests also coming in. Rohit Srivastava joining us. Good morning, Mr. Srivastav, and welcome to Moneycontrol. Big day, big Saturday. Markets have had sort of what do we call it? Is it a volatile start, ML, or what?
No, it's a flat start.
It's a flat start. It's a flat start there in for the markets. Rohit, your first observations today.
Yeah, I think the markets already rallied a bit on anticipation that things might not be so bad, or there could be some positives out of this because the government would want to get the markets, perked up again. So that hope is definitely alive. How big will it turn out to be? That we will only come to know later. But surely it can be sector specific rather than broad based. So there could be. It's more about how they allocate money to different areas that will be in focus. Not sure, given the fiscal deficit targets, whether you can have something broad based for the market. But in any case, the markets were very, very oversold. So there was a good reason for them to try and make some comeback. What the budget can do is only further fuel that on the upside. Let's see if that happens.
One is looking at railways, one is looking at infrastructure, one is looking at FMCG.
Yeah, that's I think the focus area, because anything happens on income taxes for the public at large, the middle class, it directly reflects on your consumption side stocks, and I think FMCG was the first sector to really top out and fall from September onwards. And in that sense, if I actually look at the 1 month relative performance, FMCG is holding out the best also, because it fell first and now it's sort of basing out, and any kind of positive can sort of flip it further to the upside. So I do think there is a case for FMCG stocks to actually do well. Pre or already done a bit well, I think, yesterday, and post budget also we could get triggers for it to continue for a while. So that's, I think, one key area, consumption, which can drive up consumer stocks from here a little further as well, because of both the technical condition and possibly what may come out of the budget on the consumption side.
Rohit, you have been a bit of a contrarian over the last 2 years. Every time the market's selling, you say that the bottom could be near, and every time the market's rallying, you think you take a opposite call. Right now, for 4 months, we have sold off a lot. For 4 days, we have sort of come back. Have we put the worst behind for this year? Do you see this as a turning point? Which sectors and stocks? Sonal asked about FMCG, but all the stocks that have seen deep cuts over the last 4 months, infrastructure pack, which is also essentially done well only on the back of public spending. Do you see a reversal there?
When you're speaking about the markets, you can use the screen.
Yeah, the thing is, earlier I didn't
government spending has been the main driver of growth. And the hope is that that spending continues. Now, while it may continue, the pace of growth on spending has definitely slowed down. If you look at the capex expansion that the government was doing, it was 30% 2 years ago, it dropped to 10% last year. Will they maintain the same pace this year, or will they further drop it, remains a question, because they have a bigger a target to bring down the fiscal deficit. And this is what even the US is doing, right? With the installation of DOGE, which is the Department of Government Expenditure, they're also looking at cutting back, broad expenditure. So this raises a question on the infrastructure side. How can you have the same pace of growth that these companies were showing, or do their valuations need to correct? So coming back to your main question, we've been 4 months down. This is the longest losing streak since I think 9/11, 2001. It's a very long time, almost 14-15 years since we've seen such a big long losing streak in the market. And it's hard to say that the worst is behind. Of course, 9/11, that was the last event after which the worst was behind. But that was after a 18-month bear market that had happened. This one has happened right from an all-time high. And which is why it starts to feel like, is it the beginning of something longer in terms of consolidation for the markets from the run that they were having for, the last 4 to 5 years. And that's what we've sort of started to mentally prepare for. So we do have a bottom. It may not be a long-term bottom. It may be more medium-term, which means the markets can go up over the next 1 month. Maybe the budget provides some steam for that to happen. But it may not be enough to go back to an all-time high and keep running away the way it was doing last year. So that is the sense that there may be some upside, but it may not be back to new highs.
Also bring in our next guest, Ruchit Jain. He's Vice President, Technical Research, Motilal Oswal Financial Services is with us. Good morning, Ruchit. Do you have a slightly more optimistic view at the moment? And if I can just start by asking you your top 3 sectors and top 3 stocks that you're watching out this morning.
Yeah, hi, very, very good morning, Nandira. Very good morning to everyone. Well, we believe that market, since it has retraced the 38.2%, retraced by 38.2% of this recent correction of last 3 or 4 months. So I think it's time to get a bit cautious from here on, unless we see a closing again happening above the 23,600, 650, which is the 200 EMA. No, we believe that the volatility would be there, and we are now near that resistance end. So taking, going on the budget with a very neutral view, I would say, and until we see a closing about 23,650, which is the 200 EMA, I think one needs to be very cautious and stock specific over here. And amongst the sectors, I think couple of sectors which are looking positive from here on, which is one is Nifty FMCG, because after this recent corrective phase, there is clearly a positive divergence with RSI, where the prices on the FMCG index have found lower lows, but RSI has been forming higher lows. So I think FMCG will be one space that we watch out for. Stock specific amongst the FMCG stocks, if we see, then stocks such as Britannia, Dabur, HUL, which have already seen a price-wise corrective phase over last few months, are witnessing a bounce back from their oversold territory. So FMCG is one basket which we are looking to trade with a positive bias. And breakouts in certain chemical stocks have been seen in this week. Stocks such as SRF is there, or Navin Fluorine is there, where if you look at the price volume action, then it has been supported by very high volume. So I think here also the downside now seems to be very limited, and in case of any kind of dips in both these stocks, SRF and Navin Fluorine, one should look for buying opportunities there too.
Emil.
Sorry, who?
Emil, you have Ruchit Jain.
Ruchit, how do you see the infrastructure pack doing today? Ruchit?
Okay, let me bring in Rohit Srivastava also with us. Rohit Srivastava, if I can take that question to you very quickly and understand on specifically on infrastructure.
Is somewhere in question, especially the capex spending that was sort of driving the infrastructure area. It doesn't mean that growth is not going to be there, but the pace at which we were seeing capex grow, say 2 years ago at 30%, now it's slowing down to a 10%, is definitely going to impact the valuations that we are giving to infra stocks in anticipation that growth would be much higher. So that is one thing that's going to affect us now. it's definitely possible they do something different. I mean, it's us thinking that, oh, they've slowed it down last year, they will continue to remain slow. If they do push up the rate of expenditure on capex, then that could definitely have a positive rub-off on, infra and capital good stocks. And that's going to be one of the watching points. Another one that can have an indirect positive effect is if they do something on the FDI front, because that's fallen significantly as a percentage of GDP, and it has been impacting our currency also in a big way, because if you have positive currency flows either from FDI, then you can offset some of the negativity from the FII side. So there are different angles from which you can see a positive rub-off on infra as well, which we'll have to watch out for. But yeah, hard to say whether there's a big impact or a small impact. Depends a lot on how they allocate funds.
Rohit, what do you think of banks? Because that is one area where a lot of fund managers, institutional investors are positive on, and everybody thinks that it is reasonably valued, and usually budgets have something or the other, some implication or the other for banks. How do you see them on the charts?
So at least the private sector banks have been well placed. You're right that when we actually look at the long-term valuation charts, even on our strike valuation setups, they were at the lowest levels in years when HDFC Bank was at the bottom end. Now, of course, it has broken out to a new all-time high and then pulled back a bit. But that has set the positive momentum in favor of some of the most beaten down financial stocks. So definitely there's a case there. But for that momentum to continue, we really need to see credit growth pick up, and that's where the private sector spending or private sector expenditure has to really be seen. So far, again, it takes us back to the first argument that we've been so dependent on government spending for growth that it has really not shifted towards private sector. That's what we are all waiting for. That when does that happen? One of the triggers for that could be interest rates. Of course, it takes a while for that to percolate down. And the government's focus on fiscal deficits can indirectly make it easier for the RBI to cut interest rates. So that's now very indirect angle to get into the banking thing. So if you maintain fiscal deficits, you have a case for lower interest rates and credit growth. Banks end up doing well. So there is a very indirect case where banks actually are well positioned, and because the valuations are there, I think that argument will remain for fund managers to allocate, because even if you have a weak market overall, you want to play defensive, and in that sense you'd end up wanting to own banking stocks.
Rohit Srivastava, thank you so much for joining us this morning on Moneycontrol on the day of the budget, and wish you a very happy budget day, and hope to see you again in the afternoon to get an understanding of how this is panning out. For everybody just tuning in, let me do a quick recap for all our viewers. Sensex Nifty have erased opening games. They're trading flat at this point. Defense, railway stocks in focus ahead of the budget. That's the other headline that we are panning. Also looking at Sun Pharma, Bharat Electronics, Ultratech Cement, Adani Ports, Industrial Band, all amongst major gainers for Nifty this morning, while losers are Hero Motocorp, ONGC, Dr. Reddy Labs, Trent and Gresham Industries. BSE mid cap and small cap indices are up 0.5% each. That's the lay of the land at this point at 11:34 this morning. Like I said, we are just about roughly an hour and a half away from hearing in from the finance minister. Those are the live numbers. Let's also go back to our guests now. Ruchit, can I pick you up on what Rohit was also saying on FDI investments, one of the key sectors, if that's the focus where the government really wants to bring in, where do you think this is actually going to go? Okay, can I take that question to Feroz, please? Feroz, yeah. Go.
There's some issue with the audio. If we can go again, it'll be great.
Okay, I was just trying to understand from you on the issue that Rohit Srivastava raised on how FDI is going to be in focus. If that's your lens, then which sectors are you really looking at?
I think FDI is definitely something which will definitely give impetus to several sectors. If the government is putting in money in the top three, defense, transport and rural development, and then comes education. So education is one space where FDI has not seen any investment. These are the four top expenditures of the government. FDI push in these sectors will give some degree of complementary nature to the government expenditure. If government is spending 32-33% on these four things which I mentioned, out of the 48 lakh crores, some degree of push from the FDI side makes sure that this there could be economies of scale into this sector. I'd say these four sectors is where FDIs luring FDIs would make so much more sense. Will that happen? I don't know. I think I would just be second guessing, Ruchit.
All right.
Firoz, where do you see, where are you putting your money for today, for the next 1 month?
See, I'm a largely mutual fund investor, but I think from a sector specific, I would say automobile and banking are the two sectors which most of the fund managers skewed their portfolios to, and rightly so, because banking is one sector which is available cheap. Because of the flat yield curve of India, I think any kind of a rate correction, any kind of economic boost, actually banking is a reasonable proxy. I think any sentiment booster will definitely create a large move in the banking space, especially because 27% of Nifty is banking. Any influx of money, and if FIIs reverse their positions, banking will be the largest beneficiary. So banking and automobile are the two sectors where I would expect my fund managers to skew, and I would like to skew it if I was to be buying a sector fund.
Firoz, one last question from me. What is the sentiment amongst all these, high net worth individuals? Because all this while post-pandemic, every time we've spoken, every small correction has been bought by them, right? The sentiment decisively has changed over the last 4 months. That is why we had a steeper correction this time. Do you see at this point people coming back to markets? Are they waiting for a larger correction to buy? What is the sentiment like?
I think, see, over the last, from 27th September, when the market peaked on Nifty, where FII long positions had gone to almost about 80.1%, which was one of the other breaches it did 12 times over the last 2.5 years. But after that, of course, there's been a lot of long position unwinding of the index futures of FIIs. Now coming to HNI sentiment, I don't think it has gone dampened, because if you look at 41,000 crores of influx of net sale of mutual funds, which is a reasonable barometer both on the retail side and the HNI side, has been robust. It's been the best quarter, which has been the last quarter from an inflow in the mutual fund space. Now comes the second part, is FIIs, HNIs have a large game in the AIF category 3, which is long only, and PMS. If you look at these two categories, PMS has taken a little dampened hue after the budget of 23rd July 2024. So coming back to your point, I think the HNI sentiment surprisingly is intact, because markets have not shown 5% fall on a single day over the last 5 days, because of one specific circular, which I love that circular. I thank the Lord every time I go to sleep, and I thank SEBI for having kept that circular alive, which is called the Net Short Circular, which was released 1 day before the lockdown. That is alive. That makes sure that we are, as a country, far more investors market than a speculators market. There are very few countries which limit the short position in equity markets, and India limits it to 500 crores of notional, which is not a large amount. 2-3 lakhs, if you want to buy a 1 rupee put option, you will max out a 500 crore limit. So that's why you would see that sharp falls are not happening. Gradual falls on a daily basis can still happen, from 26,213 to 23,508 as we speak. But these sharp falls, which used to happen in the past and still happen in S&P 500 and Nasdaq, don't happen in Nifty. This is what something I think investors are not taking note of, and thanking the Lord enough and the regulator to protect them against these speculators who sit on global on offshore waters. And they short some many market where they think they have to bring it down. That's not happening in India, and that's one thing I think we should all, as stakeholders, take note.
That point on net, whether Firoz, the point on whether short position should be limited or not is debatable, and that we should do some other day. But the pointed question I'm asking is, the SIP flows are a given. It's 40,000 crores a month, and it's, that's not something we are questioning. What I'm asking you is the discretionary flows, whether it comes through AIFs or through mutual funds, or even through direct equities. the money that family offices put in, that money, what is the sentiment amongst those investors, because those are the clients you deal with day in and day out?
Yes, see, I'll tell you, if you look at, and 41,000 is not the SIP number, it's the net flow number for the full quarter. So 26,000 crores is the SIP number. If you look at 1 lakh plus SIPs, which form 75% as per a sample study which we did, have also continued. Now coming to direct equity, if you look at where is the money coming from, I think there is some degree of sentiment dampened, especially in the broader market. But I don't see flows going out because debt is not giving you the capital appreciation which people have been talking about. So to answer your pointed question, if there was a scale of 1 to 10, 10 being the most excited HNI community, I would say 6.5, 7 is where we currently stand.
Leave it there for the moment. Thank you so much for joining us. We also have Vaishali Parekh standing by. Vaishali, thank you for being so patient. We're just getting some visuals from the Parliament this time around, I'm told, of the Finance Minister. There you go. That is the Finance Minister walking into the corridors of Parliament as she goes in to present the 8th consecutive budget for India. She's walking in there with her team. Now, what does the protocol say at this point, and what are we really expecting? It's about 9:40 right now, just around the time when she's going to get there. We will have the President House also being given a copy of the budget at this point. Once that is received, that is the cue for the Finance Minister to actually take it to the Union Cabinet. Once the Union Cabinet then sits on it, it's a short meeting that they sit on the budget, and then it is taken to the Parliament where she will be tabling it. 11 a.m. is when we are expecting that speech to happen. At this point, we are seeing a rather flat opening to the market. But as we look at those visuals, more guests are with us. Vaishali Parekh also with us. Vaishali, your first thoughts on what you're expecting today to be?
Very good morning. So yes, market shows a lot of optimism right now. We are seeing good momentum as usual in defense, power, infra. So I guess right now these are the budget-friendly stocks that one should be focusing on.
I'll go to you, Nitin. Nitin, we spoke about the capex math when we spoke last time. I think the elaborate interview we did. What is your expectation? What are you seeing in this budget? We've already seen quite some scale down in core areas last year in terms of capex. Do you see that reversing, considering that we have competing demands from the consumption side this time?
Good morning. I think that there's no doubt that after a sort of a muted capex growth in FY25, government will announce anything between 12 to 15% increase in capex. But what we would like to see is more allocation to core capex, which has a high multiplier effect in terms of jobs, be in terms of competitiveness of Indian industry like railways and roads, infrastructure. I would actually expect a 12 to 15% growth, given last year FY25 was a low base.
What is the number you're looking at, Nitin? So most people are expecting that this year we will close at 10 lakh crore, and at 10% over that will take us to 11.1 lakh crore, which will look like growth, but it will be no growth over the budgeted figures of last year. Do you expect that to be the number to be better?
I just use about a minute to actually give a longer term perspective over here. And if you look at the last 4 or 5 years, the real change in the budget has been how off-budget expenditure was brought into on-budget expenditure. So prior to COVID to today, perhaps we are very closer to 4.5 to 4.8% of GDP. Last year, we were thinking closer to about 11.1 trillion rupees of capex. We'll get closer to about 9.7 to 10. The core capex will hold up at about 5 or 6%. So I would actually be in the same camp that closer to 11 to 11.5 is the number. 11.5 trillion is that what they will announce. But what I would like to see is most of that allocation, unlike last year, which was about 15% in non-core capex, to go into most of it to core capex.
Okay. The other question is, so does that, from a stock perspective, how do you see the market reacting? If it were 11.11 lakh, would that excite the market? Will it be a muted reaction? Can it trigger at least a short-term rally?
Clearly, you've seen the order inflow needs for most of the infrastructure companies or capital goods companies would rise if they were to allocate closer to about 11.5 trillion, and large part of that in the core capex. Clearly, roads and railways would stand out, and some of the railway companies, smaller ones, in the last 1.5 year have been complaining, or let's say explaining, that the inflows have been sort of muted. We need more. So I think roads and railways will make a lot of announcements today. So perhaps stocks could react as they do all the time around announcements. But urban infrastructure is equally important, not only the grand infra, but urban infra. So I hope roads and railway companies would take that in a positive manner, and perhaps the markets also for their stocks.
I have a couple of more questions for you, but I'll come back to you. We have Rajiv Radhakrishnan, CIO Fixed Income from SBI Mutual Fund joining us. Good morning, Rajiv. Rajiv?
Yeah, good morning. Can you hear me?
Good morning. Tell us your budget math. You think she will stick to the 4.5% deficit? What does it mean for bond markets?
Yeah, I think given the stated fiscal consolidation trajectory, and the government in the past has clearly adhered to that path of fiscal consolidation. So we do expect that FY25 would be possibly slightly lower than 490, and the coming financial year, the government should be able to budget a fiscal deficit target of 4.5. Now, from a bond market perspective, since the fiscal deficit trajectory is broadly, I think the market really expects no shock there. But I think what is important eventually is the net and the gross, or rather the gross at this point. I think the net borrowing number would broadly be along similar lines as in this financial year, but we need to see how the gross borrowing numbers come out, because we need to understand that when you look at the way the government debt or the redemptions are there over the next few years, I think the coming year is close to 3.95 trillion of maturing bonds, and it just steps up over the next couple of years. So I think there is merit in sort of trying to smoothen out the redemption pattern by possibly budgeting a bit of buybacks. So possibly that the gross number could be closer to 14 and a half, 15. I think the market is possibly looking at around 14, little bit higher than that possibly should not be a big issue. But I think the key takeaway for the market is, or the market would look at in terms of the fiscal number, is clearly the gross number. And what is the trajectory for the as you go forward, because after 4.5 we don't really have a visible consolidation trajectory that has been enunciated by the government so far. At the same time, in the last budget, they did mention about targeting public debt to GDP, targeting it around 60. But I think a roadmap to that, if possible, is something that possibly will be important from a slightly longer term market dynamic perspective. So, yeah.
Rajiv, if I can sort of come in and ask you and have a retail investor's lens for a minute. They've been rather edgy, sitting trying to understand what exactly is happening. For all your managers at the moment, I'm sure you had a morning call before the budget. What was the big message there? What have you told them? And what is your advice or perhaps guidance to the retail investor this morning?
In fact, for the retail investor, I think, I'll just go back to, one section that I saw in the economic survey yesterday. I think the economic survey did mention about reducing the entry barriers for corporate bond markets. I guess, we've seen, if I ask from a retail investor perspective, we know that over the last couple of years, the taxation has completely turned adverse and very punitive, if I were to say, for fixed income investments. So I think some sort of relook approach on how you enable retail investors to come into debt mutual funds. I think that is something that is very, very essential. My sense is you cannot necessarily equate a market-linked product with assured return products and have the same taxation. So I think that is clearly an enabler, and I think it clearly gels in with the perspective given in the economic survey of trying to reduce the entry barriers into corporate debt markets. I think it's a very well accepted requirement even from policy circles to improve or enable development of corporate bond markets. So unless you sort of incentivize the demand in terms of, unless retail investors are incentivized to invest in the market, clearly, through I think debt funds do provide that enablement for retail investors. So I think this is something that is very, very essential, an enabler to incentivize retail to come into debt, and at the same time it will address the entry barrier issue that the economic survey flagged out. So I think that is something that would be keenly watched.
Rajiv, another question for you. If the market were to, if the finance minister were to go a little loose on the fiscal deficit number and it comes in at, let's say, 4.6 or 4.7, do you think the market will rebel it?
No, I think the market will take it as a slight negative, because as I said, 4.5 is there in the price. A net borrowing of something like 11.2, plus minus, is clearly there in the price. So if you are looking at 470, which effectively means that possibly the net and even the gross possibly would be on the higher side, it will be a short-term negative for the market, clearly. But I don't think, I think the general, consensus or the expectation is that you will see around 4.5.
I see. Trideep Bhattacharya is also with us. But before I go to him, Rajiv, can I talk to you about the 3 T's which have been shaking up the mind of the retail investor? It's tax, tariff and Trump. These 3 T's have really been the focus of how everybody is thinking, perhaps what will be on the mind of the finance ministry folks as well. Your quick comments, and then I will go to Trideep. Okay, yes. Rajiv, we couldn't get that. Trideep, if you could hear that question, I'm trying to decode the 3 T's for the market this morning. Tax, tariff and Trump. How are you seeing that play out?
I think these 3 that you talk about are unknowables at the point in time. It's very difficult to kind of, with a budget in an hour's time. All of these structurally would be, whichever direction it goes, would be negative for broadly equity markets. Certainly tariffs overall, though the second order impact, how does India figure relative to other markets, or India would stand to relatively gain, could be positive, but prima facie, lower global trade would be negative for markets in general. Taxes, if there is a rebate that comes through, certainly would benefit. But we will see how much they want to get off the fiscal deficit lowering trajectory to promote taxation if they have to. I think the key moot point of the budget that we see in front of us is basically the balance between capex and opex, which is how much do they spend on capex and how much do they spend on consumption, which is the taxes and all these things put together. That's the balance that I think the markets would be really watching out for. If it is more towards capex, my sense is the markets would treat this as a continuity, and broadly the markets would be fine with it. But if it is more towards populist measures, more towards things that lead to immediate consumption but doesn't add value over a period of time, then I think markets might take a dim view of this. So that's broadly how I look at it.
Interesting.
Trideep, this year earnings growth has obviously slowed down, and for FY25 we are expecting not more than a 5% growth in earnings. This will be the slowest in the last 4 years post-pandemic. Next year, the consensus estimate is 12% earnings growth. Do you think this budget will set the conditions for a 12% earnings growth? Because otherwise most people I talk to say that number will have to be pared down. What's your view?
Yeah, my sense is that next year earnings growth is likely to be somewhere between 10 to 15%. So, a little bit here and there, but broadly speaking, after a lost year of earnings, which is FY25, I have a dimmer view of FY25 and maybe a slightly more optimistic view of FY26 as compared to what you just said. My sense is by the time we sort of get to end of FY25, we'll call it a lost year of earnings, where courtesy not only government, lack of spending, but also globally, as different governments changeover happened in different countries, hardly any work got done on the economic front, and that's the reason I think you have seen actually not just earnings cut in India, but also earnings cut globally. Earnings cut in India has been to the tune of about 10%, which is why you've seen a bit of wobbliness in the market. My sense is by the time we get to March, April, May, this macro sort of uncertainty which has been lingering around for a year and a half with regards to which government, what policies and how much spend will all be out of the way. And I think that in itself is a good sign for earnings to start kicking in. So based on the comments that you made, I would be slightly more negative on the near term FY25 earnings and slightly more positive on FY26 earnings.
Interesting.
Is that some kind of a cognitive bias, Tridip? Because you're a lucky man if you're optimistic, and you're more optimistic about the future, and you're saying you have a dimmer view of the present.
The dimmer view of the present is more driven by what I see in the earnings season that went by, I think on net balance, this earnings season would probably lead to about 1.5% earnings cut. So that 5% number that you talked about is probably by the time we hit the end of this result season, which is by February 15th, might actually be less than 5. And hence I think that, and from the announcements that have come by, it doesn't look like that March quarter would be a particularly great one either. So that's why I said FY25 would be kind of, pretty much a lost year of earnings. Now in FY26 though, the positive impact of rural economy, rural recovery coming back, some stops, if they talk about in the budget on the consumption, would lead to a slightly better consumption scenario, which has been lagging overall in FY25. And I think the other delta is on the government capex side. We talked about 11.5 last February. We will probably end up somewhere between 9 to 10 lakh crore. So we undershot the budget by almost about 15%. Next year, my sense is with no regional elections in the way and the government in power, you would see the spend growth-wise better than what we have seen in the past versus actual spending. So my sense is government spend will also come back in some shape or form. That kind of underlines my relative more bullishness on FY26 and the recent earnings season, a little more dimmer view on the present.
Can I just get a quick word from Rajiv as well? Rajiv, before we quickly go into a break, what is the one thing, one announcement from the finance minister that you think will make the markets happy today? Not 1, 2, 3, just one thing that you think could really rally the market.
Growth to revive, at least some tax breaks or tax support for the middle class, which has been, I think, speculated of late. I think that should be I would say, a positive at the margin.
Tridip, your view quickly. One thing that you think will make markets happy?
Would be something which I think the markets and all of us are looking to see the continuity of policy and less of populism. Because the multiplier effect of infrastructure is a lot higher than some of the populist measures.
I see. Vaishali, same question. All right. Rajiv, Radhakrishnan, Tridip, Bhattacharya, thank you so much for joining us. Just a quick update on what's happening. The finance minister has reached the president's house. She's going to be presenting the budget there first. Then she makes her way to the parliament where she will be going in for a quick cabinet meeting. It's a short one and we are just about an hour away from hearing budget 2025. Those are the visuals from just a few moments ago while she was leaving the finance ministry. We're going to slip into a quick break where we bring you how corporate India is actually looking out for the budget. What are the big expectations there? Watch out for that. Coverage continues right here on Moneycontrol.
Doesn't want to burden the government with so many priorities that they already have to give any tax incentives or SOPs, but what we would probably, I think, encourage or request is a dialogue to relax certain price controls that are there on vaccines. Today you've got all our industries flourishing, the financial sector, auto sector, IT sector, where, every company is making a few $billion in profits, but, it's unfortunate that the vaccine industry, which is a very critical industry, all the companies, my company included, combined, doesn't even make $1 billion in profits every year. Now, why is this important and relevant? Whilst we want to keep healthcare very affordable, we don't want to have people paying very high prices, we want it reasonable. So what do I mean by that? If reasonable profits are made in this industry, then we can develop and innovate and make our own vaccines and our own molecules and technology. Today, we're still dependent on the partnership model with foreign entities. You saw that in COVID times, you saw it even today with chikungunya, we've partnered with Valneva, very good company abroad. Dengue, similar thing. So, if we have the kind of capital that, pharmaceutical players all over the world have, then, we can further bolster innovation and development in R&D in our country, and the government understands that, and we have to work towards, finding the balance there in the policies to do that. I think if we do that, you'll see even this industry becoming large, like, the IT sector, auto sector, and all of that, and that's really what I would pray and hope for over the next 5.
I think we need something that really spurs investment. I think capital formation is not at the level that you need to grow this economy at 7-8%, and that has to happen. So the budget has to create all these PLIs for batteries and semiconductors, they will show results 10 years from now. Okay, we need something that spurs the economy in 3 months and 6 months, not 10 years from now.
Great.
And for those products, largely the machines are all imported, the capex is all imported. So we need something that is going to put capex in the ground in India.
One quarter's data is hard to interpret. Some of us, I included, have been saying that there is an issue we need to deal with which has been building up over the last few years. If you think about the last year before the pandemic, our growth was 4.5%. And through the pandemic, we had some terrible quarters, and then we had a strong revival. What is hard to tell is how much of the strong revival was because of the terrible downturn. And I would say that to some extent, the underlying issue is how do we get strong sustainable demand? And strong sustainable demand comes from, confident people. We have confidence at the upper end, the upper middle class, the people who are employed in Bangalore and Chennai, they're confident. It's the lower middle class which has been a little more hesitant because of the job situation. And that's why it's imperative for every state to expand jobs wherever it can, to whatever extent it can. And that's sort of going to be both beneficial for just more investment, more production, more growth, but it also gives more confidence for consumption. And I think the weakness has been displayed initially, we've seen weak lower-end consumption, it's strengthened a little bit, but upper-end consumption has weakened in the last data. Broadly speaking, we need to build more confidence in consumption, which ultimately means jobs. That's a single mantra. You saw that in the elections, you see it in every election. And we can't get away from the fact that India needs to employ its young people. That's a talent pool we have, which is an opportunity for all the companies that are thinking of investing in India. But it's also a challenge we have of making those people employable for the companies coming in, which is why schemes like Nan Mudalvan are important, because they bridge that skill gap. See, the macroeconomic fundamentals of India are very strong. Yes, we have had some headwinds on growth over the last 6 months relating to consumption. I think the reasons for that are known. I mean, it's whether it was the elections, whether it was the seasonalities, and also in some industries, global disruptions that happened principally because of in one of the countries the capacity that they had created and for some of the products was disproportionate to the demand, and therefore that impacted global commodity pricing or global pricing, and that had an impact. So those things are well known. I think budget should be seen as a good opportunity to find a way that they can unleash more positive energy in the business community as well on the consumption side. And I think it's a tightrope to walk, because India is very focused on, and rightly so, on ensuring that the macroeconomic trend line is followed. So the fiscal deficit light path that we are on, I think that should continue. So the government will really have to look at innovative ways in which they can raise capital. I think it's all known. I think the measures are known. If they can execute on that and use that money as they've done in the past to spend more on the capex side, also give some relief especially to the urban lower income, middle income side. I mean, on the rural side also it's required, but definitely it's given the impact that inflation has had and everything. If they can find some relief to be given, mainly through income tax, personal income tax rates and everything, if that can happen, and I think as what we have seen, what the US is doing right now, and I think it's going to be increasingly a trend around the world, is how do we push ease of doing business and regulation so that organizations that want to grow can accelerate their growth path. Right now, because even if organizations are looking at capex spend, I think the time it takes to get all the approvals and the time it takes to the speed gets delayed. Obviously, there are challenges on skilling and everything else that have to be addressed. So I would say that if the focus on capex focus, looking at consumption, easing up things, deregulating a bit more, trying to see how we create energy through disinvestments, and
Welcome back. You're watching our special budget coverage right here on Moneycontrol. Just about an hour left for the finance minister to present her budget. The markets, of course, have opened on a fairly flat note, but my colleague Nandita is standing by with the latest. Over to you, Nandita.
And Shweta, of course, you rightly pointed out markets have started on a flattish note, although we'll take heart from the fact that it's in the positive zone, and we are holding above that 23,550 mark, crucial level, because most of the experts are pointing out that 23,500 on the upside is a crucial level, and if we keep closing above this level for consecutive sessions, who knows, we could look at moving towards 23,700 as well. So yes, right now the mid-cap index as well exhibiting strength. We have picked up pace when it comes to the broader end of the markets. So that's one area that has seen quite a bit of pain if you look at the recent correction. Even though headline indices have managed to recover, the recovery in the broader end of the markets have been fairly muted. But today, mid-cap index, like yesterday, extending those gains, almost 1% gain on the mid-cap index. Bank Nifty also holding out in the green. In the recent up move, the Nifty Bank Index has been outperforming as well. So here a triple-digit gain coming in with stocks like IndusInd Bank, which reported numbers yesterday. Top Nifty gainer right now. Capex heavy stocks are doing well. UltraTech Cement up 2%. You have Bharat Electronics. The entire defense pack is extremely active at the current juncture. Yesterday as well, we saw traction in stocks like Garden Reach and other defense names. Today, of course, BEL, of course, up by 2% on the index. Aside of that, look at other stocks, M&M, auto stocks, FMCG stocks in focus, given the fact that we are waiting for some consumption boosting measures from the finance minister. M&M among gainers, and you also have other names like Axis Bank doing well, Adani Enterprises, Bajaj Auto, and even life insurance. If the government gives or sweetens the new tax regime, it won't be very positive for life insurance stocks. But nevertheless, SBI Life, HDFC Life, these stocks are holding out at the current juncture. If you look at some of the laggards on the index, you have Hero Moto not doing well, 1.5% down at the current juncture. You have some pharma names not doing well. Dr. Reddy's is also on the list. So are other names like Cipla, not doing well. Some IT names also under pressure. Look at Wipro, TCS, Tech Mahindra, all of them on tenterhooks. Aside of that, if you look at the railway stocks, as I mentioned, capex heavy stocks are doing well. There are expectations of an increase in railway budget as well on the railway spending, which is why you are seeing stocks like Titagarh Wagon, RVNL, all these stocks doing well. Aside of that, renewables is one pocket that's in focus. Inox Wind, that is up somewhere around 9% or thereabouts on the Nifty 500 index. Let's also take a look at some of the other movers on the Nifty 500 index as to how they are doing. If you look at Prestige Estates, on hopes of push for affordable housing, some of these realty names are also doing well, which is why Prestige Estates, that stock is up 7%. Look at some of the other names like Suzlon, 5% up. Cement stocks are doing well, again on hopes of higher capex allocation. India Cements up 5%. You have other stocks doing well like Data Patterns, TBS Supply, Inox India. So yes, right now the texture of the market is on the upside. As you know, it does tend to turn volatile once the FM speech starts. So let's see how things really pan out. But 23,550, we are holding on to that level, and nothing really to complain about at the current juncture, but let's see how things really pan out, whether there are changes in personal taxation, there's anything in terms of capital gains, which of course expectations aren't there this time around, but any move towards either reducing or doing away with STT, who knows, that could prop up sentiment when it comes to the market. But aside of that, from a market standpoint, there aren't really big expectations. It's fairly subdued this time around.
All right, so it seems like, thanks Nandita for that, it seems like markets seem to be very cautious in terms of the outlook towards the budget. I have with me two eminent economists. Deepti Deshpande is joining us from CRISIL, and Mr. D.K. Srivastav is joining us from EY India. Deepti, first I'll come to you on, are you also as tepid in your expectations of the budget? Are you expecting Ms. Sitharaman to really play the field like she's always played, being fiscally prudent, not rocking the boat too much, giving minor boost to consumption through some tweaks here and there?
Yeah, good morning. Absolutely, I think that's exactly something on the minds, because fiscal prudence has been the one theme that we've seen throughout over the last couple of years, and I think that's what is primarily also going to govern how the spends are undertaken in this budget. But I think, having said that, we could see a little bit of a different angle that this budget takes, because I think there are three important crucial things behind this budget. Number one, it's the first budget after the new government, after the re-election came in. So then you have about 5 years for any of the fiscal measures that are proposed throughout this year to see a light of the day. So I think that's an important backdrop to this budget. Second is, I think, expect that over the next 5 to 7 years, the impact of some of these measures, gets converted, and we get to the $7 trillion path by 2031. It means that we need to smoothen the growth process. If possible, we need to push that up. So then we do have that period now to do so. And finally, most importantly, is the fact that the timing of the budget coincides with a lot of turbulence on the global front when it comes to trade-related or tariff-related measures and actions. So it does give us an opportunity to really maneuver our way through some of this turbulence as well, by tweaking and making it a little more easy and comfortable for domestic manufacturers and exporters to work in. So I think the setting of the budget is a little bit different this time around, with a little more angle on what's about to happen globally.
Let me also bring in Mr. D.K. Srivastav. Yeah, Mr. Srivastav, you've been an astute observer of the Indian economy for several decades now. Would it be correct to say that in terms of expectations, in the last decade, this is probably the budget where expectations are riding very high? You have the rating agencies, you have the common middle class, you have urban consumption to boost, you have private investment, and you have the Trump overhang, Mr. Srivastav. If you are finance minister today, what are the key buttons that you would have accelerated on?
Well, I would advocate the underlying theme for the budget to somehow revive India's private investment and keep it within the domestic shores. That is the one engine that has not fired that well so far. And so we have to find out through fiscal means what can be done in order to revive private investment. Now, within the budget, we have one continuing stimulus coming from government's own capital expenditure, and that capital expenditure growth must be sustained. We actually witnessed it being stalled during the election year, and that is the reason why the economic survey and other observers have signaled a slight deceleration in the growth rate, but it is still quite robust at 6.4%. The expectation is even in FY26 it should be 6.4 to 6.5%. But the missing link is actually the private investment, and whatever private investment is taking place, there is also now a tendency for it to locate outside of India. So the budget therefore has to look at the fiscal means for doing so, and also look at support from the monetary side. Now, fiscal means actually the capital expenditure growth would also have multiplier effects, and it would also generate investment demand for investment goods for the private sector. But in addition, if we can get a tangible increase in disposable incomes, not just a tweaking, through personal income tax rationalization, and it is overdue also, then that would be another way where private investors would find demand actually getting augmented, and that would be one more reason. Now, the third one is far more difficult to attend to through fiscal means, because there is a lot of attraction right now in locating one's investment in the US, for example. But one significant advantage that might happen in this year is that global energy prices may come down, and that would lead to a reduction in cost of production overall. And this is also because of some of these policy announcements that the US government has made, in the sense that they are now going to augment global supply of crude oil as well as gas through shale and other means, and therefore overall global supply will increase. That will come very handy for the Indian economy. So in my sense, I think we have to now fire on all cylinders, but all the time remaining cautious that it is only domestic growth engines that would continue to fire.
Question for you. You talked about, the most important thing this budget needs to address is how do you get back private investments, and you were saying that the finance minister may look at tax breaks. Now, my question is, if you just look at the budget math, how much headroom do we have given the current state of affairs? Because your income tax is already, at a high. How much headroom do we have keeping capex spends steady at the pace that we set at least last year, if not the last 3 years? How much headroom do we have for tax breaks at all? Where's the needle?
Yes, we have to take a call on what is going to be the tax revenue growth and what is going to be the level of fiscal deficit, because these two will determine the fiscal growth available for any tax side maneuvers. Now, tax revenue growth, luckily, even though nominal GDP growth has gone down to something like 9.7% in FY25, we expect that the budget might aim for either 10 or 10.5% nominal GDP growth. Luckily, the personal income tax buoyancy has been doing well. So if we can do something about the corporate income tax and uplift its buoyancy at least close to 1, then there would be some room that would be available from the side of the tax revenues. Now, from the side of the fiscal deficit, as far as FY26 budget is concerned, because government was not able to spend up to the budgeted amount on capital expenditures, there would be some saving there, and fiscal deficit may turn out to be in the revised estimates close to 4.8%. And the next year it will be, that is FY26, it may be then targeted at 4.4%. So I think the fiscal space available may be about 0.1 to 0.15 percentage points of GDP. That may be sufficient as far as income tax reorganization is concerned.
By that number, Mr. Srivatsav, I mean it'll be some 30,000 to 40,000 crores in terms of tax breaks, and you just divide that the 3 crore taxpayer numbers, you get like 10,000, 15,000 rupees per person. Is that enough to spur private investments?
Well, it may by itself be not enough. That is why I am arguing that we should now attempt at least at 3 policy interventions. First, continue to support capital expenditure growth, which will have a larger multiplier. Then increase disposable incomes. It is the signal that comes out that the government is looking at a simplified tax structure, compliance costs are lower, and so on. That signal by itself is very important. And then also get some support from the monetary side. At least these 3 engines should fire together, but also something more can be done on the side of import tariffs, because given the global conditions, customs revenues may also be augmented by very careful calibration of the tariff structure. In particular, we need to make sure that final goods do not come into India, but intermediate raw materials and intermediate goods, at least for a finite period, are allowed in, and so that investors are encouraged to invest within the domestic economy and the raw materials and the intermediate goods are made available without much load of tariff, but they are protected in terms of the market share, because the external competition can be at least to a degree barred. As such, there are 4 or 5 instruments that must be utilized together in order to make it effective. Luckily, the capital utilization ratio right now is closer to 75, and it is above the trend capital utilization ratio, which is about just a little less than 74. So the situation is right for the private investment to start investing for new projects.
Right. Let me also bring in Deepti here. Deepti, there has been talk about a universal basic income coming through to boost consumption. Is there fiscal room available for that? And when you look at the subsidies and the welfare schemes that are already in play, we are talking about free food grains, we have cash transfers, there's already so much going on. So would universal basic income spur that demand, the demand factor that we are really looking at getting a push through this budget?
There's number one, the fiscal room available. If you look at that, each year post the pandemic, the fiscal room available with us is really shrinking, because number one, we are going towards fiscal consolidation. We need to bring down our debt burden. At the same time, year on year, so last year we went to, the budgeted number was 4.8% of GDP. If this year we go to 4.4 or 4.5% of GDP for the next fiscal, it's that much less available, because you need to bring down your deficit. So that's number one. So with the available resources, where do you spend such that it creates the highest and fastest multipliers to growth, but also in the short term does not derail other things such as your inflation target, the ability of the economy to cut interest rates, etc. So today we are in a situation where food inflation or overall inflation is a big concern, but so is food inflation. Food inflation has been high and persistent, and it's already threatening to enter and become generalized and push overall inflation. Now, in such a situation, the RBI has been trying to sort of, keep demand from pushing inflation wherever it possibly could have. So in this situation, what we need the fiscal policy to do is coordinate with fiscal monetary policy and keep track on fiscal consolidation, keep spending in a way that is non-inflationary. Now, how can they do that? They can either do that by spending on capex the way they have been, or they can spend on some of the welfare schemes which received focused last year, Narega spends, the spends on rural roads, housing, etc. Because they do two things. Number one, they create assets. Number two, they provide them employment and also, push incomes into the hands of the people who have the highest propensity to consume. But because there is supply potential or asset creation happening simultaneously, it does not net have a very big impact on inflation. So when we speak about a universal basic income, if that does come through in such a situation where we are grappling with an inflation pressure, it can push up inflation. So I think that's number one. But number two and more important is operationalization of such a policy. We need to identify the beneficiaries correctly, in the sense who needs to receive that basic income, where there is no overlap with certain other welfare schemes, etc., that have already been given out to them. So I think it will take some more time. In the meanwhile, from a macro perspective, perhaps too early to have a universal basic income at an all India level. Perhaps pilots in pockets, some states, etc., could look at it, but I think it's probably too early to have an all India level universal basic income. So that's not really an expectation.
Right. In fact, thanks for that, Deepti. We just received an image. It's a lovely image of Miss Sitharaman with the president, and I think what the president is feeding Miss Sitharaman is some yogurt and possibly some sugar in it. It's supposed to be a good luck thing, and I have not seen this before.
Neither have I. It's a very unique picture.
It's a lovely image of two women leaders, bonding and of course wishing each other luck. Here, Miss Sitharaman. I think it's a lovely. I wish we could show it to you right now. But there, so Miss Sitharaman is the first woman finance minister who will be presenting the 8th consecutive budget. I think that in itself is so historical, and the mountain of expectations that she's carrying on her shoulders today, I really wouldn't, it's an unenviable position to be in.
Oh, absolutely.
Well, we also have Siddharth Pai joining us. Siddharth, what are the big cues that you are watching out for today, and how hopeful are you that of a 1991 like budget, something that a lot of economists have spoken about? How hopeful are you that we'll see a big bang bold budget?
I think it does behoove the government to have a big bang bold budget. The previous budget also did have some strong announcements, but I think it's lacking the punch that everyone's expecting out of a third term Modi government. And Trump has actually set the pace as of now. I think he's passed over 100 executive orders within the first 3 days of actually taking office. So he set a very high bar for the rest of them to follow. I think from the private equity venture capital industry side, we've seen capital formation through AIFs drop to single digits for that matter. We've seen foreign investors pull out money from the Indian markets as well. And we've actually seen that some of these low-hanging fruit that the government can easily end up rectifying being one of the reasons for this. So as much as the government wants to extend capital support to this industry, for that matter, I think just easing up regulations, giving us parity with foreign funds, and giving us clarity on our operations will end up actually unleashing the vast amount of dry powder that's been sitting on the fence that's eager to end up actually deploying into the Indian market itself. Indian startups also have seen fantastic IPOs. The industry wants to build upon that, and having this sort of policy clarity as well as giving us the kind of economic liberalization and freedom akin to 1991 will be the best thing that the government can do for all the startups as well as venture capital and private industry funds in the entire country.
Specifically, Siddharth, are there any measures that you expect that can decisively change the FII sentiment Is there anything in this budget that could do that?
Thing is giving VC and private equity funds clarity as to how their gains are going to be taxed. Foreign investors actually all their financial assets are classified as capital assets, and therefore the income as capital gains. Whereas we've had to rely on a network and a patchwork of circulars to end up achieving that. So give us that kind of clarity. I think will end up ensuring parity between foreign funds and us. And for startups like ours, our ESOP taxation is amongst the most onerous in the world. And given the wave of startups looking to flip back to India, giving us a kind of parity with what they enjoyed in the US or Singapore will actually be essential to accelerate that entire movement back to India and to ensure that our employees don't have to go into debt just to become shareholders in the companies they help to end up building up.
On our screen, there were visuals of the finance minister with her team going into Rashtrapati Bhavan, and we're seeing the finance minister today in a lovely Madhubani sari.
Yeah, looked like a very unique Madhubani sari. Yes,
like a really unique Madhubani sari. See, every year she makes a statement with the sari that she wears.
Right.
So
does it have anything to do with what that state? Something related to the state.
Too, maybe it'll be a budget focused or a lot on the social sector. That's the sense I'm getting. There we have it. It does look like a Madhubani sari.
Sari is an indicator for sure.
As journalists, we feel so compelled, and look, they're color coordinated. The president is also
bear in mind that this is the last budget before the Bihar elections in 2025 November.
See, there is always a message. There is always a message. Absolutely. Yes, the last elections before the Bihar budget, last time around we saw a big package coming through for Andhra Pradesh.
Was she wearing any Pakshi Kalamkari sari last year? I don't remember.
But this year, there Gaurav has put it in perspective that Bihar could be a state that could be, feeling very happy after this budget. Also, President Murmu color coordinated with the finance minister. So it's a lovely sight. Well, we have Samiran joining us. Hi, Samiran. How are you feeling this morning?
Hi, good morning.
Are you also under pressure to really, deliver a compelling report on the budget? There's so much expectation around this budget. It should be a 1991-like budget. Is that what you're expecting as well, Samiran?
If it's not a 1991 situation, then it can't be a 1991 budget. Like, do you agree? Disagree?
Obviously, every budget that markets, the economists, we go with a lot of expectations, but we also understand the context, the challenges that the finance minister poses. At one extent, economists want the fiscal deficit to come down, but middle class wants income tax cut. Industry wants more capex spend. So it's always a very calibrated, difficult balance that the finance minister will have to strike. So this year is not going to be any different. After the budget, we'll just have to figure out in which way the balance is slightly more tilted.
Do you think this will be an economist's budget, or will this be a politician's budget? Because it comes after an election year. It comes after two big wins in the state of Maharashtra and Haryana. It's coming days before the Delhi election. Do you think by this point the Modi government is out of that constant election fighting mode?
So clearly, both in the near term and medium term, there is now a clear need for policy impetus. The economic survey yesterday has made it very clear that just going on BAU would not be enough. So from that perspective, what will be important is that the small cyclical dip that we have seen in growth rates, how the budget tries to correct that. And also, outside the budget math, what are the steps being taken to ensure the economic survey's objective that India grows at 8% for a decade or two? Both the things, so both the budget math part as well as these sort of structural reforms for the more medium-term growth, I think both will be very important. As an economist, I would probably be more hopeful that the second, the structural reforms part, which will push us to that 8% growth, that gets a lot of prominence. On that note, we are looking forward to that economic policy framework document that will be put out for the first time to see what's the plan over the next 5 years. As we know, this is the first year of the third term of the Modi government. So this is probably a good time to lay out that at least the next 5 years what the planning is on.
Right. Let's go across to our veteran, budget analysts here. Bodhi and Gaurav, both of you have analyzed and gone through so many budgets. So, we heard Samiran talk about how this is a tough balancing act and so on. In the past, if I were to ask you to jog your memory, any finance minister besides Mr. Manmohan Singh, of course, who's had to deal with these kind of expectations, and how did we emerge, after that specific budget was presented? I remember when Mr. Pranab Mukherjee had introduced that dreadful retrospective taxation, and that came out of nowhere, and there was an expectation at that time that the budget will be very reform focused, but this little caveat was brought into it. So, just to give us some historical context on how has India, navigated tricky situations like we find ourselves in today, where domestically consumption is going down, globally you have the Trump factor, looming over us. Bodhi, do you want to take that first?
Well, okay, so I think if you look at, and there's obviously 1991, which is not perhaps, there is the 97 budget where there were a lot of tax cuts and so on. That was, Chidambaram's budget. If you look after that, maybe the closest analogy could actually be the 2019 budget, because growth had started slowing down.
Right.
The first 2 years of the Modi government from 2014 onwards saw high rate of growth.
Yeah.
Then there was a slowdown from 16-17 onwards, 18-19. So that budget did in fact introduce, among other things, a 15% tax rate on manufacturing. So there were some growth friendly measures. So that could be one issue, although there was no global crisis at that time. I mean, there isn't a crisis now, but there could be one if tariffs start going in this thing. But quite frankly, the 2019 budget, some of it's kind of got lost, because after that you had the pandemic, 8 or 9, sometime after that. 2019 budget, I'm talking about the one which came after the elections, at the beginning of the second Modi term. But 8 months later there was a pandemic, so it sort of kind of faded away. Some of the Vajpayee government budgets have certainly dealt with tough periods. So the one after the Asian crisis of 1998, the 99 budget have dealt with quite a tough economic situation. There was a mini recession at the beginning of the century. There was obviously the attacks on the Twin Towers, which created etc. So those budgets where Yashwant Sinha was the finance minister have dealt with such situations. But quite frankly, this is a unique situation. The global uncertainty is really being caused by Trump's tariffs coming in, which could lead to, if 25% tariffs on Canada and Mexico kick in this weekend, the markets will probably plunge in the US and probably worldwide because of that. 10% of tariffs in China are being questioned, and you're in a wild card kind of a situation, right? It depends on how long these tariffs last, whether they roll back after some time. So nobody really knows. But yeah, it's a tricky situation. One observation that I'd like to make, I mean, sort of summarizing almost 2.5 hours of discussion that we had on one, 3.5 hours, is that there is a lot of expectation. All our commentators, some of us have also spoken about that, cut income tax rates, especially for the 10 to 15 lakh range. 30% will kick in, maybe the 10% will kick in. So there is an expectation of some relief because of the slowdown, because the economy has clearly hit a soft patch. The issue is that now it's kind of circular. The problem is that because the private sector is not investing, the government has to invest, has to pick up do the heavy lifting, and they have to meet fiscal deficit targets, and you want them to cut tax rates. Now, all this is not possible at the same time. It's logically, it cannot happen. Right, everyone wants lower capital gains tax, lower income tax, lower corporate tax rates to incentivize manufacturing. But all of this cannot lower GST rates again to boost consumption. But logically, all of this cannot happen at the same time. It's not possible. So I mean, sort of, it is a as to use a term that you've been using, it's an unenviable situation to be in, but let's see. I think the vision statement part, which one of the commentators, what she spells out a vision for reforms.
Yeah.
If there are steps like a rollback in tariffs, which is seen as a reformist measure, some of that might also be in reaction to Mr. Trump. If there is talk about and some steps announced in terms of enhancing ease of doing business, which was there. So those things are, I think that could sort of lift sentiments, possibly boost the markets.
So one question I'd like to ask probably Gaurav and then Mr. Srivatsav is that if you look at the history of economies and how they've grown, you can't think of any large economy that has really grown just domestically, based on domestic growth, right? It is always export-led. You look at Southeast Asian countries, you look at China, you look at any country. Now, today we are in an environment where the biggest consumer or biggest importer is saying that we don't want so much of imports, we are going to put barriers onto that. Our ability to trigger growth or import growth looks to be under threat. When you put this in context and look at the consumption slowdown and the cap on middle class, the hurdles that middle class and poor are facing, doesn't look like it's a one-year thing. You need a large, some kind of a pivot of sorts to be able to ensure that we are able to achieve the growth targets that we keep talking about. How big is that issue?
No, absolutely, and we saw that how the economic survey yesterday actually flagged it without mentioning the word Trump even once. It went on to say how rising global protectionism it could turn out to be a big cause for worry, and also how global supply chain disruptions is something that we need to really take very seriously. But just on the point that Shweta had raised on budgets, in difficult budgets, I think the most difficult budget that was circumstances was in 21-22 when we were in the middle of the pandemic.
Yeah.
And that was something I think no finance minister in India's history since 47 would have been facing. And so you have to give it to the current finance minister's credit that she took the bold decision of raising the fiscal deficit to 9.2%, and at the same time committed and pledged that it will be brought below 4.5% by 2020 FY26, which is what this budget is likely to do. Also, this budget, I think, and the point that Samiran made, whether the medium-term fiscal policy framework that is going to be presented along with this budget for the next 5 years, there is a very high degree of expectation that we could probably see a signaling of a change in the fiscal policy architecture as we know it.
Okay.
We probably could be moving from a purely fixated fiscal deficit kind of a target to a debt to GDP ratio, which could be the primary marker and metric for public finance and fiscal policy management. If that happens, because if you look at the debt to GDP ratio, it is now about 56 to 57%, 56.8%. It has to be brought down to below 50% first, and then around about 40%. It had gone up to about 61% in 21-22. I think that's going to be, the government is going to clearly signal the debt to GDP ratio is going to be the primary metric that fiscal policy is going to change. It's something that the markets, the bond markets, and everyone in the rating agencies will be keenly watching out for, because if that happens, that's a significant shift.
Right.
In this
fact,
fiscal.
let's just hold that thought, Gaurav. Let me bring in Samiran here. Samiran, you heard Gaurav Chaudhary talk about the fiscal policy framework and how we could see a paradigm shift there. So I want to bring in your thoughts on, what is it really that you're expecting to see there, and what would you like to see in that framework?
There are two, three things here. One is the government has not yet articulated a quantifiable roadmap on this public debt to GDP reduction. It has given a qualitative thing saying that as long as it is on declining path, that means we are doing the right kind of consolidation. So what the market is hoping for is that in this budget, there will be some quantification around this. The second issue is that the deficit numbers are not going to go away. I mean, there is still, there will be some emphasis on where these deficit numbers should be in the context of that debt reduction. However, the important part is that if you do the maths in detail, what comes out is that as long as nominal GDP growth stays ahead of 10%, it is relatively easy to get the debt to GDP ratio on a declining path, even without cutting back much on deficit. So that way, the budget cannot be too restrictive also, because then we miss the 10% nominal GDP growth target, and that would make the debt consolidation even that much difficult. So that's where the fine balance comes in, that how much deficit reduction you do to get the debt down versus how much support you give to nominal growth through the higher deficit to get achieve the same objective.
So ML, clearly, as Samiran has also outlined, it's a very, it's to quote a cliche, it's a tightrope walk. Yeah. And we are looking at a single-digit nominal GDP growth. Am I right, God? We're looking at about 9%, or it could be
not more than 10%. The poll that we did,
I think the government will signal more than 10% growth in nominal terms in the budget. Eventually, how it plays out will be a matter of various other factors, including the point that ML had raised. We are serious global headwinds we are facing, and despite the very strong arguments on globalization as discontents, we live in a hugely globalized world. We cannot ourselves decouple from it. Clearly, if something the headwinds are going to affect us too, and so how we are going to navigate this very complex landscape is something that people will be watching out for the budget to signal. It's going to be more than just accounting, in this case public finance accounting. I think the signaling from the government, given the current economic environment, not just domestically but globally, is something that will, the phraseology that the government uses, that she uses in her speech, is going to be extremely interesting to watch out.
Absolutely. Let me also bring in Deepthi here. Deepthi, if you can hear me, we've in terms of the revenue streams for the government, disinvestment is something that we are not very optimistic on. Over time, we've seen that the government has de-emphasized on disinvestment. However, are you expecting any surprises there? And also on the RBI dividends, how much of a cushion is that providing to the government?
Yeah, I think last 2 to 3 years, this has changed. On the disinvestment part, the number one thing to note is that the government has acknowledged that it doesn't make sense to have huge disinvestment targets, so they reasonably brought it down. Unfortunately, at least for the current year and a little bit for the last year as well, we weren't able to meet those targets as well. So I think going forward, the focus really needs to be to, spruce up some of our revenue that can come in from more of taxation. Not by that I do not quite intend higher tax rates, but I think the buoyancy, the ability of the economy to generate taxes via higher growth, better administration, better compliance. I think all of that needs to be the focus. The RBI dividend has of course remained a bonanza for us for the last 1 or 2 years, and that might remain a little bit of a support. But like I said, the focus must be on ensuring that the economy over time is able to generate revenues on its own via taxes and direct and indirect taxes.
Yeah. On the RBI bonanza, I think the RBI dividends this time also a huge, massive amount is coming in, which is, from a public finance point of view, whether depending on RBI to take care of a large number of large components of expenditures, good thing or bad thing, that's a matter of different debate. But I think last year, on the back of a 2.1 lakh crore payout last year, and even if the government pencils in about 1.5 to 1.6, that's a huge amount of money that the government is expecting from the RBI to come in as dividends. Disinvestment as a revenue generating source, I think we have already heard the last of it. This government has now probably made peace with the fact that disinvestment cannot be a revenue generating source. It had tried setting huge targets, very ambitious targets of more than 1 lakh crore in previous budgets. Close to 30% of that probably would have been achieved in those years. So I don't think this investment is going to feature very, very prominent. In fact, the word disinvestment doesn't feature in the budget since last year.
Okay, very quickly, Samiran, I know you have to leave and we just have about 10 minutes before the budget speech starts. Any new themes that you're expecting in this budget? I'm sure you've been part of some meetings where recommendations have been made to the finance minister. Anything that you can share with us, Samir?
I guess the focus from a market standpoint also will be on the capex number a lot, and there the new theme could be diversification of capex. As you know, right now the central government capex is extremely focused on just 3 areas of roads, railways and defense. If we are able to expand this to newer areas like urban development, social housing, water, R&D, renewables, then that will be a big positive booster because there is a perception developing that if we want to grow capex at a rate higher than nominal GDP growth, which means the capex to GDP ratio will keep on increasing, then it is difficult to do it just through these traditional sectors of roads and railways because we will not have that much of execution capability there. So that's where I think the diversification of capex would be a very important thing for me to track in this budget. This will lay down the roadmap for the next 5 years on how the government is going to give the supply side push to the economy.
Thank you, Samiran, for joining us, and many thanks to Deepthi Deshpande also for joining us. We, of course, just have about 10 minutes to go before the finance minister presents the budget. Gaurav, yes.
So one of the things, of course, a fiscal deficit remains the primary number that everyone is going to track because it has, it has its impact and consequences not just in the bond markets and markets in general, but also individuals, because a higher fiscal deficit actually shrinks the pool of lendable resources for individuals, which kind of raises interest rates. So there's a bearing on everyone. But one of the things that most people who track, public finances, particularly from a market's point of view, will be watching is also the primary deficit. Right. It has been very judiciously coming down, and last budget, that is FY25 budget, it was pegged at 1.4%. And now, what does the primary deficit tell you? It tells you that lower the primary deficit, a lesser amount or a lesser proportion of the fiscal deficit or the government borrowing is being used up to pay up for interest rates. So, it's interest rate payments is devouring less amount of the borrowing. If the primary deficit in this budget is pegged at less than 1%, that's going to be a telling comment on the growing, on the rising fiscal health of the economy, and also a judiciousness, which fiscal purists will really like, and I think that the markets are going to really like it.
Absolutely. Okay, very quickly, from a political point of view, yesterday when the president's address, the president mentioned Delhi Metro. Right, she made a mention of the Delhi Metro. Besides the other
it's an interesting
lot of schemes that the government is working on, she mentioned specifically the Delhi Metro, which I thought was very interesting. So, do we expect something for Delhi?
No, so Shweta, I'll make a point here. The Election Commission has made it very clear that the budget cannot contain specific measures for Delhi, because Delhi goes to election 3 days from now.
Right.
So it's going to be a violation of the model code of conduct. Having said that, however, the federal budget, that is the central budget, technically also presents the Delhi budget. So it's an accounting exercise also for the Delhi government of the Delhi budget.
Right.
There could be in the fine print, there could be details hiding of greater allocations for various kinds of things in Delhi. I think those are something that will come out in the budget. Very interesting to watch what the government does so far as Delhi is concerned.
How the government would try and get past the EC and try and give Delhi Wala something Mahalakshmi.
Correct. Just a quick market update. I'm just looking at the sectoral performances at this hour.
Yes.
Nifty Realty is on top, which is essentially interesting considering that this year has been pretty bad. Realty demand compared to last year, which was actually blockbuster year for all the realty companies, 1.3% up. So that's some expectation this morning.
Is that because there's expectations of the Pradhan Mantri Awas Yojana, urban and rural, to go up?
Perhaps. Maybe also some exemption related stuff.
But the components of the realty index, do they really cater to the kind of the Pradhan Mantri Awas Yojana, the kind of users of Pradhan Mantri Awas?
It has, but those are not the top weights. But I'll tell you what, Prestige Estates, so these are all big housing. Prestige Estate, Shobha, DLF, Raymond, Prestige is up 6%, Shobha 4.5%, DLF 1.3%. So this is not the affordable housing, these are not the affordable housing stocks, but in general there is at least in the market a lot of people have been expecting that something, even in the economic survey yesterday they mentioned that realty is an important sector and has demand there has tapered off compared to the previous year, so perhaps some measure
so this is probably the higher tax deduction limit for interest or principal on home loans.
Definition of middle class, the definition of affordable can also vary, but none of these companies have much to do with the Pradhan Mantri Awas Yojana.
Yeah, could be reduction of duties and construction materials. That's probably what's
also intermediates, maybe cement and steel.
Yeah.
But if you look at the numbers, PMJAY, urban and rural actually grew 56% last year compared to the previous year. So I think that could be one of the reasons why reality is really watching, because this serves as a signal for what the government's emphasis is.
ML, what are the other sectors?
PSUs are up 1%, not too much. Energy, actually there is hardly any dispersion, most of it is 0.5 to 1%, and IT is actually the only loser, but that also FMCG stocks are losers this morning. So markets are not.
But what could actually be a downside for the market if the capex, if the capex budget or the growth in capex budget actually is below the nominal GDP growth rate? Meaning to say that if 11 lakh crore was the capex budget last year. If the nominal GDP is pegged at say about 10.9 or 10.5, 11%, and if the capex growth in the capex budget is less than that, that could be a bit of a disappointment.
That will be a disappointment, more so because I think that pack of stocks are already doing badly. So this will be like double pressure.
Well, 5 minutes to go, ML, for the budget speech to begin. And we just had some visuals of Amit Shah walking in to the parliament. So yeah, in another 5-7 minutes, we'll start getting a sense of what this budget will look like. That has been pitched as a historic budget, 1991-like budget, tall expectations.
I think the government or the finance minister and also in general this government would like this budget to be remembered more as a 2025 budget than a 1991.
But Gaurav and Bodhi, I want to ask both of you this question. So initially the BJP government had this whole the Sangnomics was a big part of BJP's economics, right? And I remember when Mr. Yashwant Sinha had presented the budget and there was talk of increasing the FDI cap on insurance.
That's right.
And there was a huge protest by the Swadeshi Jagran Manch then, and since then of course we've seen a complete sea change in the way all the sectors nearly have been opened up for FDI, but there is demand for further opening.
Interesting. Insurance, there has been a lot of talk that probably we can see up to 100% FDI being opened up.
FDI,
this budget could well be the occasion to make that announcement if it does, if it happens.
Dr. Surjit Bhalla, in an interview to us and in an article that he wrote, he highlighted the deep state. How deep state is holding India's growth story back. So one of the things that he highlighted was that how India started breaking up all its investment treaties with other countries, and one of the clauses that it inserted in those investment treaties was that all so-called divorce settlements, if a country wants to exit, they will have to come to Indian courts to settle that. So that was a big breaking point, and that has driven much of that exodus from India when it comes to falling FDI in the country. So this budget definitely presents the government with an opportunity to correct some of that.
So specifically with regard to FDI, I think this was in reaction to the Vodafone and the Kane episode, where those investments had international arbitration provisions, and the international arbitration panels ruled against India. So it was a reaction from the finance ministry. I'm not that sure about the deep state angle, but the finance ministry, certainly the bureaucracy, the finance ministry over successive finance secretaries of bureaucracies took this call, and the government then said that they scrapped arbitration clauses from these from the bilateral investment agreements, and said everything is under Indian court. So it was an assertion of sovereignty, of Indian sovereignty, which by the way is very much in keeping with this government's general outlook. Can that be reversed? I'm not sure. I mean, I'm not even sure whether that's holding up foreign investment in any significant way. It could, yeah, but it's been mentioned as an area. But
also one important point to remember from the, on FDI, from the market's point of view, because valuations have been so high, over the last 2 years, you've seen a lot of multinational companies actually pair exposure to Indian markets. For example, Whirlpool. Many of these companies have actually sold down their stake. As we speak, I mean, day before yesterday, Whirlpool stock was down 20% because now they're going down from 51% to, I think, 20%. So they just sold about 25% stake last year, and now they're bringing it down by another 20%. It might be an extreme example, but that is also one contributor to FDI reverse flow.
But one thing that this budget, which probably we can say with a degree of certainty, is that for the it's done.
Okay, should be.
All right. Okay. Well, I think just about a minute to go before Ms. Sitharaman presents the budget in the Parliament. So we'll of course come back with an analysis of the budget speech and watch what the budget holds for India.
Done. माननीय सदस्यगण, आइटम नंबर 1 श्रीमती निर्मला सीतारमण वित्त मंत्री सदस्यगण, बजट के बाद राज्यपाल अभिभाषण में आपको पर्याप्त अवसर दूंगा। मेरा आपसे निवेदन है, नहीं माननीय अखिलेश जी, आपने संसद की मर्यादा को आप बना के रखें। कभी बजट भाषण के अंदर इस तरीके का नहीं हुआ, ये उचित नहीं है, ये उचित नहीं है। अखिलेश जी प्लीज, मैं आपको मौका दूंगा राज्यपाल अभिभाषण पे, प्लीज। नो, ये तरीका ठीक नहीं है। नो, राज्यपाल अभिभाषण पर चर्चा होगी। नो तरीका।
Honorable Speaker, I present the budget for 25-26. This budget continues our government's efforts to A. Accelerate growth, B. Secure inclusive development, C. Invigorate private sector investments, D. Uplift household sentiments, and E. Enhance spending power of India's rising middle class. Together, we embark on a journey to unlock our nation's tremendous potential for greater prosperity and global positioning under the leadership of Honorable Prime Minister Shri Narendra Modi. As we complete the first quarter of the 21st century, continuing geopolitical headwinds suggest lower global economic growth over the medium term. However, our aspiration for a Vikasit Bharat inspires us, and the transformative work we have done during our government's first 2 terms guides us to march forward resolutely. Our economy is the fastest growing among all major economies. Our development track record for the past 10 years and structural reforms have drawn global attention. Confidence in India's capability and potential has only grown in this period. We see the next 5 years as a unique opportunity to realize Sabka Vikas, stimulating balanced growth of all regions. The great Telugu poet and playwright Gurujada Apparao had said, Deshamante matti kadoy, Deshamante manushuloy, meaning a country is not just its soil, a country is its people. In line with this, for us, Vikasit Bharat encompasses zero poverty, 100% quality good school education, access to high quality, affordable and comprehensive health care, 100% skilled labor with meaningful employment, 70% women in economic activities, and farmers making our country the food basket of the world. In this budget, the proposed development measures span 10 broad areas focusing on Garib, Youth, Annadata and Nari, spurring agricultural growth and productivity, building rural prosperity and resilience, taking everyone together on an inclusive growth path, boosting manufacturing and furthering Make in India, supporting MSMEs, enabling employment-led development, investing in people, economy and innovation, securing energy supplies, promoting exports and nurturing innovation. For this journey of development, our four powerful engines are agriculture, MSME, investments and exports. The fuel, our reforms, our guiding spirit, inclusivity, and the destination, Vikasit Bharat. This budget aims to initiate transformative reforms across 6 domains. During the first 5 years, these will augment our growth potential and global competitiveness. The domains are taxation, power sector, urban development, mining, financial sector, and regulatory reforms. Agriculture as the first engine. Now I move to specific proposals, beginning with agriculture as the first engine. Prime Minister Dhan Dhanya Krishi Yojana, developing agri-districts program. Motivated by the success of the aspirational district program, our government will undertake a Prime Minister Dhan Dhanya Krishi Yojana in partnership with states. Through the convergence of existing schemes and specialized measures, the program will cover 100 districts with low productivity, moderate crop intensity, and below average credit parameters. It aims to 1. Enhance agricultural productivity, 2. Adopt crop diversification and sustainable agricultural practices, 3. Augment post-harvest storage at the panchayat and block level, 4. Improve irrigation facilities, and 5. Facilitate availability of long-term and short-term credit. This program is likely to help 1.7 crore farmers. Building rural prosperity and resilience. A comprehensive multi-sectoral rural prosperity and resilience program will be launched in partnership with the states. This will address underemployment in agriculture through skilling, investment, technology, and invigorating the rural economy. The goal is to generate ample opportunities in rural areas so that migration is an option but not a necessity. The program will focus on rural women, young farmers, rural youth, marginal and small farmers, and landless families. The details are in Annexure A. Domestic best practices will be incorporated, and appropriate technical and financial assistance will be sought from multilateral development banks. In phase 1, 100 developing agri-districts will be covered. Atmanirbharta in pulses. Our government is implementing the National Mission for Edible Oilseed for achieving Atmanirbharta in edible oils. Our farmers have the capability to grow enough for our needs and more. 10 years ago, we made concerted efforts and succeeded in achieving near self-sufficiency in pulses. Farmers responded to the need by increasing the cultivated area by 50% and government arranged for procurement and remunerative prices. Since then, with rising incomes and better affordability, our consumption of pulses has increased significantly. Our government will now launch a 6-year mission for Atmanirbharta in pulses with a special focus on Tuar, Urad and Masoor. Details are in Annexure B. Central agencies such as NAFED and NCCF will be ready to procure these 3 pulses as much as offered during the next 4 years from farmers who register with these agencies and enter into agreements. Comprehensive program for vegetables and fruits. It is encouraging that our people are increasingly becoming aware of their nutritional needs. It is a sign of a society becoming healthier. With rising income levels, the consumption of vegetables, fruits, and Shri Anna is increasing significantly. A comprehensive program to promote production, efficient supplies, processing, and remunerative prices for farmers will be launched in partnership with the states. Appropriate institutional mechanisms for implementation and participation of farmer producer organizations and cooperatives will be set up. Makhana board in Bihar. For this, there is a special opportunity for the people of Bihar. A Makhana board will be established in the state to improve production, processing, value addition, and marketing of Makhana. The people engaged in these activities will be organized into FPOs. The board will provide hand-holding and training support to Makhana farmers and will also work to ensure they receive the benefits of all relevant government schemes. A national mission on high-yielding seeds will be launched, aimed at 1. Strengthening research ecosystem, 2. Targeted development and propagation of seeds with high yield, pest resistance, and climate resilience, and 3. Commercial availability of more than 100 seed varieties released since July 2024. India ranks second largest globally in fish production and aquaculture. Seafood exports are valued at 60,000 crore rupees. To unlock the untapped potential of the marine sector, our government will bring in an enabling framework for sustainable harnessing of fisheries from Indian exclusive economic zone and high seas, with a special focus on the Andaman and Nicobar and Lakshadweep Islands. For the benefit of lakhs of cotton growing farmers, I am pleased to announce a mission for cotton productivity. This 5-year mission will facilitate significant improvements in productivity and sustainability of cotton farming and promote extra long staple cotton varieties. The best of science and technology support will be provided to farmers. Aligned with our integrated 5F vision for the textile sector, this will help in increasing incomes of the farmers and ensure a steady supply of quality cotton for rejuvenating India's traditional textile sector. Kisan credit cards facilitate short-term loans for 7.7 crore farmers, fishermen, and dairy farmers. The loan limit under modified interest subvention scheme will be enhanced from 3 lakh rupees to 5 lakh rupees for loans taken through the KCC. For Atmanirbharta in urea production, our government had reopened 3 dormant urea plants in the eastern region. To further augment urea supply, a plant with annual capacity of 12.7 lakh metric tons will be set up at Namrup in Assam. India Post, with 1.5 lakh rural post offices, complemented by the India Post Payment Bank and a vast network of 2.4 lakh Dak Sevaks, will be repositioned to act as a catalyst for the rural economy. Details are at Annexure C. India Post will also be transformed as a large public logistics organization. This will meet the rising needs of Vishwakarmas, new entrepreneurs, women, self-help groups, MSMEs, and the large business organizations. Our government will provide support to NCDC for its lending operations for the cooperative sector. MSMEs as the second engine. Now I move to MSMEs as the second engine, which encompasses manufacturing and services with a focus on MSMEs numbering 5.7 crores. Currently, over 1 crore registered MSMEs, employing 7.5 crore people and generating 36% of our manufacturing, have come together to position India as a global manufacturing hub. With their quality products, these MSMEs are responsible for 45% of our exports. To help them achieve higher efficiencies of scale, technological upgradation, and better access to capital, the investment and turnover limits for classification of all MSMEs will be enhanced to 2.5 and 2 times respectively. This will give them the confidence to grow and generate employment for our youth. The details are given in Annexure D. To improve access to credit, the credit guarantee cover will be enhanced. First, for micro and small enterprises from 5 crore to 10 crore rupees, leading to additional credit of 1.5 lakh crores in the next 5 years. Second, for startups from 10 crore rupees to 20 crore rupees, with the guarantee fee being moderated to 1% for loans in 27 focus sectors which are important for Atmanirbhar Bharat. And for well-run exporter MSMEs, for term loans up to 20 crore rupees. Also for the micro enterprises, we will introduce customized credit cards with a 5 lakh rupee limit for micro enterprises registered on Udyam portal. In the first year, 10 lakh such cards will be issued. Fund of funds for startups. The alternate investment fund, AIFs, for startups have received commitments of more than 91,000 crores rupees. These are supported by the fund of funds set up with the Government of India's contribution of 10,000 crore rupees. Now, a new fund of funds with expanded scope and a fresh contribution of another 10,000 crore rupees will be set up. A new scheme will be launched for 5 lakh women, scheduled castes and scheduled tribes, first-time entrepreneurs. This will provide term loans up to 2 crore rupees during the next 5 years. The scheme will incorporate lessons from the successful Stand Up India scheme. Online capacity building for entrepreneurship and managerial skills will also be organized. Measures for labor-intensive sectors. To promote employment and entrepreneurship opportunities in labor-intensive sectors, our government will undertake specific policy and facilitation measures. To enhance the productivity, quality, and competitiveness of India's footwear and leather sector, a focus product scheme will be implemented. The scheme will support design capacity, component manufacturing, and machinery required for production of non-leather quality footwear, besides the support for leather footwear and products. The scheme is expected to facilitate employment for 22 lakh persons, generate over 4 lakh crore rupees, and exports of over 1.1 lakh crore rupees. Measures for the toys sector. Building on the National Action Plan for Toys, we will implement a scheme to make India a global hub for toys. The scheme will focus on development of clusters, skills, and a manufacturing ecosystem that will create high quality, unique, innovative, and sustainable toys that will represent the Made in India brand. Support for food processing. In line with our commitment towards Purvodaya, we will establish a National Institute of Food Technology, Entrepreneurship and Management in Bihar. The institute will provide a strong fillip to food processing activities in the entire eastern region. This will result in 1. Enhanced income for the farmers through value addition to their produce, and 2. Skilling entrepreneurship and employment opportunities for the youth. Manufacturing mission, furthering Make in India. Our government will set up a national manufacturing mission covering small, medium and large industries for furthering Make in India by providing policy support, execution roadmaps, governance and monitoring framework for central ministries and states. Details are in Annexure E. Given our commitment to climate-friendly development, the mission will also support clean tech manufacturing. This will aim to improve domestic value addition and build our ecosystem for solar PV cells, EV batteries, motors and controllers, electrolyzers, wind turbines, very high voltage transmission equipment and grid scale batteries. Investment as the third engine. Now I move to investment as the third engine, which encompasses investing in people, investing in the economy and investing in innovation. Investing in people. Saksham Anganwadi and Poshan 2.0. Saksham Anganwadi and Poshan 2.0 program provides nutritional support to more than 8 crore children, 1 crore pregnant women and lactating mothers all over the country, and about 20 lakh adolescent girls in aspirational districts and the Northeast region. The cost norms for these nutritional support will be enhanced appropriately. Atal Tinkering Labs. 50,000 Atal Tinkering Labs will be set up in government schools in the next 5 years to cultivate the spirit of curiosity and innovation and foster a scientific temper among young minds. Broadband connectivity to government secondary schools and PHCs. Broadband connectivity will be provided to all government secondary schools and primary health centers in rural areas under the BharatNet project. Bharatiya Bhasha Pustak Scheme. We propose to implement a Bharatiya Bhasha Pustak scheme to provide digital form Indian language books for schools and for higher education. This aims to help students understand their subjects better and in their language. National Centers of Excellence for Skilling. Building on the initiative announced in the July 24 budget, 5 national centers of excellence for skilling will be set up with global expertise and partnerships to equip our youth with the skills required for Make for India, Make for the World manufacturing. The partnership will cover curriculum design, training of trainers, and a skills certification framework and periodic reviews. Expansion of capacity in IITs. Total number of students in 23 IITs has increased 100% from 65,000 to 1.35 lakh in the past 10 years. Additional infrastructure will be created in the 5 IITs started after 2014 to facilitate education for 6,500 more students. Hostel and other infrastructure capacity at IIT Patna will also be expanded. Center of Excellence. Center of Excellence in AI for Education. I had announced 3 centers of excellence in artificial intelligence for agriculture, health, and sustainable cities in 2023. Now a center of excellence in artificial intelligence for education will be set up with a total outlay of 500 crores. Expansion of medical education. Our government has added almost 1.1 lakh undergraduate and postgraduate medical education seats in 10 years, an increase of 130%. In the next year, 10,000 additional seats will be added in medical colleges and hospitals towards the goal of adding 75,000 seats in the next 5 years. Daycare cancer centers in all district hospitals. Our government will facilitate setting up of daycare cancer centers in all district hospitals in the next 3 years. 200 centers will be established in 25-26 itself. Strengthening urban livelihoods. Our government has been giving priority to assisting urban poor and vulnerable groups. A scheme for socio-economic upliftment of urban workers will be implemented to help them improve their incomes, have sustainable livelihoods, and a better quality of life. PM Swanidhi scheme has benefited more than 68 lakh street vendors, giving them respite from high-interest informal sector loans. Building on this success, the scheme will be revamped with enhanced loans from banks, UPI-linked credit cards with 30,000 rupees limit, and capacity building support. Social Security Scheme for welfare of online platform workers. Gig workers of online platforms provide great dynamism to the new age services economy. Recognizing their contribution, our government will arrange for their identity cards and registration on the e-Shram portal. They will be provided healthcare under PM Jan Arogya Yojana. This measure is likely to assist nearly 1 crore gig workers. Investing in the economy. Public-private partnership in infrastructure. Each infrastructure-related ministry will come up with a 3-year pipeline of projects that can be implemented in PPP mode. States will also be encouraged to do so and can seek support from the India Infrastructure Project Development Fund, which is a scheme to prepare PPP proposals. Support to states for infrastructure. An outlay of 1.5 lakh crore is proposed for the 50-year interest-free loans to states for capital expenditure and incentives for reforms. Building on the success of the first asset monetization plan announced in 2021, the second plan for 2025 to 30 will be launched to plow back capital of 10 lakh crore in new projects. Regulatory and fiscal measures will be fine-tuned to support the plan. Jal Jeevan Mission. Since 2019, 15 crore households, representing 80% of India's rural population, have been provided access to portable tap water connections. To achieve 100% coverage, I am pleased to announce the extension of this mission until 2028 with an enhanced total outlay. The mission's focus will be on the quality of infrastructure and O&M of rural piped water supply schemes through Jan Bhagidari. A separate MOU or separate MOUs will be signed with the states and union territories to ensure sustainability and citizen-centric water services delivery. Urban sector reforms. Building on the July budget proposals, urban sector reforms related to governance, municipal services, urban land and planning will be incentivized. Urban Challenge Fund. The government will set up an Urban Challenge Fund of 1 lakh crore rupees to implement the proposals for cities as growth hubs, creative redevelopment of cities, and for water and sanitation purposes announced in the July budget. This fund will finance up to 25% of the cost of bankable projects, with a stipulation that at least 50% of the cost is funded from bonds, bank loans, and PPPs. An allocation of 10,000 crore is proposed in 2025-26. Power sector reforms. We will incentivize electricity distribution reforms and augmentation of intra-state transmission capacity by states. This will improve financial health and capacity of electricity companies. Additional borrowing of 0.5% of GSDP will be allowed to states contingent on these reforms. Nuclear energy mission for Vikasit Bharat. Development of at least 100 gigawatt of nuclear energy by 2047 is essential for our energy transition efforts. For an active partnership with the private sector towards this goal, amendments to the Atomic Energy Act and the Civil Liability for Nuclear Damage Act will be taken up. A nuclear energy mission for research and development of small modular reactors with an outlay of 20,000 crore will be set up. At least 5 indigenously developed small modular reactors will be operationalized by 2033. Shipbuilding. The shipbuilding financial assistance policy will be revamped to address cost disadvantages. This will also include credit notes for shipbreaking in Indian yards to promote the circular economy. Large ships above a specified size will be included in the infrastructure harmonized master list. Shipbuilding clusters will be facilitated to increase the range, categories and capacity of ships. This will include additional infrastructure, facilities, skilling and technology to develop the entire ecosystem. Maritime Development Fund. For long-term financing for the maritime industry, a Maritime Development Fund with a corpus of 25,000 crore rupees will be set up. This will be for distributed support and promoting competition. This will have up to 49% contribution by the government, and the balance will be mobilized from ports and from private sector. UDAN regional connectivity schemes. UDAN has enabled 1.5 crore middle-class people to meet their aspirations for speedier travel. The scheme has connected 88 airports, and operationalized 619 routes. Inspired by that success, a modified UDAN scheme will be launched. to enhance regional connectivity to 120 new destinations and carry 4 crore passengers in the next 10 years. 4 crore additional passengers in the next 10 years. The scheme will also support helipads and smaller airports in hilly, aspirational and northeast regional districts. Greenfield airports will be facilitated in Bihar to meet the future needs of the state. These will be in addition to the expansion of the capacity of Patna Airport and a brownfield airport in Beta. Western Kosi Canal project in Mithilanchal. Financial support will be provided for the Western Kosi Canal ERM project, benefiting a large number of farmers cultivating over 50,000 hectares of land in the Mithilanchal region of Bihar. Mining sector reforms. Mining sector reforms, including those for minor minerals, will be encouraged through sharing of best practices and institutions of a state mining index. A policy for recovery of critical minerals from tailings will be brought out. Under the special window for affordable and mid-income housing, SWAMI, 50,000 dwelling units in stressed housing projects have been completed and keys handed over to home buyers. Another 40,000 units will be completed in 2025, further helping middle-class families who were paying EMIs on loans taken for apartments while also paying rent for their current dwellings. Building on this success, SWAMI Fund 2 will be established as a blended finance facility with contribution from the government, banks and private investors. This fund of 15,000 crore rupees will aim for expeditious completion of another 1 lakh units. PM Gati Shakti data for private sector. For furthering PPPs and assisting the private sector in project planning, access to relevant data and maps from the PM Gati Shakti portal will be provided. Tourism for employment-led growth. Top 50 tourist destination sites in the country will be developed in partnership with states through a challenge mode. Land for building key infrastructure will have to be provided by the states. Hotels in these destinations will be included in the infrastructure harmonized list. The following measures will be taken for facilitating employment-led growth. Organizing intensive skill development programs for our youth, including in institutes of hospitality management. Providing mudra loans for homestays. Improving ease of travel and connectivity to tourist destinations. Providing performance-linked incentives to states for effective destination management, including tourist amenities, cleanliness, and marketing efforts. And introducing streamlined e-visa facilities along with visa fee waivers for certain tourist groups. Continuing with the emphasis on places of spiritual and religious significance in the July budget, there will be a special focus on destinations related to the life and times of Lord Buddha. Medical tourism and heal in India. Medical tourism and heal in India will be promoted in partnership with the private sector along with capacity building and easier visa norms. Investing in innovation. To implement private sector driven research Development and Innovation initiatives announced in the July budget, I am now allocating 20,000 crore rupees for this purpose. A deep tech fund of funds will also be explored to catalyze the next generation startups as a part of this initiative. In the next 5 years, under the PM Research Fellowship Scheme, we will provide 10,000 fellowships for technological research in IITs and IISc with enhanced financial support. The second gene bank with 10 lakh germplasm lines will be set up for future food and nutritional security. This will provide conservation support to both public and private sectors for genetic resources. We will start a national geospatial mission to develop foundational geospatial infrastructure and data. Using PM Gati Shakti, this mission will facilitate modernization of land records, urban planning, and design of infrastructure projects. A Gyan Bharatam mission for survey, documentation, and conservation of our manuscript heritage with academic institutions, museums, libraries, and private collectors will be undertaken to cover more than 1 crore manuscripts. We will set up a national digital repository of Indian knowledge systems for knowledge sharing. Now I move to exports as the fourth engine. We will set up an export promotion mission with sectoral and ministerial targets driven jointly by the Ministries of Commerce, MSME, and Finance. It will facilitate easy access to export credit, cross-border factoring support, support to MSMEs to tackle non-tariff measures in overseas markets. A digital public infrastructure, Bharat Trade Net, for international trade will be set up as a unified platform for trade documentation and financing solutions. This will complement the Unified Logistics Interface platform. The BTN will be aligned with international practices. Support will be provided to develop domestic manufacturing capacities for our economy's integration with global supply chains. Sectors will be identified based on objective criteria. Facilitation groups with participation of senior officers and industry representatives will be formed for select products and supply chains. Through this, there are huge opportunities related to Industry 4.0, which needs high skills and talent. Our youth have both. Our government will support the domestic electronic equipment industry to leverage this opportunity for the benefit of our youth. A national framework will be formulated as guidance to states for promoting global capability centers in emerging Tier 2 cities. This will suggest measures for enhancing availability of talent and infrastructure, building bylaw reforms, and mechanisms for collaboration with industry. Our government will facilitate upgradation of infrastructure and warehousing for air cargo, including high-value perishable horticultural produce. Cargo screening and customs protocol will be streamlined and made user-friendly. Reforms as the fuel. Over the past 10 years, our government has implemented several reforms for convenience of taxpayers, such as faceless assessment, 2, taxpayer charter, 3, faster returns, 4, almost 99% returns being on self-assessment, and 5, Vivad Se Vishwas scheme. Continuing these efforts, I reaffirm the commitment of the tax department to trust first, scrutinized later. I also propose to introduce the new income tax bill next week. I will detail the indirect tax reforms and changes in direct taxes in Part B. Financial sector reforms. The FDI limit for the insurance sector will be raised from 74 to 100%. This enhanced limit will be available for those companies which invest the entire premium in India. The current guardrails and conditionalities associated with foreign investment will be reviewed and simplified. The services of India Post Payment Bank will be deepened and expanded in rural areas. NABFID will set up a partial credit enhancement facility for corporate bonds for infrastructure. Public sector banks will develop Grameen Credit Score framework to serve the credit needs of SHG members and people in rural areas. A forum for regulatory coordination and development of pension products will be set up. To implement the earlier announcement on simplifying the KYC processes, the revamped Central KYC Registry will be rolled out in 2025. We will also implement a streamlined system for periodic updating. Requirements and procedures for speedy approval of company mergers will be rationalized. The scope for fast-track mergers will also be widened and the process made simpler. As proposed in the interim budget, we signed bilateral investment treaties with 2 countries in 2024 to encourage sustained foreign investment, and in the spirit of First Develop India, the current model BIT will be revamped and made more investor-friendly. In the last 10 years, in several aspects, including financial and non-financial, our government has demonstrated a steadfast commitment to ease of doing business. We are determined to ensure that our regulations must keep up with technological innovations and global policy developments. A light touch regulatory framework based on principles and trust will unleash productivity and employment. Through this framework, we will update regulations that were made under old laws. To develop this modern, flexible, people-friendly, and trust-based regulatory framework appropriate for the 21st century, I propose 4 specific measures. A high-level committee for regulatory reforms will be set up for a review of all non-financial sector regulations, certifications, licenses, and permissions. The committee will be expected to make recommendations within a year. The objective is to strengthen trust-based economic governance and take transformational measures to enhance ease of doing business, especially in matters of inspection and compliances. States will be encouraged to join in this endeavor. An investment friendliness index of states will be launched in 2025 to further the spirit of competitive, cooperative federalism. Under the Financial Stability and Development Council, a mechanism will be set up to evaluate impact of the current financial regulations and subsidiary instructions. It will also formulate a framework to enhance their responsiveness and development of the financial sector. In the Jan Vishwas Act 2023, more than 180 legal provisions were decriminalized. Our government will now bring up the Jan Vishwas Bill 2.0 to decriminalize more than 100 provisions in various laws. I now move to fiscal policy. In the July budget, I had committed to staying the course for fiscal consolidation. Our endeavor will be to keep the fiscal deficit each year such that that central government debt remains on a declining path as a percentage of the GDP. The roadmap for the next 6 years has been detailed in the FRBM statement. Revised estimates for 2024-25. The revised estimate of the total receipts other than borrowings is 31.47 lakh crore rupees, of which the net tax receipts are 25.57 lakh crore rupees. The revised estimate of the total expenditure is 47.16 lakh crore rupees, of which the capital expenditure is about 10.18 lakh crore rupees. The revised estimate of the fiscal deficit is 4.8% of the GDP. Budget estimates for 25-26. Coming to 25-26, the total receipts other than borrowings and total expenditure are estimated at 34.96 lakh crore rupees and 50.65 lakh crore rupees respectively. The net tax receipts are estimated at 28.37 lakh crore rupees. The fiscal deficit is estimated to be 4.4% of GDP. To finance the fiscal deficit, the net market borrowings from dated securities are estimated at 11.54 lakh crore. The balance financing is expected to come from small savings and other sources. The gross market borrowings are estimated at 14.82 lakh crore rupees. I will now move to Part B. Indirect taxes. My proposals relating to customs aim to rationalize tariff structure and address duty inversion. These will also support domestic manufacturing and value addition, promote exports, facilitate trade, and provide relief to common people. Rationalization of customs tariff structure for industrial goods. As a part of comprehensive review of customs rate structure announced in July 2024 budget, I propose to 1. Remove 7 tariff rates. This is over and above the 7 tariff rates removed in 23-24 budget. After this, there will be only 8 remaining tariff rates, including 0 rate. 2. Apply appropriate cess to broadly maintain effective duty incidence, except on a few items where such incidence will reduce marginally. 3. Levy not more than 1 cess or surcharge. Therefore, I propose to exempt social welfare surcharge on 82 tariff lines that are subject to a cess. I shall now take up sector-specific proposals. To provide relief to patients, particularly those suffering from cancer, rare diseases, and other severe chronic diseases, I propose to add 36 life-saving drugs and medicines to the list of medicines fully exempted from basic custom duty. I also propose to add 6 life-saving medicines to the list attracting concessional custom duty of 5%. Full exemption and concessional duty will also respectively apply on the bulk drugs for manufacture of the above. Specified drugs and medicines under patient assistance programs run by the pharmaceutical companies are fully exempt from BCD, provided the medicines are supplied free of cost to the patients. I propose to add 37 more medicines along with 13 new patient assistance programs. Support to domestic manufacturing and value addition. Critical minerals. In the July 2024 budget, I had fully exempted BCD on 25 critical minerals that are not domestically available. I had also reduced BCD of 2 other such minerals to provide a major fillip to their processing especially by MSMEs. Now, I propose to fully exempt cobalt powder and waste, the scrap of lithium-ion battery, lead, zinc, and 12 more critical minerals. This will help secure the availability for manufacturing in India and promote more jobs for our youth. To promote domestic production of technical textile products such as agro-textiles, medical textiles, and geotextiles at competitive prices, I propose to add 2 more types of shuttle-less looms to the list of fully exempted textile machinery. I also propose to revise the BCD rate on knitted fabrics covered by 9 tariff lines from 10 or 20 to 20% or 115 rupees per kg, whichever is higher. Electronic goods. In line with our Make in India policy and to rectify inverted duty structure, I propose to increase the BCD on interactive flat panel display from 10% to 20% and reduce the BCD to 5% on open cell and other components. In 23-24 budget, for the manufacture of open cells of LCD, LED TVs, I had reduced the BCD on parts of open cells from 5% to 2.5%. To further boost the manufacture of such open cells, the BCD on these parts will now stand exempted. Lithium-ion battery. To the list of exempted capital goods, I propose to add 35 additional capital goods for EV battery manufacturing and 28 additional capital goods for mobile phone battery manufacturing. This will boost domestic manufacture of lithium-ion batteries, both for mobile phones and for electric vehicles. Shipping sector. Considering that shipbuilding has a long gestation period, I propose to continue the exemption of BCD on raw materials, components, consumables, or parts for the manufacture of ships for another 10 years. I also propose the same dispensation for shipbreaking to make it more competitive. Telecommunication. To prevent classification disputes, I propose to reduce the BCD from 20% to 10% on carrier-grade Ethernet switches to make it at par with non-carrier-grade Ethernet switches. Export promotion. To facilitate exports of handicrafts, I propose to extend the time period for export from 6 months to 1 year, further extendable by another 3 months if required. I also propose to add 9 items to the list of duty-free inputs. Leather sector. I propose to fully exempt BCD on wet blue leather to facilitate imports for domestic value addition and employment. I also propose to exempt crust leather from 20% export duty to facilitate exports by small tanners. Marine products. To enhance India's competitiveness in the global seafood market, I propose to reduce BCD from 30% to 5% on frozen fish paste, surimi, for manufacture and export of its analog products. I also propose to reduce BCD from 15% to 5% on fish hydrolysates for manufacture of fish and shrimp feed. In July 2024 budget, to promote development of domestic MROs for aircraft and ships, I had extended the time limit for export of foreign origin goods that were imported for repairs from 6 months to 1 year and further extendable by 1 year. I now propose to extend the same dispensation for railway goods. Time limit for provisional assessment. Presently, the Customs Act 1962 does not provide any time limit to finalize provisional assessments, leading to uncertainty and cost to trade. As a measure of promoting ease of doing business, I propose to fix a time limit of 2 years, extendable by a year, for finalizing the provisional assessment. I propose to introduce a new provision that will enable importers or exporters, after clearance of goods, to voluntarily declare material facts and pay duty with interest but without penalty. This will incentivize voluntary compliance. However, this will not apply in cases where department has already initiated audit or investigation proceedings. For industry to better plan their imports, I propose to extend the time limit for the end use of imported inputs in the relevant rules from 6 months to 1 year. This will provide operational flexibility in view of cost and uncertainty of supply. Further, such importers will now have to file only quarterly statements instead of a monthly statement. I now come to my direct tax proposals. In Part A, I have briefly underlined taxation reforms as one of key reforms to realize our vision of Vikasit Bharat. In respect of criminal law, our government had earlier ushered in Bharatiya Nyaya Sanhita, replacing Bharatiya Danda Sanhita. I am happy to inform this august House and the country that for new income tax bill will carry forward the same spirit of Nyaya in its drafting as well. The new bill will be clear and direct in text, with close to half of the present law in terms of both chapters and words. It will be simple to understand for taxpayers and tax administrators, leading to tax certainty and reduced litigation. Reforms, however, are not a destination. They are means to achieve good governance for our people and economy. Providing good governance primarily involves being responsive. The Tirukural captures this in verse 542, which reads, "Vaanokki vaazhum ulagallam, mannavan kol nokki vaazhum kudi," meaning, just as the living beings live expecting rains, citizens live expecting good governance. Our government is committed to keeping an ear to the ground and a finger on the pulse and responding while balancing our national building efforts. The following measures will detail just how our government will, under the guidance of PM Modi, has taken steps to understand and address. I repeat that sentence, sir. The following measures will detail just how our government, under the guidance of PM Modi, has taken steps to understand and address the needs voiced by our citizens. My tax proposals are guided by this spirit. The objectives of my proposals are as follows. Personal income tax reforms with special focus on middle class. Rationalization of TDS and TCS for easing difficulties. Encouraging voluntary compliance. Reducing compliance burden. Ease of doing business. Employment and investment. I will come to my proposal on personal income tax towards the end. TDS and TCS, rationalization for easing difficulties. I propose to rationalize tax deduction at source, TDS, by reducing the number of rates and thresholds above which TDS is deducted. Further, threshold amounts for tax deduction will be increased for better clarity and uniformity. The limit for tax deduction on interest for senior citizens is being doubled from the present 50,000 rupees to 1 lakh rupees. Similarly, the annual limit of 2.40 lakh rupees for TDS on rent is being increased to 6 lakh rupees. This will reduce the number of transactions liable to TDS, thus benefiting small taxpayers receiving small payments. The threshold to collect tax at source, the TCS, on remittances under RBI's liberalized remittance scheme, the LRS, is proposed to be increased from 7 lakh to 10 lakhs. I also propose to remove TCS on remittances for education purposes, where such remittances is out of a loan taken from a specified financial institution. Both TDS and TCS are being applied on any transaction related to sale of goods. To prevent such compliance difficulties, I propose to omit the TCS. I also propose that the provisions of the higher TDS deduction will now apply only in non-PAN cases. In July 2024, the delay for payment of TDS up to the due date of filing statement was decriminalized. I propose to provide the same relaxation to TCS provisions as well. The government under the leadership of Prime Minister Modi believes in Sabka Saath, Sabka Vikas, Sabka Vishwas and Sabka Prayas. In line with this, we brought in updated return facility in 2022 for voluntary compliance by taxpayers who had omitted to report their correct income. Our trust in taxpayers was proved right. Nearly 90 lakh taxpayers voluntarily updated their incomes by paying additional tax. Taking this trust further, I now propose to extend the time limit to file updated returns for any assessment year from the current limit of 2 years to 4 years. I propose to reduce the compliance burden for small charitable trusts and institutions by increasing their period of registration from 5 years to 10 years. It is also proposed that disproportionate consequences do not arise for minor defaults such as incomplete applications filed by charitable entities. Presently, taxpayers can claim the annual value of self-occupied properties as nil only on the fulfillment of certain conditions. Considering the difficulties faced by taxpayers, it is proposed to allow the benefit of 2 such self-occupied properties without any condition. To streamline the process of transfer pricing and to provide an alternative to yearly examination, I propose to introduce a scheme for determining arm's length price of international transaction for a block period of 3 years. This will be in line with global best practices. With a view to reduce litigation and provide certainty in international taxation, the scope of safe harbor rules is being expanded. A number of senior and very senior citizens have very old national savings schemes accounts. As interest is no longer payable on such accounts, I propose to exempt withdrawals made from NSS by individuals on or after 29th August 2024. I am also proposing to allow similar treatment to NPS Vatsalya accounts as is available to normal NPS accounts subject to overall limits. In my speech in July 2024, I had promised that all processes, including giving effect to appellate orders, shall be digitalized and made paperless over the next 2 years. So I'm happy to announce that digitalization is being made operational now. In July 2024, we brought in the Vivad Se Vishwas scheme to resolve income tax disputes pending in appeal. The scheme has received a great response, with nearly 33,000 taxpayers having availed of the scheme to settle their disputes. I have a few proposals to promote investment and employment. It is proposed to provide a presumptive taxation regime for non-residents who provide services to a resident company that is establishing or operating an electronics manufacturing facility. I further propose to introduce a safe harbor for tax certainty for non-residents who store components for supply to specified electronics manufacturing units. Presently, the tonnage tax scheme is available only to sea-going ships. The benefits of existing tonnage tax scheme are proposed to be extended to inland vessels registered under the Indian Vessels Act 2021 to promote inland water transport in the country. Extension for incorporation of startups. We continue to support the Indian startup ecosystem. I propose to extend the period of incorporation by 5 years to allow the benefit available to startups which are incorporated before 1/4/2030. In order to attract and promote additional activities in the IFSC, I am inter alia proposing specific benefits to ship leasing units, insurance offices, and treasury centers of global companies which are set up in IFSC. Further, to claim benefits, the cut-off date for commencement in IFSC has also been extended by 5 years to 31/3/2030. Category 1 and Category 2 AIFs are undertaking investments in infrastructure and other such sectors. I propose to provide certainty of taxation to these entities on the gains from securities, to promote funding from sovereign wealth funds and pension funds to the infrastructure sector. I propose to extend the date of making an investment by 5 more years up to 31st March 2030. Personal income tax reforms with special focus on middle class. Democracy, demography, and demand are the key support pillars in our journey towards Vikasit Bharat. The middle class provides strength for India's growth. This government, under the leadership of Prime Minister Modi, has always believed in the admirable energy and ability of the middle class in nation building. In recognition of their contribution, we have periodically reduced their tax burden. Right after 2014, the nil tax slab was raised to 2.5 lakhs of rupees, which was further raised to 5 lakh rupees in 2019 and to 7 lakh rupees in 2023. This is reflective of our government's trust on the middle class taxpayers. I am now happy to announce that there will be no income tax payable up to income of 12 lakh rupees. So, average income of 1 lakh per month other than the special rate income such as capital gains under the new regime. This limit will be 12.75 lakh for salaried taxpayers due to the standard deduction of 75,000. Slabs and rates are being changed across the board to benefit all taxpayers. The new structure will substantially reduce the taxes of the middle class and leave more money in their hands, boosting household consumption, savings, and investment. In the new tax regime, I propose to revise tax rate structures as follows. 0 to 4 lakh rupees nil, 4.8 lakh rupees to 4 to 8 lakh rupees 5%, 8 to 12 lakh rupees 10%, 12 to 16 lakh rupees 15%, 16 to 20 lakh rupees 20%, 20 to 24 lakh rupees 25%, and above 24 lakh rupees 30%. To taxpayers up to 12 lakh of normal income other than special rate income such as capital gains. I read that again. To taxpayers up to 12 lakh of income other than special rate income such as capital gains, tax rebate is being provided in addition to the benefit due to slab rate reduction in such a manner that there is no tax payable by them. The total tax benefit of slab rate changes and rebate at different income levels can be illustrated with a few examples. A taxpayer in the new regime with an income of 12 lakh rupees will get a benefit of 80,000 rupees in tax, which is 100% of tax payable as per the existing rates. A person having income of 18 lakh rupees will get a benefit of 70,000 rupees in tax, that is 30% of tax payable as per existing rates. A person with an income of 25 lakh gets a benefit of 1,10,000 rupees, that is 25% of his tax payable as per existing rates. Details of my tax proposals are given in the annexure. As a result of these proposals, Honorable Speaker, sir, revenue of about 1 lakh crore in direct taxes and 2,600 crores in indirect taxes will be foregone. Mr. Speaker, sir, with this, I commend the budget to this august House.
Item number 2, Srimati Nirmala Sitharaman.
Sir, with your permission, I rise to lay on the table the following statements under Section 3(1) of the Fiscal Responsibility and Budget Management Act 2003. Medium-term fiscal policy cum fiscal policy strategy statement and macroeconomic framework statement.
Item number 3, Srimati Nirmala Sitharaman.
Sir, with your permission, I rise to move for leave to introduce the Finance Bill 2025.
प्रश्न ये है कि विधेयक को पुनर्स्थापित करने की अनुमति प्रदान की जाए। जो सदस्य इसके पक्ष में हाँ कहें, जो सदस्य विरोध में ना कहें। मेरे विचार में निर्णय हाँ वालों के पक्ष में हुआ, हाँ वालों के पक्ष में अनुमति प्रदान की जाती है। माननीय मंत्री जी अब विधेयक को पुनर्स्थापित करें।
Sir, I introduce the bill.
थैंक यू। सभा की कार्रवाई सोमवार दिनांक 3 फरवरी 2025 को प्राप्त 11 बजे तक के लिए स्थगित की जाती है। सभा की कार्रवाई 2025 को
launched in partnership with the states. This will address underemployment in agriculture through skilling, investment, technology, and invigorating the rural economy. The goal is to generate ample opportunities in rural areas so that migration is an option but not a necessity. The program will focus on rural women, young farmers, rural youth, marginal and small farmers, and landless families.
And best. All right, the budget 2025 has been tabled. The loudest cheers have gone in on the tax relief that has come in. No income tax payable up to 12 lakh rupees. That's the big headline coming out of budget 2025. Those along with several other measures that have kicked in. But at this point on Money Control, let's take a quick look at how the markets are actually faring at this point and what their reaction to this budget 2025 is all about. Let's cut across to Nandita for the latest.
So yes, a tax cut that was kind of cheered by the market as well, because capex for FY25 has been revised lower. That's something the market didn't like. From 11.11 lakh crores to come down to 10.1 lakh crores, which is when we saw a huge reaction coming in on the market. We shake off to 250 points on the daily high. In fact, fell below that 23,600 mark as well at one point. Right now we're seeing the trend, but it's marginal now. We have recovered, lost ground. That was happened after the.
All right, we'll just fix that audio with Nandita in a minute and go back to her. For the moment, the big breaking news at this point, the big takeaway from budget 2025 is the income tax exemption limits. We'll put that graphic up on the screen for everybody to sort of review at the moment. Let's take a look at those exemptions again. From 2005 to 2025, if you look at the exemptions that have been given in, it's gone from 1 lakh, 2 lakh to almost 12 lakhs now in 2025. That is the big booster shot to middle class that has come in with budget 2025. Remember, going into this budget, the one big thing that everybody was asking was relief. Has that been granted with this budget? Like I said, loud cheers were heard here in the newsroom and across as well on social media as we hear that. We are just about an hour and 20 minutes of budget speech that we heard from the Prime Minister, some of the key, from the Finance Minister, some of the key takeaways on your screen right now, and those are what the numbers are really looking like. Let's try and see if we can get a quick response again and see how the markets are faring at this point. Let's see if we have Nandita. Nandita, yeah?
Yeah, I'm back. So yes, as I'm saying that the Mahalakshmi has clearly blessed us in terms of personal taxes. No income tax up till 12 lakh rupees, and that is something that cheered the market, because we did slip into the red, and we shaved the wild swings. We saw wild swings during the speech. Once the capex target was revised lower, the markets took it on the chin. We in fact shaved off 300 points from the day's high. In fact, the Nifty fell below that 23,300 mark as well. But announcement on personal taxes, something that cheered the market, and we came off from the day's low. All the capex heavy stocks like Ultratech Cement, L&T, these are all losing at the current juncture. Bharat Electronics, if you look at these stocks, even power stocks for that matter, Coal India, Power Grid, and the oil and gas stocks, ONGC, BPCL, these are all trending lower, given the fact that the government has revised its capex target lower for FY25. What's doing well? You guessed it right. All the consumption stocks have got a boost after the announcement on personal taxes. So Maruti Suzuki 6% up for that matter. Trent, ITC, Britannia, Bajaj Auto, HUL, all these consumption stocks are gaining to the tune of 6 to 7% apiece. So that's the kind of reaction that's coming in on the market. Mid cap index in the green right now. We are off the day's low. We saw wild swings, but let's understand and get a battery of guests to understand all the announcements that were made in the budget. For that, let me cut back to Mahalakshmi. Mahalakshmi, take it over.
Before we go to the battery of guests, one correction. The Finance Minister did not mention the revised, the budget estimates for capital expenditure for FY26 in her speech. She only talked about the revised numbers for FY25, which stood at 10.1, which is pretty much what the market was expecting. That's what we closed this year with. The number for FY26 budgeted estimate is still not out. We have to wait for the budget document to see that. So I'm really clueless about why has the market really took it so badly. But the good news in the end was, of course, the tax breaks, which largely people were expecting but were not sure whether will happen or not. Back to you, Nandita.
Thanks, Mahalakshmi. Yes, when I did point out that the capex figure has been revised lower, it was for FY25. Yes, but the markets did react quite negatively to that. Of course, we will wait for the fine print and see how things pan out for FY26 as well.
Yeah.
But in terms of other announcements and reactions on stock prices, insurance FDI has been hiked to 100% from 74%, which is why we saw positive reaction on stocks SBI Life as well, and there was a lot of push towards agriculture, which bode well for stocks like Kaveri Seeds, Godrej Agrovet, Bayer Corp. You had fertilizer stocks as well gaining because government is going to set up urea plant of 1.27 lakh tons capacity, and which is what cheered stocks like Madras Fertilizer, Paradip Phosphates, Fact as well. Footwear stocks got a fillip. We saw Bata, Relaxo, all these stocks rallying in trade. Scheme for footwear and leather will generate investment to the tune of 4 lakh crore rupees. So, which is what got the footwear stocks going in trade. There were measures to boost shipbuilding as well, which is why we saw reactions on stocks like Shipping Corp, SR Shipping, and the Jal Jeevan mission has been extended to 2028. Stocks like Viatech, Wabag, Shakti Pipes, got a fillip, and we saw strong gains coming in there. There has been a push for affordable housing as well. The Swami, which is why stocks like Aadhar Housing, Aptus Value, HFC, even the entire realty pack in fact managed to do well. But in terms of what the market is doing at the current juncture, as I said, wild swings. Right now we are in the positive zone. The bank nifty is trading in the red, but yes, we are off the day's low, and of course once the fine print comes, we will get more reactions, and we will see how markets really react to that. But with that, I think back to Sonal and will impact all of us.
It's been quite firecracker for budget. Lots to decode on what is happening. Nandita, stay back with us. I want to come back to you and see how consumption, or essentially putting money back in the pockets of the middle class, will actually do, and which sectors will see an upswing there. So while you prep up on that, let me just also welcome in Bodhi Satsangangli in the studios. Bodhi, what a budget. She saved the best for the last.
I know.
And right in the end gave in that big booster. Your first thoughts?
No, so the highlight of the budget is clearly the personal tax under the new income tax regime.
Yes.
Just to be clear. So basically, if you if up to 12 lakhs you don't pay any tax at all, I think it's 12.75 if you include the standard deduction, and the 30% tax rate kicks in above 24 lakhs. So that's significant because under the new income tax regime, the 30% tax kicked in above 15 lakh. That's a big. So there is a lot of money for those who are opted for the new income tax regime. However, I think you should consult, if you're still under the old income tax regime, you should consult your CA because of the housing loan, the 2 lakh interest and also health insurance and things like that, or even the rental. So you need to consult your CA for that. So don't, but that's really the big kicker. I don't know what has happened to consumption stocks though in the last few minutes. Have they moved?
I actually wanted to go back to Nandita and sort of get in a quick jump on that. So when stuff like this happens, Nandita, like I said, consumption, which was a big expectation, urban consumption, largely the big expectation, which is falling short. If this is a measure intended towards that direction, which sectors are we seeing and how are they reacting?
So, right, we are seeing autos doing well, FMCG, which have seen volume decline, not exactly decline, volume slowing down in their quarterly earnings. We've seen biggies like HUL say that volumes are under pressure. We've seen flat growth in volumes because people are buying less soaps, less detergents, that's where the pain was, which is what the, I think, finance minister has looked at, plugging the hole, and which is why we are seeing stocks from auto sector doing well, FMCG doing well, retail stocks like Trent for that matter, among top gainers 5%. So that will, more money in the hands of consumer will, encourage them to plug that hole and perhaps go and buy more of these cars and, dresses, the lower end dresses, FMCG products, etc. Looking at the top gainers, Trent, that stock is up 5%, Maruti, Hindustan Unilever, Britannia, ITC, Tata Consumer, Bajaj Auto, all these auto, FMCG and retail names are the ones that are reacting.
All right, can we look at some big stocks then, Anita, for a minute? Stocks that we've been tracking before the budget as well, ITC, Nestle, the rest of them, and see how quickly they are really doing at this point. And let's go sector by sector. Yeah.
Yeah, so HUL is leading when it comes to the FMCG pack, followed by ITC, Britannia, even Nestle for that matter is among the gainers when it comes to the FMCG pack. Looking at the auto pack, you have Maruti, Bajaj Auto, Hero Moto that was in the red for a greater part of the day because there has been a CEO management change as well there, a top level management exit. It was reacting to that, but now it has also turned back into the green and it's gaining somewhere around 2% or so. From the retail names, as I mentioned, Trent is doing well. Tata Consumer is another one that's doing well right now. So that's about the consumption. Even paint stocks are doing well as of now. Asian Paints, that's kind of holding out. But the trend is, you can't really establish a trend in the market right now because we are flitting between gains and losses. I think once the budget fine print comes out later, that's when we will see a proper trend emerging. Right now we are off the day's lows, but still in the red.
In the order of gainers, it's very clear. Actually, staples are the biggest gainers, 4% up. In fact, 3.39% up as we speak. Consumption is 2.37% up. Consumer durables is the next, which is all these white goods, etc. Then autos. So it seems like the market is expecting that the rural demand will have rural semi-urban will have a lower effect, but autos will be even slower. But the top gainer is staples and
what about agri?
Two-wheelers also is around.
Yeah. What about agri stocks?
Agri stocks, agri
stocks are a mixed bag.
Agri stocks actually, there is a big push for agriculture sector. Government will be launching a 6-year mission for Atmanirbharta in pulses. So you have Kaveri Seeds, Godrej Agrovet, Bayer Crop. These are some of the agriculture centric stocks that are doing well. Even fertilizer stocks, because government will be setting up a urea plant. Of 1.3 lakh tons capacity. All these fertilizer stocks like Madras Fertilizer, Paradeep Phosphates, footwear, there was a push for that as well. Bata, Relax, so these are doing well. Even for solar battery system, there was government will be aiming to create an ecosystem for solar PV cells and electrolyzers. Because of that, you've seen stocks like Borosil Renewables, Amara Raja doing well. So these are some of the stocks that are doing well right now.
Another important thing to note in today's trade is banks. I mean, she announced fiscal deficit at 4.4% for next year, and yet banks are sulking. Private sector banks, large and nifty private banks is down a tad. Similarly, PSU banks down nearly 1% today. Financial services down 0.5%.
So why are they sulking?
So gross borrowing figure is also going up 5.5%. I think that will have a bearing on the bond.
That's again largely on expected lines, Bodhi. I don't think the deficit or the borrowing number is something
4.5 was expected. It's 4.4. I think the bigger takeaway, why the market started falling the moment the capex number for this year, the 24-25 capex number was not going to be met, and the 25-26, which just remind me what it is. But it is
25-26 numbers she didn't state.
It was not announced. That's right. So that is when the market started falling, because it is capex which has been holding growth rates aloft. So that that's really when the market started falling. Then they rose briefly after the income tax cuts, but now again are slightly down.
But all these capex heavy stocks really have taken it on the chin.
So see, there is a positive way and a negative way of looking at it. The positive way is really that it will help those whose salaries are comparatively less in a comparative sense, which includes possibly the majority of employees in the organized sector, including in corporates. But those earning about 8 lakhs, 10 lakhs, if you go by the eco survey, which lambasts companies for paying less while their profits are going up, IT employees, entry level IT employees. But the thing which the market perhaps is apprehensive about is the capex not being met, and not exactly clear. We'll get in the fine print what the capex for next year is. Government capex has been very important for boosting growth, so it can be interpreted as some kind of an emphasis on giveaways, quote unquote, and de-emphasis on capex. I mean, that is one way of reading it.
Can I also draw everybody's attention to another sector which found quite a significant focus in her speech, health. She has spoken in detail about cancer medicines being custom duty free. She talked about medical tourism and heal in India. She also spoke about some 75 seats to be added to medical colleges, daycare centers, etc. to be put up. Any quick look at health and then see how
I'll
those
just
are
have
faring as well?
I'll just need some 5 minutes.
By the time Nandita comes back, Vikas Kimani and Pankaj Tibrewal join us. Your first thoughts, Vikas?
Pankaj is with us. Pankaj Tibrewal, thank you so much for tuning in. First reactions to Budget 2025. It's been quite a booster.
Yes, I think clearly the sentiment change is being seen and the priority is being seen towards boosting the middle class. And I believe after 4 years, from a market perspective also, we may move from infra-led growth to maybe consumption-led growth, which has not been there. And I think clearly this tax regime, and it's a significant boost that above 24 lakhs, it's 30%. So till 24 lakhs, it's a significant boost, and up to 12 lakh, there's nothing. And back of the envelope calculation suggests that it's approximately 75 to 80,000 rupees per household, per person on an annualized basis. So I think clearly full marks to the government in terms of doing this on the consumption side, which was much needed. On the expenditure side, our ballpark calculation suggests that the revised number is 10.1 lakh crores for this fiscal year and 11.2 lakh crores, which means a growth of 10% on the revised numbers on the capex side, which is not bad. But I think the highlight of the budget is the personal income tax slab readjustment on the new tax regime, and it will lead to a smooth movement from the old tax regime to the new tax regime.
I see, ML.
We have Rashesh Shah joining us. Good afternoon, Rashesh. Your first thoughts on the budget?
Hello?
Rashesh, can you hear me?
Yes, I can hear you.
The budget. Your first thoughts on the budget?
I think it's a conservative budget, more keeping the fiscal path on track. I think a lot of people were expecting a bold, aggressive budget. I think the FM has decided to keep it conservative. But at the same time, I think the announcement about the new income tax code is a very good one. It's long awaited. The relief for the middle class of no tax up to 12 lakhs is good. I mean, for people like us, 100% FDI in insurance is also a great, announcement, because this will really boost investments in insurance and make the insurance sector also grow with the capital that will be available. So I think some good stuff. I think we were expecting a 7 to 7.5% growth target for the next year in the real terms, and maybe 11 plus for nominal. I think the nominal GDP of 10.1 is slightly more conservative, and I'm hoping that actual nominal growth is higher than that. So, and again, I think we are all constantly grappling with how to boost capex and how to boost consumption. I think some of the middle class relief should boost consumption, but I think the more important one is going to be the RBI monetary policy in a week's time, because I think you were speaking earlier about banks, because a large part of the bank's earnings is not going to be impacted by the announcement in this particular budget, but will be impacted by the RBI policy a week down the line.
All right.
Rashesh, do you see these measures essentially spurring private investment? One aspect is that, we might see some uptick in demand because of these slab changes and the income tax relief. But do you see that as adequate enough to spur private investments?
Private investment is going to be spurred only when consumption grows and the capacity utilization moves consistently close to 80%. We have for the last 5 years hovered between 74-75% capacity utilization, and because of the recent slowdown in demand and all, we are still stuck around that. Private capex will follow demand. Private capex will follow capacity utilization. It will not follow any announcements at all. So I think my expectation is for the first half of this year will still be dependent on government capex. Government capex has been the main driver for the last few years. Government and the PSU entities. I think that will still be for the next 5-6 months at least be the key driver. With the reduction in taxes for the middle class, if that drives consumption up and some reversal to growth comes back, I think then the private capex will go up. Also remember, I think the international markets is going to be very, very volatile. Trade is going to be very volatile. All the tariff issues and all is also going to keep exports also very uncertain. So given that, I think first half government will be the key driver. The private capex will only follow after that.
I see. Pankaj Tibriwal is also with us. Pankaj, if you can hear me. So, anybody looking at this budget right now, middle class, definition of middle class is debatable at this point, but anybody looking at this budget as a booster and looking at it as a tax relief would be wondering why, despite that, markets are so volatile. If you could take us through where you are seeing that?
Clearly, this year has not been that great on the capex side, and that has led to the slowdown. Going into the budget, the expectation was a 15 to 20% kind of a growth over a revised estimate, which is about 10.18 lakh crores for the fiscal year 26. This number has come at about 11.2 lakh crores, which is the July number, if you look at plus minus few thousand crores. So I think that has been a bit of a dampener in terms of sentiment. That can we can be in a low growth environment for some time now till the private sector capex picks up. But the other flip side is that consumption, which was also not doing well for the last 4-5 years, I think it's a significant boost to the household income. And I think that's the only point of joy. Otherwise, the capex numbers are still there. And also, the finance minister clearly, again, was hawkish on the fiscal side. The revised estimate is 4.8. She talked about 4.4 for next year, which is another 40 basis points of fiscal consolidation. Markets were expecting some relaxation on fiscal side to get a boost to a slowing economy. I think, as Rashesh also mentioned, I think next the ball is in the monetary side. I think we can do substantially there. On 6th of Feb, when the credit policy is there, any interest rate reduction can be a further boost from an economic perspective. And we believe that there's a lot of monetary room as you move ahead into this next 12 months. So clearly, I think markets were expecting fiscal and monetary. Fiscal didn't that much happen, especially on the corporate side. So I think that's where the markets are slightly disappointed on the overall capex numbers.
Pankaj, which part of the consumer space would you bet on right now? Consumer staples or discretionary, or all these assorted consumption names like Nykaa, Zomato, which are different also because of the kind of business models they have?
So clearly, we believe that consumer discretionary has further legs in terms of growth over the next few years. As the per capita income of India increases, roti, kapda, makan, the basics gets, addressed, and better, good, higher restaurants, better fashionable brands in terms of clothing and bigger houses becomes more aspirational. And a lot of discretionary part of India, I think we have significant headroom to grow. And I think that's where our choice would be in terms of discretion. That's what market is also reflecting right now. And if interest rates also gets reduced over the next 6 months, I think one significant boost on the EMI side. Don't forget, 5 years back, total EMI of consumer loans across housing, jewelry, credit card was about, in our estimate, 19 lakh crores. This year, we will end at about 42 lakh crores, which is double of what we have seen, but the incomes have not gone to the same extent. So I think there is a significant EMI burden in the household leverage. Any reduction on the interest rates on that side will help boost the consumption as well. So our preference will lie on the slightly lower end of the pyramid, the second half of India, the middle half of India. And I think there a lot of good, interesting names are available.
Sure. One question for you, Rashesh. This fiscal prudence, I mean, this finance minister has been absolutely, sticking to the fiscal path that she defined. In fact, she's beaten expectations by bringing it down to 4.4% for next year. And all of this, I guess, in aid of getting a rating upgrade. Do you see that coming this year? Rashesh?
So I think all this is part of that. I think the fiscal prudence is actually keeping in mind the bond investors. Equity investors like growth, bond investors like fiscal prudence. So, I mean, every time there is a monetary loosening, equity investors are happy, and every time there is either monetary or fiscal tightening, the bond investors are happy, and the equity investors are the opposite. So I think that is what maybe you are seeing in the equity markets. But overall, I think Indian economy needs both inflows in equity markets and bond markets. And I think India is now getting ready for global bond markets. And I would say last few years, the government approach to fiscal prudence and the middle path has in the long term, because it will conquer one key problem India has always had, which is inflation, which is like a dragon that rears his head all the time. So I think this government fiscal prudence of the last few years, including when COVID was there, Indian government was very, very careful, has been good for keeping inflation at least not getting out of control. But at the same time, I think we now have a growth issue, and balancing that is going to be a key one. I think demand is going to be the most important vector to drive, and I'm hoping that some of the details as we get will also give us confidence that demand, especially urban consumption and all, if it starts picking up, that will be good. It will augur well for the economy. But outside of that, I think currently whatever government does, the ease of doing business and the income tax code and all this will have an effect in the medium term. I think in the short term is going to be government capex. I do hope that whatever capex for the year they have, they do front end it in the first half, so that will also give a boost to the economy and the growth rate, as well as at least cushion the uncertainty of the global environment.
Sure. Thank you so much, Rashesh, for joining us this afternoon. Vikas Khimbani from Carnelian has joined us. Vikas, in today's trade, consumption stocks seem to be winning. Do you see these stocks having legs to run going forward?
I think, consumption is a long-term story for sure in India as the per capita income goes up. The little bit slowdown which we saw in case of in last couple of quarters, I think this current relaxation in the income tax probably might help that. But I mean, in my opinion, these are only short-term trades. According to me, consumption continues to remain one of the best story for long-term. But again, like I said, as an investor, one looks for real long-term story, and that nothing is about India as a consumption hub.
But in terms of valuations, etc., even now, consumer stocks, despite the the growth rates coming off over the last few quarters, which partly may get addressed because of this uptick in consumption, they're all highly valued, more than 60-70 times earnings. So from a market perspective, while some uptick in demand may come through, in the short to medium term, do you see these stocks performing?
Now look, again, it's hard to call out on short term, but like I said, most consumer stocks are quite expensive, and hence we don't own many, but we have select stocks which we like. So, the idea is to kind of look at stories where there's a risk and reward in favor. So, structurally speaking, many consumption stocks have not performed in last 4 or 5 years, and may not perform in next couple of years because of their overvaluation and also potential disruption happening in those large big names. But at the same time, smaller consumer companies have been growing faster, and they are also getting sort of better risk reward. So again, it's a idea is to choose right set. But I would say that consumer stocks may not be a one-way run, and short-term flip can be there. But you have to look back again individual stocks and idea depending on that. But risk reward has to be there based on the valuation.
One more question, but before that, Bodhi, what do you think of the possibility of us getting a sovereign debt upgrade this year?
So I think that's certainly an expectation the government has. The fact is that it's 4.4. I think the expectation was for the next fiscal year, it should be 4.5. So they're actually tightening. We'll have to also see beyond that, what is the target? Do they plan to hit 3%? In the next couple of years. If you look at the last 5 years, in the COVID year 2021, I think the fiscal deficit, if memory serves me right, was almost 9% of GDP. It was probably, so it's a big contraction. It's a 5 percentage points, 5.5 percentage points contraction over 5 years, and that could account for some impact on growth. The problem, which is that the contraction is not crowding in private investment as it is supposed to do in theory.
Right.
At least not as yet. I mean, that's the Indian story. If at some stage it does, we should all be in for happier times, but I'm not sure the market is convinced about that right now.
Talking about the markets, let's take a quick check on that. The big headline we are going with at Moneycontrol at this point is that it is Prime Minister Modi's big middle class outreach, tax changes have put more money in the pocket, but look what's happening in the market. There's a different story over there. Indian equity markets erased early gains and slipped into red after government revised its capital expenditure, capex estimates, remember, for FY25, lower than initially projected. At around 12 noon, that's when the speech ended. The Sensex fell about 350 points over there and about 0.45% as well. Now, while Nifty declined also above 100 points or so, 0.43% also is the market's breadth sort of turned over a little bit. But let's look specifically at how these stocks are doing. ML, we've talked about the big sort of gainers and losers at this point and sectors that we are looking into. What else is telling you the story of how market is reacting?
Yeah, I mean, it seems to be a reversal of the trade that happened post-COVID for a bulk of 3-4 years. Is that all your economy-sensitive stocks, infrastructure stocks did very well, consumption stocks didn't, and now that's what you're seeing, a reversal of that trend. But we don't know how much to read into it. That's what we'll understand. So back to you, Vikas. Even in today's, how do you see, I just got the capex numbers, it's 11.2 for FY26, that's the budgeted number for FY26 capex. That is pretty much along market expectations, but is it a disappointment? Can that number take the infra pack through this year? Vikas?
Like I said, government has put out a number and it is in line with expectation. Now, a lot depends on how the execution happens, pace of execution, how government really spends it. Now, do you want the number to be higher? Answer is yes, but government has taken a path of fiscal prudence and I think pursuing that. And also there are different ways of spending money on capex. Today, a lot of infrastructure capex are happening on the SPV of, they're not necessarily to the government balance sheet, but on a user pay basis. So this is not the only sort of vector for the growth of the investment cycle. There are many more. So I would say that yes, of course, there's not major disappointment on that. But at the same time, could this number have been higher? Maybe answer is yes. But this is what it is, and I am not really very disappointed overall on this basis. I think even what two things were expected from the government on this: one is the taking care of the middle class on the income tax, and secondly on the capex. I think they have met the expectation by and large. In fact, in case they in income tax they have exceeded the expectation. So by and large, it's a good budget, and I think markets are terribly down. I mean, a little bit of profit booking based on the expectation always happens. So I'm not really perturbed. It's not a significant judgment on either side of the budget. It's a good budget, but in line with market expectation is what I would say.
Pankaj, there were 4 pockets of sectoral announcements which I thought were interesting. What do they mean from a stock perspective? Affordable housing, she talked about 40,000 dwelling units under Swami scheme. Then she talked about continuing the stuff on renewables. There were the thrust on EV batteries, solar cells, transmission equipment, grid scale, and this pocket has been a very buoyant, vibrant pocket of the stock market. So amongst these, any stocks stand out? Do you still back these themes? Because these are also some of the overvalued pockets.
Definitely, Mahalakshmi. I think from an overall perspective, the new age businesses, the new energy transition, the government has been quite vocal about. And in this budget also, they mention about the same. But one important point which I want to bring it is that we always get cue from this government on what the next 3, 4, 5 years lie ahead. If you remember in 20 and 21 after COVID, the clear focal point was to revive government expenditure across infrastructure, make in India, make sure PLI schemes worked, and you achieved a huge success, and the next 3, 4 years followed that. If you look at the last 6 months in this 3.0, clearly the focus is towards boosting the middle class consumption. Already 12 states have announced freebies, welfare schemes, whatever you can mention, to the tune of 3 lakh crores. So that's supporting the urban side, the rural side. And now with this income tax correction and new regime, you're talking about incremental 1.14 lakh. We just did the maths, which is a huge number for an individual on an annualized basis on a higher tax slab. So I think the clear focus could be towards consumption as well. And I think most of these stocks in the consumption, the headline valuations looks very expensive. But when growth starts coming in, can be a area to watch out for. Also, expenditure 10% growth, not bad, but compared to the expectation, it was running high. So I think markets are a little disappointed. So I think a balanced portfolio probably could help you navigate this volatility as you move ahead in the next 12 to 18 months. Don't be on the extreme side. I think having right stocks from a bottom up, both on consumption as well as some of the areas where infra spend will happen, both by private and government, will be the way to create a portfolio.
So much, Pankaj. We have with us Jigar Mistry, Director of Buoyant Capital. Jigar, the last time we spoke, you said, banks is the only sector where you find valuations relatively okay. In today's trade, banks seem to be sulking. How do you explain that the fiscal deficit number is actually lower than what the market was expecting? There are consumption triggers in this budget. Nothing changes with respect to the infrastructure budget. The spends are pretty much in line with market expectations, but banks are sulking still. How do you explain this?
I would beg to differ, Mahalakshmi. I think we see this as a pivotal shift of the government away from capex and into consumption. Because if you look at the spending, 11.1 lakh crore was the budgeted estimate last year. From there, we are going down to 10. And next year budget is 11.2 lakh crores. I think the market estimate was fairly above 12 lakh crores. So clearly the capex number of the center is much lower than expected. Secondly, if you look at the last 12 state elections, the capex bill was 4.3 lakh crores. The sort of social spending / freebie bill was 3.6 lakh crores. So center is not spending enough, states are not spending enough. Private capex, while it's inching up the intensity to GDP, is not really matching pre-2015 levels. So I think what the government is now trying to do is, look a little closer to home rather than spending with the highest M3 multiplier. If you look at the income tax spendings, 60% of the 8-month collection was because of personal income taxes. Corporation income tax growth was 0. And I think they're trying to make sure that they, give some relief therein. While the fiscal deficit number is broadly on track, I think the 14% assumption on personal income tax growth at a time when STT and capital gains accounted for a bulk of the incremental number, the market might not really want to look at it in a big way. Secondly, RBI dividend of 3.25 lakh crores at a time when you could be called in to do a much larger OMO. I don't think the market wants to believe that that higher number is possible. which is why yields may want to spike once the market opens. In that scenario, the banks, sort of don't look as great in the short term. So to answer your question, I think I've taken a longer route, but this is how sort of we see the budget.
Sure. I guess Saurabh Mukherjee has also joined us. Good afternoon, Saurabh. You already must have your, personal income tax calculations ready. So give us a lowdown.
Now look, I think Pankaj was already saying it, that this is a very different budget from the last 5 budgets from the. I think this is a decisive change in direction. Perhaps the 2024 general elections triggered this, but it pushes the market away from the theme that the market had got really, addicted to, which is government will do capex, we will buy capex stocks, and that's all there is to it. If you take the last 2 years, effectively there will be zero growth in government capex.
Correct.
And therefore a whole section of the market, I would say 50-60% of the Indian stock market was running on a government capex theme, directly or indirectly. I think that part of the market, I think, will see a retreat over the coming few years. And in a way, we go back to what we saw in NDA 1, which is you focus on SMEs, you focus on pro-poor, you focus on the middle class, you give them economic space to grow, and the economy runs at the back of that. I think that's the theme we get back to. The middle class consumption tax cut. The middle class tax cut is obviously the biggest concession in that direction, but there's a whole host of smaller concessions to low-income workers, to farmers, and I think changes the direction of economic growth, it changes the direction of earnings growth quite decisively, and we'll see that playing out in the coming weeks in the stock market.
So 2 numbers have come in, Saurabh. One is that the RBI dividend projection for next year is 2.56 lakh crore. That's even bigger than the bazooka we got for this year, 2 lakh crore, which itself was a lakh more. But the projection for next year is 2.56 lakh crore. Does it surprise you, and what can it do?
I mean, look, I think given that the recent change in the RBI governor, given that the RBI has massive surpluses, the RBI balance sheets has massive surpluses, it doesn't surprise me that there is a big dividend there. What I find interesting is that the government has chosen to compress the deficit significantly in spite of the dividend. They could have used this extra money from the RBI and thrown it at capex. The government is being very clear, saying we will compress the deficit, we'll give the middle class a break, and we will conserve fiscal space. I suspect the conserving fiscal space for the sort of business end of the 5-year election cycle. So the budget deficit reduction to 4.4 in turn, I think puts onus on the RBI to kick off the rate cutting cycle. Next couple of months we'll see the rate cutting cycle begin. With this sort of fiscal consolidation, in spite of the pressure on the rupee, I think there's good reason for the RBI to begin the rate cutting cycle.
Fair enough. Because one question for you, and as all of you have rightly pointed out, that there is no capex growth between last year and this year. If at all we are showing that 10% growth, it is because this year we did not meet that, that we see that growth compared to the revised estimates and budgeted estimates for next year. Do you think the entire bogey of stocks that did well in the post-pandemic era, that trade has now reversed? I guess we've lost Vikas. Saurabh, can you take that question?
Saurabh, just a minute. We're just getting your audio back. Saurabh, if you could just take that again, please. Thank you.
The focus in the market was on capex oriented plays, especially government capex oriented plays. I think that theme will now die a slow death over the next couple of years, and we go back to the sort of market we had in the era before COVID, where small businesses were going up the ladder a little bit, middle classes were moving forward. That was giving a fillip to consumption-oriented plays, light industrial stocks. It's also likely that on the back of the rupee weakening, export-oriented companies will do better. Not just IT. I think even in manufacturing exports, we're seeing good improvement in earnings growth. So the direction of the stock market, as I said, tilts away from that 50-60% of the market, which is a play on capex directly or indirectly, towards that 40% of the market, which is a play on either exports or consumption.
Why would you think exports? What areas of exports? Are you talking about pharma?
A couple of reasons for thinking exports, right? If you see India's economic cycle, it's actually a fairly predictable pattern. We have 3 years of strong growth, and then supply side issues catch up with us. We then get a couple of years of weaker growth. When we get weaker growth, the rupee typically comes off. That helps exporters naturally. Thankfully for us, that period of the rupee coming off also coincides with a very strong period for the US economy. So the US economy in great shape. China is pulling off. China's pulling back from the post-COVID dumping. That creates more space for our exporters. So the export data the last 6-7 months, Mahalakshmi, has been very clear. Our exporters are growing at the fastest rate I've seen since the COVID period. Post-COVID, we had a dramatic lull in Indian exports. Exporters are being helped by the weaker currency, strong demand in America, and China gradually throttling off on the mad dumping that they've been doing in the post-COVID years.
Saurabh, but can I give you a follow-up on that? You talk about exports, but how do you factor in Trump and tariffs coming in on that matter? With US being in the state of volatility, we really don't know what's going to happen next. How are you factoring that?
It's highly unlikely there is that much that we produce that he will tax. Our biggest export to the United States is IT services. Fortune 500 companies fundamentally rely upon India as their global IT center. I fail to understand why Trump will go after that. It's not as if IT services will relocate to America just because they'll get taxed. So our manufactured exports are pretty small. I mean, in the context of Indian GDP, manufacturing itself is 15% of GDP. Manufactured exports would be barely 2-3% of GDP. So I don't think Trump's "Make America Great Again" is a huge threat to India. I think it's a bigger challenge for China and countries like Mexico, who are sort of acting as a via media for Chinese goods to get into America. From a tariff perspective, I sort of fail to understand why many people in India get so worked up. We export so little beyond IT services and pharmaceuticals that it's not really a massive issue. IT and pharma, difficult for me to see why Trump will come after us on those two.
Pankaj, would you bet on affordable housing as a theme? And the second one I wanted to ask you, anything related to agri inputs that you find exciting?
I think housing has a great multiplier impact, and two things which have not been spoken about. One is the urban infra. I think we have seen government talking about urban infra and many states funding required, and a 50-year concessional rate. That's a good one. And 1 lakh crore of support on the urban infra. I think this model, if state and center work together, can be a brilliant model apart from the capex number which we are so obsessed to look at. And this has a very high multiplier impact. The second part is the housing, and obviously our long-standing demand has been that. And if you look at two self-occupied houses, individual can own now. I think there is no taxation on that side, which is a good, which has not been spoken about again. And I think these two are important measures. And obviously, housing from a medium to long-term theme is a very, very strong and powerful theme from a multiplier impact perspective on the country and the economic growth. So obviously, that remains as a core thesis from a portfolio perspective also. The second part which you spoke about was, can you repeat, Mahalakshmi, once more on the second part?
He's asking you to repeat the question once.
Second question, agri-related stocks.
I think clearly we have seen that from the recent commentary by most corporates and the data coming out, that agri seems to be doing well, rural seems to be doing well. And there have been a whole host of announcements on the agri. She started from the agri side itself. And we believe that probably the rural stress is behind us. The good news on Indian economy is that reservoirs are full. Rabi has been quite decent. Kharif was good. So we are coming on the back of a good monsoon, and the real wages of rural workers is moved into a positive territory after a very long time. And that's we are seeing in many sectors which are linked to agri directly. For example, M&M just declared their numbers. Look at the tractor growth. Obviously, slightly lower base, but we are seeing a good number on M&M tractor growth. Look at the way fertilizer and agrochemical companies are reporting numbers. A couple of them reported yesterday, very strong growth. And the narrative of a lot of FMCG companies which have declared numbers or given a preview are talking about pickup in rural and a bit of stress on urban. So I think rural is doing fine, and I think stocks probably linked to rural can come back. So I think after 24 elections, I think there is a decisive change in which this government wants to take the next 4 or 5 years, and there is a clear focus on reviving rural and urban consumption, and we should not ignore that because that's a decisive direction this government is telling us to focus on. And I think slowly and gradually markets will move towards that part as we move ahead.
Jigar, what is your takeaway? I mean, this rural thrust in terms of, pockets of stocks and sub-segments, where do you see action? Are there any pockets that today are, have seen serious cuts which you think will bounce back?
Yes, Nalakshmi. So I think generically, as we discussed before, we do see, the effort of the government to give relief to a wider mass rather than a select few, right? So even this data that you look at, the TDS, TCS cuts that we saw, right? There are almost 2 crore taxpayers who pay the tax but don't file IT returns. With this sort of increase in limit, they will benefit. The Kisan cards limit expansion that you saw, the specific targeted agri measures. I think when you see these surveys where you see that the bottom 20% households have not really seen a growth in nominal income since demon. I think the government is trying to address that, as I was mentioning in my initial comment. So very clearly, and even I think they did something on the seeds, fisheries, yet to read the fine print on those 2 accounts. But I think, yes, there is a definitive push away from sort of the last budget and time into consumption and a wider base that benefits in small proportions rather than sort of a select few.
How do you see travel and tourism? Because there was this, Udan scheme that she talked about, and the expectation, that's been one strong area of spending and somewhat of an exception. Do you see that continuing? And will this Udan really make a difference in terms of how, the hotel companies do, in terms of how airlines do? Airlines, of course, there is already a consolidation because of which profit pools are getting concentrated in fewer companies. Sort of, if you can come in on this.
Post-COVID, one of the big surprises has been the runaway boom in domestic travel, right? Foreign tourist arrivals today are actually lower than they were in 2019. It's remarkable. 6 years in, there are fewer foreign tourists in India than there were in 2019. Hopefully the e-visa that the FN mentioned will stimulate that. But domestic tourism is on a tear, and numbers actually are quite astonishing, right? The listed hotels are reporting 20-25% revenue growth. The luggage manufacturers, we've invested in one of them. They are reporting 25% earnings growth, 25% revenue growth. I'm sorry, earnings might be more than that. In fact, I speak to some of my friends who run unlisted hotels and unlisted luggage companies. It's a massive boom, and whatever the FM is saying, the tourism plans, the Udan construct, 120 new airports will only give further succor to that. It seems that Indians have discovered this kind of wanderlust where they want to discover their country, and luggage manufacturers and hotels will make a lot of money. I'm not so sure about airlines. It's tougher to make money in airlines in any country, but hotels and luggage manufacturers will be grinning from year to year today.
All right, sort of taking a leaf on tourism, can we switch our focus for a minute to medical tourism as well and Heal in India? That was also another focus that the FM had. Like I was pointing out, there were several schemes that have been floated out. Health also found quite a prominent focus there. How are your outlook on health?
So look, it's relatively clear for several years now that the government really doesn't plan to build too many more hospitals, right? So therefore the private sector hospital space has been blossoming. In parallel, post-COVID, everybody is buying Mediclaim, or their companies providing them Mediclaim. So the healthcare and hospital space, diagnostics, hospitals, medical equipment is doing well in our country. If medical tourism can be given a further boost, then all power to the private hospitals. But I suspect the private hospitals' main play will be Indians and Indians getting insured, because I think the government is saying we will broadly be stepping back from the provision of healthcare. In this budget, notably, we didn't hear much about Ayushman Bharat, but even if the government spends more money on Ayushman Bharat in subsequent budgets, ultimately it's the private sector which will have to provide hospitals, healthcare, medical devices, medical diagnostics, and I think that remains a strong theme in our country. Plenty of high quality listed plays there for all of us to make money from.
Right, but you don't see that playing out in pharma stocks as well? Lots of cancer drugs which have been given sort of free custom duty, other boosts as well?
I think pharma stocks, the challenge is that the bulk of their earnings, for most of them, there's a few pharma companies which are domestically focused, but the bulk of them get their earnings from exports to the Western world, where earnings growth is a difficult story. Domestically, pharma stocks should continue to do well. They had a great run through COVID, post-COVID. I think there'll be reason to believe that domestically focused pharma companies will have, say, somewhere around 10-15% earnings growth. But remember, the government will constantly keep increasing the NLEM, the National List of Essential Medicines. We are a poor country, and NLEM will keep expanding, thus squeezing the ability of pharma companies to monetize demand growth. Harder for the government to do so with hospitals. There is a Supreme Court challenge around the hospitals piece, but I think by and large, hospitals will be left to make money on the core of their client base, medical insurance, and then diagnostics and medical equipment. I think plenty of space to make money there. And as the government pulls back from building more hospitals, there'll be growing space for the private sector to blossom and boom.
All right. So
one quick question for Jigar on insurance companies, Jigar. These stocks are almost at 5-year lows, if I'm not wrong, or somewhere thereabouts. Do you see them bouncing back? Because there is also this announcement on the FDI on insurance companies. Is there even sentimentally you think stocks will go up? Although I'm not sure how they're reacting today. I'm just looking up.
They're broadly, I think, down today as well, Mahalakshmi, and I think ownership structures beyond the point don't really change fundamentals. So to that extent, unless there has been something in the fine print, I couldn't really hear anything else that was coming through. So no, I don't think there is anything as far as the budget I could go through which suggested anything on insurance stocks.
The buzzword yesterday from the economic survey is also health tax. That got everybody talking about how food which is unhealthy food will get this sort of health tax. I'm not sure if we missed that in the budget at all, but a quick takeaway, what did you make of that?
Yeah, but I think it was only limited to sort of economic survey. We'll have to go through the fine print to see if there was something really there. But I don't think that essentially weighs it on how the market is reacting today.
Okay, before we go into getting some reactions that are coming in from Parliament and other places as well, Bodhi, quickly, I want to concentrate on another subject that we haven't really touched upon, jobs. That was said to be another focus that we were hoping that the budget would provide. Last year's budget had this internship scheme. We don't really know how that has really panned out, did not get a lot of support from the private sector. How are you picking up on jobs from this budget?
So the internship scheme wasn't mentioned at all. There are welfare measures for workers. There is, for example, the extremely important measure for gig workers, basically putting them on the Shram portal, giving them insurance. So that is there. As far as general sort of job creation is concerned, I mean, no big sort of direct measure that I could really pick up. I mean, there was some talk of incentivizing labor-intensive manufacturing by way of tax breaks of PLI, but no reference to PLI. So yeah, not much. I mean, I think the job creation, if any, will be indirect. I mean, I suppose the tax cuts and the extra spending, and if that leads to a revival in the economy, jobs will be generated, but nothing very dramatic. I mean, there are loans. There is the whole the fund of funds for startups. I mean, there is stuff. There's support for MSME. So it's there. But it is not directly, I mean, which will create jobs, but no direct job support schemes of the kind there were in the last budget, which was held just 2 months after the general election.
Yeah, so the great Indian middle class that seems to be rejoicing at this point. But this is only a teaser, right? There is a new tax regime coming up altogether. There is a new bill in law that she plans to propose in just about a week from now.
It's a simple, but I think people are more interested in the tax rates than the tax bill.
Correct. On that note, let's quickly cut across and get some reactions that have come in from Parliament and other places.
देखिए, सबसे ज़्यादा तो स्टेटों के नाम देखिए, बिहार जहाँ पे चोन आ रही है, बिहार, उसके बाद असम की आ रही है तो असम, पंजाब का तो नामो निशानी है, वो किसान धरने में बैठे 4 साल से MSP की लीगल गारंटी के किसान के लिए क्या मखाना बोर्ड, ये बोर्ड, वो बोर्ड, सो किसानों के विरोध एक बजट था और किसान जो उसके लिए लड़ाई लड़ रहे हैं उनकी तो कुछ सुनी नहीं गई, तो दुख है।
ਕਿਵੇਂ ਵੇਖਦੇ ਹੋ ਜਿਹੜਾ ਅੱਜ ਬਜਟ ਪੇਸ਼ ਕੀਤਾ ਗਿਆ ਪੰਜਾਬ ਦੇ ਲਈ ਜਿਹੜੀ ਅਨਾਉਂਸਮੈਂਟ ਸੀ ਐਕਸਪੈਕਟ ਕਰ ਰਹੇ ਸੀ ਉਹ ਨਹੀਂ ਮਿਲੀ ਹੈ ਉਹ
ਪੰਜਾਬ ਨੂੰ ਤਾਂ ਕਦੇ 15 ਸਾਲਾਂ 'ਚ ਇਸ ਸਰਕਾਰ ਨੂੰ ਹੋਵੇ ਇੱਕ ਵਾਰੀ ਪੰਜਾਬ ਦਾ ਨਾਂ ਨਹੀਂ ਲਿੱਤਾ ਗਿਆ ਸੋ ਪੰਜਾਬ ਦਾ ਕੀ ਲੇਕਿਨ ਕਿਸਾਨ ਜਿਹੜੇ ਧਰਨੇ 'ਚ ਬੈਠੇ ਹੋਏ ਨੇ ਪਿਛਲੇ 5 ਸਾਲਾਂ ਤੋਂ ਜਿਨ੍ਹਾਂ ਨੂੰ 4 ਸਾਲ ਪਹਿਲੇ ਧਰਨਾ ਚੱਕਿਆ ਸੀ ਕਿ ਤੁਹਾਡਾ ਲੀਗਲ ਗਾਰੰਟੀ MSP ਨੂੰ ਦਿੱਤਾ ਜਾਊਗਾ ਅੱਜ ਕਿਸਾਨ ਮਰ ਰਹੇ ਨੇ उस मंग वास्ते लेकिन ओदे वास्ते पूरे बजट ते एक किसान दे वास्ते एक शब्द तक नहीं सीगा बस हाँ फिशरीज दी गल सीगी इत्थे उत्थे पहले बोर्ड मखाना बोर्ड बन रहा लेकिन किसान दे हाथ च कुछ नहीं आम
अगर मेरी जानकारी सही है तो ये सरकार का 12वां बजट है 12वां ही है क्यों 11वां है अच्छा ठीक है जो भी कुछ ये जो बजट है अगर हम इसको 12वां मान लें 11वां मान लें 12 साल बाद कुंभ आता है जो सरकार को आंकड़े देने चाहिए थे हमारे लिए आज बजट के आंकड़ों से ज्यादा जरूरी है कि जिन लोगों की जान गई है वो आंकड़े जो सरकार मरने वालों का आंकड़ा न दे सके जो सरकार खोए लोगों का आंकड़ा न दे सके जो खोया पाया केंद्र है उसमें बड़ी संख्या में लोग भटक रहे हैं कुंभ में लोग अपने मोबाइल पे अपने परिवार के सदस्यों की तस्वीर लेकर के कोई अपनी मां की तस्वीर लेकर के कोई अपने बेटे की तस्वीर लेकर के कोई अपने परिवार के सदस्य की तस्वीर लेकर के कुंभ में लोग भटक रहे हैं लेकिन सरकार उसकी जानकारी के लिए कोई इंतजाम नहीं किया है जो आंकड़े बताए जा रहे हैं जान जाने
यक्स सर्विसमैन कंट्रीब्यूटरी हेल्थ स्कीम यानी ECHS को 8,300 करोड़ रुपए से अधिक का एलोकेशन किया गया है ये पिछले साल के बजटरी एलोकेशन से लगभग 19% अधिक है बॉर्डर इंफ्रास्ट्रक्चर को और मजबूती प्रदान करने के लिए इस साल के बजट में कैपिटल हेड के तहत बॉर्डर रोड्स ऑर्गेनाइजेशन भाई ऐसा है इसे काहे को लंबा डाल दिए कोई जरूरत नहीं बंद कर बहुत लेंदी कर दिया बहुत कोई जरूरत नहीं है
All right, those were some of the reactions coming in. Just to sort of revise and refresh your memory, the opposition was actually sloganeering, demanding answers on the death toll in Kumbh. They even staged a walkout, then came back in the middle of the budget while this was being placed. This is the budget that started being read out in middle of ruckus in Parliament, and those were some of the reactions coming in. I believe we have Amit Jaswani, founder and CIO, Stallion Assets, also joining us. Hi. Good afternoon, Amit. Your first thoughts on how the budget 2025 went?
It was an extraordinary great budget. This was the budget that was needed. Delivered what was needed, especially the tax cut. I think that headline was needed across paint industry, across every industry was struggling. Consumer spend was up 3% YOY. The consumers were struggling. And every elections, the emerging class, I would say, was getting soaps with 2,500 rupees a month, etc. But there was nothing ever for the middle class. I believe this budget shows that the government's intention is clear. I believe consumer stocks underperformance bottoms out. This is what I feel. I can be wrong, of course. but consumer stocks underperformance should bottom out today.
Amit, are you saying that because you're a die-hard fan of consumer stocks, you only invest in consumer stocks, or do you really see consumer stocks coming back?
So Mahalakshmi ji, actually it was a very tough 2025 for consumer stocks. There were only 5, 7, 8 companies in the consumer space that were outperforming very aggressively. Of course, good money was getting made and valuations got a bit stretched there in those 7, 8 stocks because everyone wanted to own those 7, 8 stocks because the rest 100 were not doing so well. But what has happened is, assuming 8, 10 stocks were doing well and 90 stocks were not doing so well, the valuations of those 90 stocks have now come down a lot. And assuming if market senses that there will be change of growth rate, I believe the re-rating can happen in the fancy ones because the fancy ones will keep continuing to perform well, but the non-fancy ones is where large alphas can get made. So Mahalakshmi ji, if you think about it, consumer is the only place where large money can, I believe it's very tough to have B2G and those kind of things in our portfolio because volatility is very high for us. But let's see, we are very, but I believe outperformance can now start in consumer stocks. And today might be the outperformance bottom. Don't get me wrong, if the market goes down, consumer stocks will also go down, but they will not go down as much as the market. Market was looking for a defensive. After this rally, after this, whatever has happened from October till now, markets were looking for a new hiding place. And I believe consumer will now become a hiding place for all investors, at least in the short term.
You say markets, this is a great budget, but if we take a quick look at how the markets are doing and how the Lal Street is doing at this point, you see you see Nifty below 23,400, you see Sensex down 300 points as well. You have HDFC Life, SBI Life amongst top losers that are coming in. Among sectors, consumer durables, realty, auto, FMCG up by around 1 or 2%. You have BSE mid-cap, small-cap indices also down marginally. You've got Bharat Electronics, L&T, Shriram Finance, Coal India, ONGC all amongst top losers on the Nifty. Again, Trent, Maruti Suzuki, Britannia, Hero MotoCorp all against top gainers. So how exactly is this panning out? Make sense of these numbers for us, please.
You want me to make sense of these numbers?
Yes, please.
So this is what was expected, right? Because you've got the government is pivoting. So the last 3 years were all about capex spend, and you went from 5 lakh crores to around 11 lakh crores of capex spend. That was last budgeted capex spend. Right now the game is changing, and you had a massive growth in personal income tax. Personal income tax rates were growing at 17-18% CAGR, way higher than nominal GDP growth. And now, so a lot of tax money was getting collected from consumer, from the middle class, and now this soap will be a game changer. I believe it is, so these consumer stocks underperformance should get reversed, and that is very good because from your automobiles to your, there are so many stocks that were not doing so well. I believe across airlines, more discretionary spends, that is a good space to be in now. I'm very happy with this budget. I'm extremely happy. See, most times, like you just like the budget is middle, like not so great, nothing new happens, but this 12 lakh is a massive change. Even in my office, there are so many people who make less than 12 lakh rupees. And this is going to be a massive addition to their income. And even if they make 20 lakh rupees, 15 lakh rupees, everyone benefits. They will spend on cars, they will spend on travel, they will spend, and there will be a multiplier impact on the economy. I believe this is one of the best steps that could have been taken, and I would rate this budget 10 on 10. You're not asking me, but I'm still rating it 10 on 10.
ML.
Amit, you are absolutely right. I think more than 85% of taxpayers benefit from the tax reliefs, okay, the change in slab and the income tax rate. But tell me, in the consumer space, I mean, it's very hard to really determine which pockets will benefit, right? I mean, you have, companies that you own, like something that sells shoes, a local brand of shoes, to the levers, which has everything in its portfolio, to, all kinds of companies. How do you zero in on consumer companies or segments of consumers which will really benefit from the kind of changes that the kind of changes in the tax slabs that we've seen today? Where do you see that money getting spent?
Yeah, this money will get spent. This will get spent on cars. This will get spent on fashion. You just keep tracking quarterly data. Which are the companies which are growing and which are the economy is always similar for everyone. For all companies in every market, the economy is similar. It is about execution. Few promoters know how to execute, but 70% don't know how to execute. So, but you have to look at who are the guys who are using this tailwind to execute and make it large. And those are the kind of entrepreneurs we want to back in this cycle. India has gone through a down cycle. We are just starting, I believe that next year, if you look at GDP growth numbers, they were 5.2%. GST growth numbers were 7-8%. So this is a time that I'm thinking that the best way to like you keep tracking data and if a company has to go from 100 crores PAT to 500 crores PAT, it has to do 120, 150, 170. You keep tracking data, and whoever is executing well, that is where you want to be invested in. That is what we do. We keep tracking who are the guys who are executing, but valuation just decide the allocation. If you get good execution at low valuation, then you want to have larger allocations. If you get good execution but very high valuation, we might have lower allocation. So that is what we do.
And what is your valuation threshold?
So we look at 1 year forward numbers, Mahalakshmi ji, to decide. So if you grow at 40%, we will buy you at 70-80 PE also. But if you grow at
please tell me one company that is growing at 40%.
That's so many. Yesterday one
40% top line, bottom line, what?
Both. I want both. Like top line and bottom line, both should grow at 30-40%. Maybe there's so many companies. My entire portfolio, I think, will grow decently. There's so many from your largest exchange. So many companies will grow. You want to take more risk, you can go for triple-digit growth also. But these are very risky. So normal people, like your investors, should look at 20% growth also. Those are very sustainable. So Peter Lynch had these frameworks of slow growers, fast growers, consistent growers. I believe very large money for retail investors will always be made in consistent growers. Companies who grow at 15%, 20% consistently, because those companies don't get changed. In the high growth companies, what happens is when growth is very fast, the market bids them to unbelievable valuation. And if you don't get out at the right points of time, then you're stuck with those stocks. So medium growth, like consistent market leaders, medium growth, wires and cables, housing, all your housing ancillary companies you should have, not real estate, but housing ancillary companies, all of these housing ancillary companies. You see one pipe company came with 0% growth yesterday. All these, the largest paint company was coming with 0% growth for so many quarters. And now if there is a revival, it has come to 40p, assuming. This is not a recommendation, but I'm just telling you how you should think, that it is at 40p. It's after how long do you think the growth will revive? And if you revive, then I'm just telling you how to think. I'm not buying the largest paint company. I'm just telling you how you should think, that if the growth moves back to 15%, because paint and all these categories are very long-term categories. For US, there are companies like, so many companies are already there who've been where India is right now. And very large, I think it's a very blockbuster kind of budget for consumer companies. Mahalakshmi, large money will get made now.
No, I agree with you, but I think the only difference is on valuations, which is where the market really disagrees. You see a company like, Whirlpool, what has happened? So global companies are also realizing that Indian markets are super expensive and dumping stock here. And of course, we are giving them exit at very favorable terms. But be that as it may, thank you so much for joining this afternoon, Amit.
Rohit Shrivastava, founder India Charts, has joined us. Rohit, quick comments on how we are hearing people saying 10 on 10 budget, great budget for the Indian middle class. The market numbers not really reflecting that at the moment.
Yeah, so there are a lot of positives, and at the same time, if you go by overall expectations, there are many things that you were hoping to see that have also not happened. So that is why probably there's a mixed feeling in the market. I mean, the most positive reaction you're seeing in the obvious area, which is, consumer stocks, that if you have more money in your hands, okay, you're going to buy this or this. Then I think at some point of time you will think about secondary effects. But
The other area which people are talking less of, which is the capex and infra spending, mostly dependent on government, has slowed down in terms of the pace of investment that they're doing from 30% 2 years ago to 10% last year to maybe 8 to 9% this year. That sort of reduces your expectations on growth overall from those segments. And then we, of course, start hoping that interest rates will come down because you have good fiscal consolidation going on. That means pressure on the budget is on the bond market is not so much, and there's a case for rates to cool off. Will that happen right away? Will the RBI take that measure, or will they remain concerned about the currency? So these are some of the unknowns, and which is why the immediate reaction is not there. We can look at secondary effects of consumption. When you combine it with rates and try to put it together, which is why some auto stocks are maybe doing well. The realty sector is up. So these are interest rate sensitive sectors, but they will probably show the same kind of movements as FMCG if you could actually anticipate what happens next more clearly. So which is why it's not broad based. It is sector specific based on what the government has allocated to, where the capital is really being put to or taken away from. And that is why the market as a whole is not showing that same response as the particular sectors are showing.
Right. Talk about quick responses that we are seeing. Swiggy, Zomato shares rise up to 7% from day's low. I mean, again, income tax relief that has come in. Agri stocks are on the rise as well on the announcements made in the budget 2025. Also, as a boost that is coming to agriculture and farmer income. Renewable stocks, renewable energy stocks also up in this post the budget. Shipping Corporation, the Great Eastern Shipping, etc. All of them also gaining at this point. Emil, you had a question for Rohit.
Rohit, on the charts, what are you seeing? You take today's reaction and the past 4 months. What do you see? Any clear pockets of winners in the short term?
Yeah, so there will be, and I think if we did, in fact, I published a relative strength analysis yesterday of what has been working since the market fell from 13th of December to the end of the month, and it was essentially the top sectors showing up were FMCG, auto, and pharma. These are the three sectors that were standing out in the fall. And usually we feel that, okay, what's standing out in the fall is going to stand out afterwards as well as it bounces back. And I think out of these, two of them are showing the way. One is FMCG and second is, of course, autos. FMCG was on top and that's sort of doing the best. So I don't think the rally that you're seeing now in FMCG is over because some of the stocks are just breaking out from the base formation that they were making over the last several weeks. Because remember that FMCG was also the first to fall. When the market started to fall from the peak in September, this was the sector that got hammered the most, whether it's including the domestic FMCG, which we are not even focused on now. Although I think Godrej Consumer is actually one of the top performers right now, but you have Titan, you have Asian Paints, you have so many stocks that got battered the most. So that became the case for, okay, when are they going to bounce back? And you've got a case now for them to continue this bounce, maybe retrace a little more because you've not even retraced maybe 38% of the fall so far. You can do 50%, you can do 61%. So I would say there's still further upside in these segments in the days ahead. So we should remain optimistic from a trade perspective. Since you asked short term, maybe for the month of February, I think we still have upside in these segments. But when we study the market as a whole, it's possible that the Nifty, which has hit its first resistance over here, close to 23,500, 600, you will see a consolidation below that level before you break out above it. I do think that in the weeks ahead you will hit 24,000 in this bounce that we've started to see. But it may take a while. You might still see the market consolidate maybe for a week below 23,600 before you get the next leg higher, because you're going to need participation from the rest of the market for that to happen. So the sector specific gains may continue, but the overall Nifty, if we simply look at it, may take a while to start moving higher.
All right, Rohit, stay back with us. Lakshmi Iyer, CEO, Investment and Strategy, Kotak Alternate Asset Managers Limited is also with us. Hi, Lakshmi. Thanks so much for joining us at Moneycontrol. Firstly, your first reaction to the budget. Like I said, I was mentioning to Rohit earlier, the sentiment, the newsroom was in cheers towards the end of the budget when we heard the income tax cuts over there. But somehow the market's not reflecting that mood.
Yeah, definitely. So, I would say between the two C's, which is capex and consumption boost, clearly the common man, Aka, the consumption boost has been the winner in today's budget. To that extent, near term, obviously, there is quite, it's quite likely that markets may think that, the capex growth is not as much, but one can't completely undermine the positive impact of the consumption boost that has happened today on account of tax rationalization. So I think yes, one can't completely ignore what's happening across the globe in terms of potential tariff wars, etc. So I think I would say the balance of tilt has gone slightly more towards the consumer, and I think that is the key highlight of the budget in today's outcome. Apart from the fact that yes, fiscal discipline is something which is been a non-negotiable.
Right.
Hi Lakshmi, do you see a rate cut on cards in the next MPC meeting?
So I would say it's still a toss of a coin. It's not a necessary and a sufficient condition, because globally there are a lot of things which are happening. This time FOMC was a status quo, but the clamor for rate cut over there is also happening. ECB did a rate cut. While our inflation is fairly docile, especially on the food side, the target number is nowhere near met, and currency is definitely in a volatile phase. So I think we are entering the monetary policy phase with multiple uncertainties. So I would say it's still a toss of a coin between the head and the heart. We don't know what will rule.
Lakshmi, what is the sentiment amongst high net worth individuals right now? Do you see a lot of your clients move to debt, because it seems like the equity markets are sort of, at least before today, it was looking like they were hitting a pause button. One, the relentless selling from FIIs continue. The quarterly results seem to be, not as one would have expected. So there is clearly some kind of, at least in terms of stock market returns, very muted expectation. On the contrary, we don't see rate cuts happening yet. So is the mood shifting away from equities into debt?
Well, I would say the mood is getting a little bit cautious on equities, especially the mid-market segment, and more avenues are being sought, be it some of the unlisted space. Gold, for example, is, we are constructive on gold as a asset class. Fixed income, specifically in the high yields, there is interest, because in government bonds, the yields are very, very low. It's not even high enough to attract foreign investor interest, let alone domestic interest right now. So I think while the interest for equities is not out completely, but clearly diversification tools are being sought within asset classes to just kind of deflect some of the risk, which possibly could be more vehement in the coming weeks. Volatility probably.
Okay, two more questions.
Given the fact that it is the larger pack of EM or emerging market currencies which are witnessing some sort of soft patch, and I'd say that could continue for some more time, including the rupee for now. As far as the FPI or the foreign portfolio investor selling is concerned, look, they are actually trying to diversify more from, it's getting to be more like an EM versus DM or the developed market trade. So I think that's not going to abate anytime soon. Maybe the pace can come down a little bit, but looks like so long as we do not see currency stabilize, it is very difficult to expect FPIs allocate more durably in the very near term.
Okay, Rohit, coming back to you, general interest in market has gone down quite substantially, since September last year. Since the budget in July. Trading interest has also substantially gone down. I think more than 30%, even in the cash market. Now, is the retail interest in stock market somewhat? Do you see it waning?
I think it's a bit early to say that, but definitely a lot of people who we speak to, in our clients or, essentially users of our platform, what they do say is let the market pick up and then, we'll do something. So it's more like a cat and dog thing, that this retail interest which you're talking of, they essentially feel that, okay, once the market picks up, we'll become more active. I think it's more like that. And they're just patiently waiting for the bad phase to be behind us. And once that sense starts coming back that, yes, maybe the worst is over, maybe we've put in a low and, stocks are making a comeback, that activity will probably increase all over again. So it's more like that. But there's no give up. I don't think they've generally given up on it because that's too early. We haven't really fallen that much from top to low for people to completely give up. But definitely the selling that we saw in mid and small caps was slightly disheartening for a lot of people. But the optimism is still there below the surface, but they're just being very, very patient.
Okay, while we continue to have Rohit and Lakshmi with us, can I just get a big picture question from Bodhi, who's also been patiently sort of listening into all of this? Can you give us and help us understand what exactly is the endeavor here from the government? What are they saying with this budget at this point? Is there a clear shift in strategy as we were talking about earlier?
No, it's clearly, it's a budget aimed at the middle class. There's been a lot of discontent or at least a perception of discontent on part of the middle class, the very large middle class, however you define middle class. But I think the government is also very clear. The middle class are those earning around under 20 lakh rupees, 25 lakh rupees. So it's a big tax concession to them. There is also below the level of the middle class, if you look at the gig workers, which is really low middle class, they're not tax paying, but there's also a big attempt to reach out to them to in terms of health insurance, in terms to ensure some basics. So I think that is really the message. I think the third big picture is the government cannot keep spending capex, cannot keep spending money to boost the economy. So it's up to the private sector to really step up to the table. Where the private sector actually does so, as a number of the guests mentioned, depends on demand, because capacity utilization is under 75% right now. It needs to go up somewhat. So yeah, that's the conundrum of the economy. The big picture is that the government is now going to react to some of the discontent which has been expressed, and it cannot keep. I mean, this 11. So as some of the guests mentioned, the capex in FY 25-26 is about the same as the budget estimate for 23-24. So there's actually no growth. There's a marginal growth if you look at the revised estimate for 23-24. So yeah, I mean, so that has kind of run its course, and the government is, and the fourth element of the big picture is the government is still very big on fiscal prudence. It is going to stick to the fiscal deficit target. There's an announcement also to bring down the debt to GDP ratio to 51% by 2031. It's currently close to 60%. That's now 56-57%. So they will bring it down. So there is so fiscal management remains a core element of the government, and there are elements of, there is a PM Kisan which they have, if I'm not mistaken, I think it's there somewhere, they've increased the payout. So there is so that's some kind of universal basic income and for a section of the population, although that's not. And yes, then startups, MSME. So the whole and of course the whole emphasis on Bihar, the elections in later this year. So it is reacting to the political circumstances. I think that's really the big thing. They're trying to boost consumption, and so that's really what.
Let's just pause that for a minute, Bodhi, and we can also cut across to CNBC, our sister network over there, to try and get more industry reactions. This is CNBC at CII.
Delhi right around the corner and Bihar, and that's the message the government sending out.
Yeah, I think. I think we've had pre-budget discussions. Everyone was expecting relief for the lower and middle income. But this extent of relief, I don't recollect, has been given 1 lakh crore in personal tax, which is almost, about 7 to 8% of the total personal tax collection that the government has. So I think it's a very significant relief. And overall, if you look at the overall theme from a tax standpoint, I think a lot of it is based on just simplification.
Right.
from the new income tax, 50% of the provisions coming down in the new income tax bill, that will be tabled next week. All the other things that they've also done, whether it's on TDS, TCS, all the other areas that have been laid out, a lot of that is on simplification. Also in continuity, no changes, no significant changes anywhere except addressing some, minor tweaks here and there. Unless something is there in the final, that we don't know. But this government generally, whatever is on the table. IFSC always gets, they're trying to encourage and project IFSC more. That's there. And overall, the emphasis, whether you look at the economic survey or you look at the budget, this ease of doing business. And I think it is so important to unleash the spirits and to ensure that India achieves its full potential. I think that, setting up the committee, coming out with in the next 1 year, setting up some competitiveness among states, clearly recognizing that a lot of this benefit, a lot of these things have to happen in states. I think that's a big change, and the pillars that they have identified, and focusing, some of which Sanjeev mentioned, focusing on those 4 or 5 pillars that are so critical for growth in the next 10, 15, 20 years, including nuclear power and making changes in the act. I think that was quite good to hear.
Yeah, a target of 100 gigawatts as far as nuclear power is concerned. And remember, the IEA has said that 2025 is likely to be a breakout year when we talk about nuclear energy. So India getting into the ring as far as small modules are concerned. But Chandrajit Banerjee, what the finance minister has delivered on the consumption side, perhaps some disappointment on the capex side. Clearly not on the lines of what industry was expecting or even hoping for, but it's in line with what the government has been saying. So on balance, the balance has been done and the balance has delivered?
Absolutely. Of course, we talked about a 25% more. I mean, there is no restriction to asks, but
no, clearly there isn't. Clearly there isn't.
But yes, this was expected, and one had thought about that. But if you really look at the type of spend that one sees on the capex, which is still, I mean, quite reasonable in terms of if you compare it, what goes into rural infrastructure, even this about the states that 50-year interest-free, so all of that actually would help in crowding even the private sector, which has been called a laggard, so to say, for some time. And I see that coming in because we see a focus on a lot through that will come through the consumption demand. So all in all, not really any disappointment with the capex which the government has done, because it has done more than to offset the consumption demand.
Done more than what was expected, certainly on the consumption side. Sunil Mujal, thanks very much for joining us. On balance, the big headlines, the big takeaways, what does the budget do to accelerate growth?
So actually the whole exercise, I think, was a balancing act between maintaining fiscal discipline, which the finance minister has put on herself over the last many years, at the same time figuring out a way to bring growth back in. So I think it's been done in multiple different ways. One is the building blocks, is on education, skilling, research, innovation, tech focus, that's very good. Second is picking specific sectors for high growth potential, clean energy, deep tech, so the seeds, that's a massive area actually. What they've done in agriculture is a wide coverage. What I like is also focusing on some of the fundamentals, things like nutrition, things like the elderly, things like the farmer, small industry, export capability. So it's actually fun. I'm actually broadening the answer to your question, because I don't think it's only about that. It's not only about growth. Is not something you can flick a switch and get tomorrow. But the tools have been put in place, and the point you were making just now about the higher liquidity in individual and families' hands will either go towards savings or investments or consumption, and all three will do good. Even if you say it's about 1/3 each, roughly. So you're talking about 30,000 crores coming into consumption this year. So some of it will need to go because personal and family balance sheets were getting a bit upset because there was over leverage taking place on individuals. I think some of that will go to offset that, as companies and banks have done over the last 7 or 8 years. So I think we will come out better, healthier, cleaner. I do hope, unlike what CB is saying, I was hoping that the infra spend would have been higher because this consumption takes a little bit of while for the virtuous cycle to kick in.
Right.
Consumption can start, but consumption leading into production, leading into additional capacity, leading to jobs is a bit of a time lag. So that's one miss from my side. But I guess to be able to maintain the 4.8 instead of 4.9 at the FISC was a pretty magical number.
Oh, and it certainly was a surprise that came in there after having delivered on the kind of cuts that they delivered on. But Sanjeev Puri, let's talk about those untapped sectors where the government hopes to unlock potential. Tourism, this identifying 50 cities, PPP with states, PPP with industry as well. I'm not sure what the details are, but also including hotels as part of the infrastructure harmonization scheme that they're talking about. What did you make of that? And, a lot of actually the schemes that were talked about are work in progress. The actual operationalization still has to be detailed. So what do you take away from many of the announcements that came in?
See, first of all, many of the specific interventions that are there, you alluded to some in tourism. Then there are others, for example, in exports. I think the integrated approach, cross-ministerial approach, I think is absolutely the one that is required, because in the morning also we spoke about some of the issues that have to be dealt with, which requires a cross-ministerial approach. And something CI has also been talking about, having an integrated approach. Looking at setting up this committee on ease of doing business.
Right.
And taking an integrated and focused approach on agriculture, 100 districts, all-round development.
Yeah.
Taking an integrated approach on rural, the non-farm development. Really sending some development and resilience hubs for rural areas. So these are very fine ideas, very good ideas, and certainly will unlock the potential in many areas. Creating a framework for GCCs. GCCs are already doing well in India.
And massive job creators.
Massive job creation, and the world has demographic challenge. So it's a great opportunity for India, and to provide impetus to it, to make some, today it's happening on its own. Without really any impetus of specific interventions. So right now, to create a facilitative framework for this, I think it's going to provide further impetus to it. But the whole idea about the strong point of reforms and collaborating with states. I think this will provide a lot of impetus, because a lot of reforms now need to be done at the state level. Right? So a lot of the right things are there. And I think what I'm very happy to note also is that there is a lot of clarity on the mechanisms that will be used to do it. It is not just a statement without an institutional mechanism.
Sure. Rajiv Memani, the big headline for you as I say goodbye, at least as part of this session, but the big headline that you take away from what the finance minister has delivered.
I would say identifying the critical growth drivers for Viksit Bharat, ensuring that there is, as he rightly said, that there is a focused approach.
So that was Shireen Ban talking to corporate captains from CII. We have with us Prashant Khemka, founder and CIO of White Oak Capital. Prashant, your first take on the budget.
It's a very good budget, Mahalakshmi. I think it's the best in a long time, because primarily, as I've often said, what I keenly try to read from the budget speech is what does it reflect of the government's mindset at this time. So I have, like on my notepad, I'm taking the positives and the negatives along and the single biggest thing that I'm looking for directionally is whether they're improving ease of doing business. And the reason ease of doing business is the single most important factor for me is because that leads to faster growth in a structural manner over long term. Faster growth leads to job creation, higher incomes, higher spending, higher corporate earnings growth, higher market returns, and the virtual cycle that of higher economic growth as well. In this budget, if you see, there are many instances throughout the budget that the finance minister talked about ease of doing business, either using those very words or in one form or another, as if that was actually the central theme through the budget. So she talked about, setting up in the early part of the speech, setting up a high-level committee for regulatory reform. She mentioned 4 points. I couldn't note down each one of those in details, but one of the things she mentioned is investor friendliness index for states. I hope it is something that truly turns out to be a index that the states would pay attention to and would compete with one another, as that would be would go a very long way in increasing the ease of doing business at state levels. Then she talked about evaluating impact of current financial regulation. There are a lot of regulations that are, they've outlived their utility, or in fact they've become a burden. If they ever were serving any utility, they've outlived, but many of them have never served any utility. And Section 9A, one of the things I was talking on another channel, Section 9A was a section that with all good intent was proposed by the late Honorable Finance Minister, Mr. Jaitley, in 2015, but it's been 10 years since, and it has not been operational because of a lot of handicaps that were built in and are built into that Section 9A. So hopefully all these would actually see the light of the day. A lot of announcement that came through in the Jan Vishwas bill to decriminalize 100 additional laws. This is so specific that I have to assume that would be seen through. A new income tax bill in regards with which the finance minister talked about it being simple, it being clear, simple to understand, and providing tax certainty. All these are extremely desirable for.
Sure, but how do you see the pivot from capex pressure?
Capex to consumption, all those I think are relevant in the scheme of things, but are, to me personally, and then from a White Oak perspective, are very short term in orientation. And hence I don't necessarily get very worked up with them positively or negatively. Yes, there is a little bit more emphasis on consumption that has to be expected after the elections of last year, the central elections. That was clearly the direction of the July budget as well. So in that sense, it is continuation on that front. There is nothing different. But on the more important subject that I was talking about, it is quite different from last year. This year, finance ministers talked about increasing the thresholds on TDS, TCS, and all those things. So on consumption, yes, it is more pro-consumption with the increase in the threshold of the income tax limit, and the capex budget was left at only 10% increase, which is while in line with last year. Last year or July was expected to be an aberration in the longer term trend, that is where the capital expenditure budget has been growing in the high teens, and July was just 10%. People thought, well, this February, this budget, it will go back to that high teens. So now that it's come again at 10%, market would have to possibly reset its expectation going forward to more of a 10% kind of number rather than a high teens kind of number that persisted for the prior 10 years or so. Yes, that's important, but no, I think there are more important things that were positive in the budget, as I was highlighting earlier, and the whole list that we haven't gone through.
But how do you see this shift? I mean, is this a temporary shift for this year, in the sense that all of this while we have assumed that this is a government that will continue to focus on infrastructure. That is what creates assets for India. That is what has the highest multiplier. All of that, and keeping it the same. And I'm also saying, in the context of the fact that they've accounted for 2.5 lakh crore in terms of dividend receipts from the RBI.
Yeah. You see, we'll have to see the underlying mix, how it has changed, what is growing faster, what is not growing so fast. So, for example, defense budget, which has come under stress, no doubt. But if there is far greater emphasis on indigenization of defense procurement, which has been underway for quite a few years, So Indian companies, private sector, which is still in its nascent stages, but they are producing some of the same equipment and supplies at a fraction of a cost. compared to foreign suppliers. We've been engaged with and talking to several of these defense companies, and they cite examples of supplying these ammunitions and other equipment at 60, 70, 80% lower prices than foreign suppliers. So if there is a massive push towards further indigenizing, accelerating that indigenization, there will be a big benefit to the defense sector private companies, as well as help the government reduce the budgetary allocation to defense without cutting down on any of the procurement in terms of volumes. So we'll have to see the underlying mix of where the capex has been, constrained and where it is not. But if done properly, a 10% increase, you can't grow at 18-20% capex budget at the country level when the nominal GDP growth rate is 10%. You can't do 18-20% for too long, right? Forget forever. So in that context, we have to think of, in my view, 10% as a new normal going forward. It's not as bad as it seems.
In the near term, Prashant, what would you look at as tactical bets? If you were to just, look at the next 1 to 3 month period, where do you see positive news flow? Where do you see earnings sort of starting to see recovery by the end of the year? And next year, that is for FY26, do you think we can achieve a double-digit earnings growth?
Yes, I do think we can achieve a double-digit earnings growth. That would be our base case expectation, in line with nominal GDP growth rate, say 10 to 11% corporate earnings growth. This year is going to be a bit softer, as we all know. In terms of sectorally, where we find a lot of opportunities, Mahalakshmi, at this time are in no particular order in the technology, IT services sector. I think all this worry about AI demolishing the business model of IT companies is very misplaced, and it is very possible, or just as possible, that the investments that companies, corporates globally would need to make to be AI prepared and leverage AI would result in a boom for demand of some of the IT services companies in India, particularly those who built some strength in this area and those who have been proven over time to be strong in execution and at pivoting when there are new technological changes which have always been there over the last many decades. They do come about every now and then. So IT services, we do continue to find some very attractively priced opportunities, particularly in mid-cap IT, where execution is very strong. Other sector, I would say, is
any announcements from this budget that stood out for you, that open up fresh opportunities
for IT companies, or in general?
In general.
See, in general, from this budget, no. I mean, it's positive for consumption, but we already are fairly highly exposed to consumption. So it's not that for us we can go out and buy more consumption related stocks on the back of the budget. It's good that we have considerable exposure, but if we didn't, or if someone does not have exposure to consumption related companies, might make sense for them, because this budget is not about this budget now. The July budget and this budget, now there are two budgets in row where the government has made it very clear that consumption would remain their focus. So if that's going to be the case for many budgets to come, it puts a floor below the softness in consumption that we have been experiencing over the last few quarters or couple of years. And in that kind of backdrop, there are a lot of consumption related companies which have reported weak numbers, and hence the numbers are suppressed, as well as the multiples have come down now relative to what they were at least 2 to 3 years ago. And so it would be a good idea to explore both discretionary, which includes a wide range of industries, including automobiles, retail and whatnot, and durables, as well as staples. So that would be a good area to dig deeper to identify the big success stories over the coming years.
Thank you so much, Prashant, for joining us. We have Lata Venkatesh waiting for us at the Bombay studio. Lata?
Thank you very much, Mahalakshmi. Looks like the budget has quite clearly shifted from capex thrust to consumption thrust. That seems to be the main theme. What we have seen is that the capital spend of the government is rising only by 10% over the budgeted expense, over the revised expense of this year. Next year it is going to about 11.2, from 10.2 to 11.2 trillion rupees. So the basic increase in capex is only 10%, and the government has also given away a lot of money to the middle class because the minimum tax has been raised from 7 lakh to 12 lakh. So more money in the hands of the middle class to spend. The hope therefore being that urban consumption will revive, and that will enable the economy to go ahead. It is a growth oriented budget provided consumption takes off, especially in urban areas, and there's a substantial amount of money that has been given in the hands of people who are earning 12 lakhs, people who are earning 15 lakhs. They're all saving something like 70,000 to 1 lakh rupees by way of taxes. The expectation is that they will go ahead and spend. I think we have Gautam Trivedi with us, Gautam Trivedi of Nepean Capital. Gautam, can you hear me? Okay, we are awaiting connection with Gautam Trivedi, and as soon as we can. Okay, Gautam, can you hear me?
I can hear you loud and clear.
Okay, all right. Gautam, from what the macro takeaway for me is that capex expend has been increased only by 10% over this year's actuals, but the government has given away 1 trillion rupees to the middle classes by way of tax giveaways. Would you say therefore that we must expect a consumption boost?
I think we got to take this with a pinch of salt, because the fact is, to expect all of the disposable income in the hands of the taxpayers will now be spent on whether it's cars, whether it's clothes, whether it's QSR, and eating out. I don't know if that's what the middle class will necessarily do. There'll be a fair bit of savings given the inflation is still pretty strong. And my view is that this was a very bold step to take to increase it from 7 to 12 lakh rupees, as you just said. But the reality is that I found other measures within the budget not as bold. So my view is, specific to your question on this 1 lakh crore bonanza, will the taxpayers start spending all of it, and as a result help jumpstart the economy? I don't think so.
Okay. Gautam, I'll just come back to you in 1 minute. We also have Manish Gunwani, the CIO of Bandhan Mutual Fund, with us. Let me get first thoughts from Manish as well. Manish, thank you very much for spending time with us in Moneycontrol. What are your first takeaways from the union budget?
So I think it does look like a important pivot from capex to consumption. That is the first one. Two is, the question is the intensity of the stimulus. Is it strong enough to revive consumption in a meaningful manner? I think that will obviously be open for debate. I personally feel maybe the stimulus could have been stronger, but I guess it's also a function of how monetary policy works in conjunction with this stimulus on the consumption side. So the third point is, in terms of estimates, I think the personal income tax estimate does look a bit aggressive, given that with the tax cuts, we still have a growth of 13-14%. So that, and the pension expenditure also is flattish, which may or may not happen. So I have a feeling maybe there is some risk to the fiscal numbers, although having said that, I'm not read the fine print in detail. But I do think maybe from the first glance, it does look like some of these estimates may be aggressive.
Actually, I share your skepticism on that. If you have given away 1 trillion rupees by way of taxes, income tax, you are assuming a 14.4% rise in income tax. Right. Now, we could be surprised positively, because this year if you looked at the April-December numbers, the income tax rises 22%. So possibly even after the giveaway, there will be so much growth in incomes at the higher level. It's after all a K-shaped recovery. And maybe their bet on tax buoyancy will pay off, no?
So at the margin, things like capital gains tax and all, the kind of growth we've seen last 2 years may be a bit difficult, right? Given stock markets, how they're behaving.
Fair point. They have also assumed a little more on STT. Okay, let me get the first thoughts. Aggressive. Okay, so let's see. This is the first time they're giving a charge of aggression on this government. Otherwise, for the past 3 years, Nirmala Sitharaman has actually surprised on the upside in terms of her tax collections, including income tax in FY25 itself. Even as of April-December, she is surprising on the upside. So we perhaps must hold our horses in terms of our skepticism. Let me get back to Gautam on this. Gautam Trivedi, what are your key takeaways? You said that my bet on consumption is a bit aggressive and optimistic. What are your key takeaways from this budget?
I think fact is that, as I said earlier, that the raising the exemption limit, I think is a great move. The only thing is I found less of that in other aspects of the budget. So could they have done much more to kickstart this economy? Because that's where the economy really at this point needs help. If you take out the top 6 or 7 in large industrial houses, private sector capex really hasn't taken off. So I'm not sure if this is a great time to actually think of fiscal consolidation when private sector capex is not taking off. Should you be focusing more on spending more? Because even the defense budget, they've pruned it down. The overall capex has been pruned down from the budgeted estimates to now the revised estimates for FY25. So my view is that we need more investments to come in. Yes, there has been an effort to increase consumption, but I don't know if that's going to bear fruit so quickly. There were a lot of long-term measures in the budget which were longer-term positive. For example, the FM spoke about 50 new tourist destinations. Great idea. About time we did that, but the fact is that's going to take several years to play out. So the concern is that let's leave aside fiscal consolidation for now. Let's focus on continuing the spend because that's what the need of the hour is.
Okay. Coming back to you, Gautam, Munish, what kind of stocks or sectors, therefore, should an investor bet on? The market is running away with Easy Trip, for instance, because of what Gautam spoke. The fact that tourism, at least there is a mention of tourism in Bihar and other places like that. Munish, can you hear me? Munish, you can hear me?
Yeah.
Is running away with positives for stocks like Easy Trip, for stocks like even Indian hotels, because the expectation is that all these will benefit from that tourism mentions as well as more money in the hands of people. What exactly should be the sectors one should bet on because of this consumption thrust and the other things like tourism that have been mentioned in the budget?
No, obviously things like auto, retailing, aviation, hotels may benefit. The bigger question post this initial bounce will be that ultimately these are consumer discretionary sectors and they will do well if the economy does well. So I think while relatively versus capex, this set of stocks will obviously benefit, and a lot of them have not really done all that well over last 1 or 2 years, again relative to the capex plays. So we may see a shift in the market action towards these segments. But ultimately both capex and consumer discretionary need the economy to do well. So I think we should also keep in mind that for these stocks to do well, this stimulus is enough to get us out of this slowdown which we've seen over the last 6 months or so. And I think that is also a big question.
Okay. You think that's not answered? It is not, you're not very sure that this boost is enough to get us out of the consumption slowdown that we have seen, is it?
So Lata, think about this way, you basically shifted about 1 lakh odd crores from capex to consumption. The overall government expenditure growth is very tepid. 1 lakh crore is roughly about 0.2, 0.3% of the economy. So I have a feeling, although there is no science to this, that it needs to be married with a bit of monetary and maybe exchange rate stimulus as well, rather than looking at only this 0.2, 0.3%, maybe slightly higher because some of the revenue projections, as I said, are aggressive. So the fiscal compression may not be as much from 4.9 to 4.4. Maybe we'll end up with 4.6, 4.7. But even that, essentially, the overall fiscal stimulus is actually going down in one sense. So I would preferably want to see monetary and exchange rate combined with the stimulus to be a bit more sure that whether it's capex or consumer discretionary. See, ultimately both of them are married at the hip in the sense that if consumer discretionary does well, we will have capex finally, private sector capex.
Got it.
So the bigger question is whether the economy will come out of the slowdown.
Fair enough. You think that the question is not answered. Well, Gautam, Munish, I want to thank you. Just leave me with some sectors you will bet on at this point in time. Gautam, you first.
Yeah, I think I would stick to consumption given the fact that these stocks have done nothing for the last 3 to 4 years and they finally got some benefit from this budget. So I would stick to them.
Okay. All right. Thanks a lot for that, Gautam, and thank you for joining us all the way from the Jaipur Lit Fest. That's really kind of you. Munish, which part of the economy would you bet on now?
I would say urban consumption in sector like retailing, internet platforms and auto. I think those will benefit.
Okay. Okay. All right. Well, those are the sectors that have done well today at least. So maybe the market has smelt it right. Thank you very much, Manish Gunwani, for giving us your first thoughts on the budget. We now have two other guests joining us. We have Gautam Dugar, the head of research at Motilal Oswal, and Ashish Gupta, the CIO of Axis AMC. Ashish, Gautam, thank you very much indeed for your time. Well, Gautam Dugar, I wanted to ask you about these insurance companies. We saw them suddenly tank the insurance stocks on fear that more people will shift, I think, to the new tax regime, and there will be no incentive, therefore, to perhaps go for insurance. Would you be that bearish on insurance companies as a result of the budget? Gautam Dugar, can you hear me? Okay, I think there is a connection issue. We will come back to Gautam Dugar in just a minute. Ashish, can you hear me? Well, we do have a problem of connectivity. We will try and see if we can connect once again with Gautam Dugar and Ashish Gupta, two stalwart market veterans, and they're going to tell us what they have made. Ashish, can you hear me now?
I can hear you, Lata. Am I audible?
Okay, okay. Yeah, now you are. Now you are. Thanks a lot, Ashish. Well, a key takeaway is really, do you think that the thrust given to consumption is enough to push the economy up to a faster pace of growth?
Sure. Yeah, I think, first of all, I don't think we should just look at government as the sole driver of the economy and economic growth, right? So I think we have to keep in mind the government's largest role is to creating an enabling environment for growth, right? And I think on that count, the budget has clearly delivered, because in the current uncertain global backdrop, it was very important that we maintain path to fiscal consolidation, right? And we have all seen the trend in foreign flows that has been quite negative, even though our macro has been quite solid over the past couple of years. And at this point of time, there was no real leeway for the government to waver from the path of fiscal consolidation. So we have to see the room to maneuver the government had on that front. right? So first of all, yes, they have continued on that path. Next year fiscal deficit is 4.4%. The market borrowing for next year on net basis is not going to be very.
No, exactly. Gautam, Ashish, you can't fault the logic of the government. They have decided that they will move out and hand over the baton to consumption.
Yes. So given that backdrop, whatever spending they could do, they have delivered on that, and I think they have been responsive in terms of ensuring that the spend increase has happened more in the area that had been a drag on the economy, and which was clearly consumption. And so in that sense, I think the government had done its part, both in terms of creating an enabling environment and trying to address that pocket of economy which was lacking. So I think that is it. The other thing which I think perhaps has not been spoken about as much is that the responsiveness of the government has been on another big aspect that has been dragging the economy, and which has been regulatory, right? And there were two announcements. One was setting up of a high-level committee to look at regulation across non-financial sectors, and also actually mandating the FSDC to look at financial sector regulation in terms of development of the sector, right? So I think that to my mind is an equally important step, because in addition to the other challenges that we were facing, I think the regulatory drag was also a big hurdle to growth. And I think them looking to address that, to my mind, shows that the government is being responsive to the feedback that has been coming on what has led to the slowdown.
No, I absolutely take your point, and you're one of the first experts pointing this out, that this effort to deregulate, which was there in the economic survey, the government has actually tried to walk the talk. Non-financial compliance, clearly they're reducing the burden, and on finance as well, we should hear something if the FSDC committee is going to, cut some of the regulation. Now, an added point that comes from this, the regulator and the government should act together, especially the monetary authority. Considering that the fiscal deficit discipline has been maintained, it is logical to expect that Reserve Bank will cut rates. Because that's how the RBI thinks, from what I know of 20 years of covering them. Whenever they see fiscal discipline, they are a bit more ready to cut rates. If that rate cut comes, what kind of sectors would you bet on?
So of course, see, when the rate cut comes, all of us are quite well aware of the rate sensitive sectors, whether it is related to the financial bank, non-banks, real estate, automobiles, etc. But I think what is more important besides rate cut has been liquidity, or the lack of liquidity in the last 6 months. Yes. I think you have already highlighted in multiple shows over the past week how under the new governor the stance towards liquidity is being addressed. And I think as much as the fiscal consolidation has been maintained this year, the other big document that they have put out, if you have seen the FRBM note, is that they have committed that in the next 5 years they'll get central government debt to GDP down to about 50%, right? So it's about 56%. So I think that is again a very important statement. What it means is that not that this year fiscal deficit is coming down, but the glide path for next 5 years continues to be down, and debt to GDP, particularly the central government debt to GDP, will be declining, while across the globe over the last few years we have seen government debt to GDP only go up.
Okay. Well, please stay on, Ashish. We also have Deepak Shenoy joining us, a master of stock picking. Deepak, thank you very much for your time. Let me start straight away with a stock market question, which a lot of viewers will have in their mind. Having heard the budget, what kind of sectors look attractive?
I think, Lata, the attractiveness of perhaps the manufacturing industry, the shipping industry in general, and semiconductors or electronics in general have been particularly favored, I think, in the budget. So they might possibly react quite well. The increase in perhaps up to 10,000 rupees per person will be per month. Will be an extra, non-tax, because you save about 1,20,000 rupees in tax at the maximum if you're earning more than 24 lakhs. So that's 10,000 rupees extra per month that comes in the hands of people. So I think consumption should do well. Tourism, specifically consumer durables, also likely. And if this downstream, like you said, leads to a tax cut, we might actually see quite an interesting change in even the industrial capex that comes in. So companies that have been working in capacity constrained sectors, but not necessarily trying to do more capex because they don't believe that demand will expand, those are sectors which I think will start doing capacity expansion plans. Much of that will happen in the manufacturing sector also because of the boost they've got. So I think overall quite a decent stock market related budget, but I don't think it will help a lot of people thinking that a lot more people get attracted to stock markets, because effectively 1.5 crores of income of assets can be placed in fixed deposits now by a person retiring, and they will have no tax on that income. So if you have that much money, it is actually better placed in a fixed deposit than invested in stocks, bonds or mutual funds.
Oh, okay. I didn't think about that. That would actually take away some money at the margin. But I'm betting on the fact that, as you pointed out, 10,000 rupees more per month is available to people earning up to 25 lakh. That's, I would assume, a decent number of people. Multiplied by 10,000, that's assuming they will say, they will not invest, but they will spend. We are getting some consumption-oriented boost here. Very quickly, when you say manufacturing, which specific stocks are you thinking of? Deepak?
We do have a lot. So I think there'll be a whole, whether the auto industry itself has a lot of manufacturing components to it. That is one layer. The semiconductor / electronics manufacturing industry, whether, a lot of stocks there are listed. We own a lot of these stocks, so very biased here. I think downstream will also impact infrastructure, but I haven't been able to go through the documents in detail to understand where infra is maximum affected. There is a lot more push on nuclear, so companies providing manufacturing elements to the nuclear sector, I think they will do well, whether it is water pumps or other equipment related to this. There are few listed stocks there as well. And I think tourism, so manufacturing itself, I think in the end, you have a lot of people who provide tools, consumables and other equipment to the manufacturing sector, while you have a car manufacturer, for instance, buys a lot of components use a lot of machine tools and so on. Many of those manufacturers have floundered for decades because there's not been much of a manufacturing push. That I think will massively change. Many of them are mid and small caps, so I expect a few of them to become large caps soon.
Okay, well, that's a very big hope that you're giving. At the moment, the market is not looking in that direction. The kind of stocks that are doing well, Swiggy, Zomato, Kalyan Jewellers, ITC hotels, Indian hotels. So it's consumption as far as the market can look at it at this point in time. Maybe they will, come around a little later. Ashish, I wanted to ask you, do you think that, you pointed out very correctly to that FRBM roadmap and the fact that the debt to GDP ratio will also come down towards 50. That's exactly what has been the ask of the rating agencies. Do you think we tick all the boxes now for rating agencies and we should expect, an upgrade from that quarter?
So
I think there are multiple parameters they look at, and I don't really think India's government debt to GDP ratio was very high to start with, and that was therefore the constraining factor for the rating, right? But irrespective of that, I think India's macro fundamental.
No, Gautam, sorry, Ashish, fiscal deficit was something they would keep pointing out, and we kept arguing with them that our rate of growth is higher than our rate of interest, and therefore, the old R-star argument, and therefore we should get an upgrade. I'm just asking, all things put, macros in place, and then this 4.4% fiscal deficit, are we on the path of a rating upgrade?
So, see, I agree that, and if they continue on this path, both the fiscal deficit number will also keep coming down, and I think your primary deficit will also keep coming down, right? So I think that should be taken as positive indicator, but I'm not just sure what will be the catalyst for the global agencies to change their view. Having said that, I think from the perspective of the markets, really what is important is what is the cost of capital, right? So even without the rating upgrade, given how well our macro fundamentals have improved, if you see the spread domestic yield have to global yield, that has been consistently coming down. So I think if we are doing the right thing, the market obviously recognizes it and rewards it, irrespective of the fact when the rating change happens.
Okay. Finally, Ashish, what is your sense of, first of all, would you expect a rate cut? And secondly, what sectors therefore look good to you?
So I think I'll agree with some of the sectors picked by your panelists earlier. So for example, sectors including consumer discretionary. So rather than FMCG, consumer discretionaries, auto, real estate, hotels, and of course the financial sector, including insurance, because as you were earlier highlighting, there seems to be have some inexplicable sell-off there. So I think all these sectors look good to us. I also agree that broader manufacturing continues to be fine.
Okay. Thanks, Ashish. We have to cut to the Prime Minister.
ये बजट एक फोर्स मल्टीप्लायर है। ये बजट सेविंग्स को बढ़ाएगा, इन्वेस्टमेंट को बढ़ाएगा, कंजम्पशन को बढ़ाएगा और ग्रोथ को भी तेजी से बढ़ाएगा। मैं वित्त मंत्री निर्मला सीतारमण जी और उनकी पूरी टीम को इस जनता जनार्दन का बजट, पीपल्स का बजट, इसके लिए बहुत बहुत बधाई देता हूं। साथियों, आमतौर पर बजट का फोकस इस बात पर रहता है कि सरकार का खजाना कैसे भरेगा, लेकिन ये बजट उससे बिल्कुल उल्टा है। लेकिन ये बजट देश के नागरिकों की जेब कैसे भरेगी, देश के नागरिकों की बचत कैसे बढ़ेगी और देश के नागरिक विकास के भागीदार कैसे बनेंगे, ये बजट इसकी एक बहुत मजबूत नींव रखता है। साथियों, इस बजट में रिफॉर्म की दिशा में महत्वपूर्ण कदम उठाए गए हैं। न्यूक्लियर एनर्जी में प्राइवेट सेक्टर को बढ़ावा देने का निर्णय बहुत ही ऐतिहासिक है। ये आने वाले समय में सिविल न्यूक्लियर एनर्जी का बड़ा योगदान देश के विकास में सुनिश्चित करेगा। बजट में रोजगार के सभी क्षेत्रों को हर प्रकार से प्राथमिकता दी गई है। लेकिन मैं दो चीजों पर ध्यान आकर्षित करना चाहूंगा, उन रिफॉर्म्स की मैं चर्चा करना चाहूंगा जो आने वाले समय में बहुत बड़ा परिवर्तन लाने वाले हैं। एक, इंफ्रास्ट्रक्चर स्टेटस देने के कारण भारत में बड़े शिप्स के निर्माण को बढ़ावा मिलेगा, आत्मनिर्भर भारत अभियान को गति मिलेगी। और हम सब जानते हैं कि शिप बिल्डिंग ये सर्वाधिक रोजगार देने वाला क्षेत्र है। उसी प्रकार से देश में टूरिज्म के लिए बहुत संभावना है। महत्वपूर्ण 50 टूरिस्ट डेस्टिनेशन, वहां पर जो होटल्स बनाएंगे, उस होटल को पहली बार इंफ्रास्ट्रक्चर के दायरे में लाकर टूरिज्म पर बहुत बल दिया है। इससे हॉस्पिटैलिटी सेक्टर को, जो रोजगार का बहुत बड़ा क्षेत्र है, और टूरिज्म जो रोजगार का सबसे बड़ा क्षेत्र है, एक प्रकार से चारों तरफ रोजगार के अवसर पैदा करने वाला एक क्षेत्र को ऊर्जा देने वाला काम करेगा। आज देश विकास भी विरासत भी इस मंत्र को लेकर चल रहा है। इस बजट में भी इसके लिए भी बहुत महत्वपूर्ण और ठोस कदम उठाए गए हैं। 1 करोड़ पांडुलिपियों के लिए संरक्षण के लिए, मैन्युस्क्रिप्ट के लिए ज्ञान भारतम मिशन लॉन्च किया गया है। साथ ही भारतीय ज्ञान परंपरा से प्रेरित एक नेशनल डिजिटल रिपोजिटरी बनाई जाएगी, यानी टेक्नोलॉजी का भरपूर उपयोग किया जाएगा और हमारा जो परंपरागत ज्ञान है उसमें से अमृत निचोड़ने का भी काम होगा। साथियों, बजट में किसानों के लिए जो घोषणा हुई है वो कृषि क्षेत्र और समूची ग्रामीण अर्थव्यवस्था में नई क्रांति का आधार बनेगी। पीएम धन धान्य कृषि योजना के तहत 100 जिलों में सिंचाई और इंफ्रास्ट्रक्चर का डेवलपमेंट होगा। किसान क्रेडिट कार्ड की लिमिट 5 लाख तक होने से उन्हें ज्यादा मदद मिलेगी। साथियों, अब इस बजट में 12 लाख रुपए तक की आय को टैक्स से मुक्त कर दिया गया है। सभी आय वर्ग के लोगों के लिए टैक्स में भी कमी की गई है। इसका बहुत बड़ा फायदा हमारे मिडिल क्लास को, नौकरी पेशे करने वाले जिनकी आय बंधी हुई है, ऐसे लोगों को, मिडिल क्लास को इससे बहुत बड़ा लाभ होने वाला है। उसी प्रकार से जो नए नए प्रोफेशन में आए हैं, जिनको नए नए जॉब मिले हैं, इनकम टैक्स की ये मुक्ति उनके लिए एक बहुत बड़ा अवसर बन जाएगी। साथियों, इस बजट में मैन्युफैक्चरिंग पर 360 डिग्री फोकस है, ताकि एंटरप्रेन्योर्स को, एमएसएमईज को, छोटे उद्यमियों को मजबूती मिले और नई जॉब पैदा हो। नेशनल मैन्युफैक्चरिंग मिशन से लेकर क्लीन टेक, लेदर, फुटवियर, टॉय इंडस्ट्री जैसे अनेक सेक्टर्स को विशेष समर्थन दिया गया है। लक्ष्य साफ है कि भारतीय प्रोडक्ट्स ग्लोबल मार्केट में अपनी चमक बिखेर सके। साथियों, राज्यों में इन्वेस्टमेंट का एक वाइब्रेंट कॉम्पिटिटिव माहौल बने, इस पर बजट में विशेष जोर दिया गया है। एमएसएमईज और स्टार्टअप के लिए क्रेडिट गारंटी को दोगुना करने की घोषणा भी हुई है। देश के एससी, एसटी और महिला जो नए उद्यमी बनना चाहते हैं, उनको 2 करोड़ रुपए तक के लोन की योजना भी लाई गई है, और वो भी बिना गारंटी। इस बजट में न्यू एज इकोनॉमी को ध्यान में रखते हुए गीग वर्कर्स के लिए बहुत बड़ी घोषणा की गई है। पहली बार गीग वर्कर्स का ई श्रम पोर्टल पर रजिस्ट्रेशन किया जाएगा। इसके बाद इन साथियों को स्वास्थ्य सेवा और दूसरी सोशल सिक्योरिटी स्कीम्स का लाभ मिलेगा। ये डिग्निटी ऑफ लेबर, इसके प्रति, श्रम एव जयते के प्रति सरकार के कमिटमेंट को दर्शाता है। रेगुलेटरी रिफॉर्म से लेकर फाइनेंशियल रिफॉर्म्स, जन विश्वास 2.0 जैसे कदमों से मिनिमम गवर्नमेंट और ट्रस्ट बेस्ड गवर्नेंस के हमारे कमिटमेंट को और बल मिलेगा। साथियों, ये बजट न केवल देश की वर्तमान आवश्यकताओं को ध्यान में रखता है, बल्कि हमें भविष्य की तैयारी करने में भी मदद करता है। स्टार्टअप के लिए डीप टेक फंड, जियोस्पेशल मिशन और न्यूक्लियर एनर्जी मिशन ऐसे ही महत्वपूर्ण कदम है। मैं सभी देशवासियों को एक बार फिर इस ऐतिहासिक पीपल्स बजट की बधाई देता हूं, और फिर एक बार वित्त मंत्री जी को भी बहुत बहुत बधाई देता हूं। बहुत बहुत धन्यवाद।
बाजार नहीं है, आपने कहा बोर्ड का गठन करेंगे। अच्छा, जो बात आप 10 बार पहले रिपीट कर चुके हो केनाल के बारे में, उसको 11वां बार लाते हो। मतलब ये तरह तरह से घुमा के आप आवाज करते रहते हो, नई बात कभी होती नहीं है। शराब बदल जाती है, बोतल वही रह जाता है। आपने 12 लाख लोगों के लिए टैक्सेस किया, और आप हमको 10 लाख से 2 लाख बढ़ा दिया।
Investment thrust because of this consumption. Deepak Shenoy is still with us, and in a minute we'll be joined by Mr. Dinesh Kanabar as well, the tax expert from Dhruva Advisors. But first let me get to Deepak Shenoy. Deepak, after listening to what the Finance Prime Minister has also said, what would be your look at financial stocks? I mean, NBFC stocks are doing well. It looks like there's more money and therefore more people will take personal loans. Any NBFC stocks you would like?
I think we've seen the results here, Lata, and I think that as much as we've seen, there are obviously, I think there's a clear differentiation between some NBFCs that have had too much of a reliance perhaps on unsecured personal loans, and others that are more broad-based. I think unsecured personal will come back because eventually a lot of even business loans at the small sector happen as unsecured personal loans because they may not have any pakka collateral to give. Even their houses may not be collateralizable and so on. So I think when RBI makes a clearer stance about how they may not be necessarily, not they were telling people not to give unsecured personal loans and the growth to slow down the growth. Now that the growth has slowed down, I think they should be more open about it. But once that happens, I think that will increase, across the landscape, whether it is private capex at the small level or it is actually for consumption. Loans should probably go up a little. NBFCs, I think, other than the microfinance sector, where I think we have a little bit more of damage to go, we should perhaps see a much better scope for it in the next year. I would, however, focus on some of the larger banks. They seem to have more diversified portfolios, can participate in corporate capex as well. So I think they may give you a better edge compared to an NBFC right now.
Okay. And finally, the other piece of the financial space where I would like your views, insurance. You know, immediately after the finance minister finished her speech, we saw this tanking of insurance stocks on the, I would assume the reasoning that because there is so much of a benefit now to be in the new tax regime, there are no tax incentive-led insurance policy buying. Otherwise, people were buying insurance policy to take advantage of the tax benefits. Now that is not there. So insurance companies fell, but the stocks have risen again. Where are you on the insurance, both life and health?
So I think, firstly, I think health is a necessity now. It's more, I don't want to take it for the tax benefit. I take it because, if I go to hospital, somebody else is going to pay. I don't have to pay out of my pocket. That is the reason why insurance should have been bought in the first place. But for 40 or odd years, we've kind of looked at it primarily as a tax saving thing. Now, when you remove the tax saving, the real advantages come to the fore. For instance, we are underserved from a term insurance premium. Most people don't have term insurance when they should, and perhaps instead of looking at it primarily as a tax saving thing, they should look at it as a protection product. ULIPs have actually been made more attractive. Even if you invest more than 2.5 lakh rupees in a ULIP, the problem till yesterday or till this current financial year is the maturity amount, whenever you take them out, were taxed as income. So if you're at the highest tax bracket, even up to 39% of it was taxed. But now they've said, listen, that is just capital gains. So only the profits will be taxed, and that too at 12.5% because it's considered equity taxation. So that I think that ULIP part of the mechanism can be a boost because some of these insurance companies have been performing very well even in their insurance investment products. They have been looked at from a tax saving perspective. Now they can be looked at from a primarily performance perspective as well. So I think that may change the game. I think wider, more spending, more consumption will actually lead to more insurance growth. We just don't have the penetration, and we shouldn't have done it with tax advantages. So now I think it's better off for them longer term. I hold insurance companies. So I'm very biased, but I think it's actually long-term positive.
Okay, just top 3 stocks before I let you go.
Good question. I think we have to look at shipbuilders again. The profits have been, the policies have been quite interesting. There's a few public sector, whether it's Mazgaon or GRSE or others, but there's that. I would look at the nuclear sector. We have a few stocks there, KSB for instance, and so on. In the vehicles, where I feel there will be a revival because of the extra money in the hands of, in the pockets of people, looking at M&M, perhaps even a Maruti, and so on. So those, plus we have a bunch of mid-cap, manufacturing-oriented companies. Won't take too many names, but we're buying most of these. And I would, right today we're not trading, but we'll look at it freshly on Monday. I think very interesting sectors. We'll, a lot more will come. I haven't gone through all the memorandums. I'm sorry, but it looks like it's a shopping time now.
Oh, okay. No, actually, that's the biggest advice you're giving in terms of shopping time. And I would believe that, the rupee has fallen enough and the stocks have fallen enough. So maybe at some point in time, in the not too distant future, foreign investment sentiment will also turn. Deepak Shirai, pleasure having you with us. Thank you very much for joining us. We have now 2 economists joining us, and I think Mr. Dinesh Kanabar was waiting. I'll check if I can get him as well. But first the economists, we have Kanika Pasricha of Union Bank, and in a minute Devendra Pant of India Ratings will also be with us. Kanika, your thoughts on first the tax assumptions. The budget has assumed a 10.1% nominal GDP growth, and it is assuming a 15% growth in income tax. I think 14.4 to be precise. Is that an assumption that you find credible, considering that they have given away 1 trillion in terms of tax, tax reductions?
So, Lata, first and foremost, before even I make a comment on that tax assumption, if you remember yesterday when we ended the discussion on economic survey, the point was need for demand stimulus. We asked for it, we got that, At least that itself is a sentiment booster. Now, coming to the tax assumption, of course, if we adjust for 1 lakh crore loss on income tax, then the growth comes out to be 22% this year, almost for income tax in receipts in FY26 versus 20.3% growth in FY25. Of course, that assumption itself was on a slightly more optimistic base, and then adjusting for it's at 14%. Somewhere it's showing what economists usually call as the Laffer curve, that when you cut tax rates, more people start paying taxes, the compliance also improves. So maybe that's an underlying assumption. The government has been able to manage strong growth in income tax purely on the basis of compliance as well. Even the nominal GDP growth has been sub 10% for the last 2 years. That looks like an assumption. We wouldn't want to call it not so credible at the current juncture. Let's see how the year goes. If we see a repeat of FY25, they will be able to manage even 14-15% with the tax cuts.
No, actually, I agree with you that for the last 2-3 years, for the first time in my coverage of budgets, the tax collected has been higher than what the budget has assumed. I mean, even for April, December income tax, the rise is 22%. The budget estimates had factored in only about a 15-16% rise. So I agree with you that income tax in particular, not corporate tax, but income tax has surprised on the upside, and if anything, the finance minister could be accused of being conservative in her assumptions. But now we are in a different situation, and Devendra Pant of India Ratings has also joined us. Dr. Pant, I wanted to ask you exactly that. The GDP assumption is very conservative at 10.1%, no 6.3 to 6.8 real and 10.1 nominal. I mean, I would assume that they cannot be accused of an aggressive assumption. But income tax, after a giveaway of 1 trillion rupees and likelihood of STT and capital gains not being that good, if you look at the state of the stock markets now, do you think that the income tax assumption of 14.4% growth is aggressive?
Look, I don't think so, because if I look at how the income tax collections have been in past few years, so if I look at FY23, 24 and 25 growth rate, that number gives a growth rate of average growth rate of 21.8%. So in 23 it grew by 19.7, 24 by 25.4, and 25 is 20.3. Now on top of that they have assumed a 40.1. So look, what these numbers are telling me, this is not just the natural growth which is coming because of growth buoyancy. There is a lot of improvement in entire tax administration and the way the tax are collected, and the leakages in the systems are getting plugged in. Now, because of that, we are looking at this number which are way too high.
14.4.
Now, if I look at that, if I add that 1 lakh crore into it, the growth number, including like 14 lakh 38,000 crore, on that I add another lakh crore, gives me a growth of 22.4%, which one can say maybe marginally higher than how we have done on an average last 3 years. I'm not counting FY22, because if one looks at 22, then I have to take the FY21 when there was a degrowth. So not much. The only issue which where could be a problem is the corporate tax. Unless I agree with you. The corporate performance is almost like 60% better than what it is right now. 7 points on 7.6, there's a growth of 10.4%. So that looks big.
No, I take your point. Dr. Pant. I'm hurrying you because, we have also a market to trade and speak about. So I want to rush as many questions as possible with my economists as well. And I take your point. The only thing I'll say in favor of the government is that it is not wrong to assume that corporate income tax will grow along with nominal GDP. Nominal GDP 10.1, corporate tax 10.7. On the face of it doesn't look bad, but yes, this year's experience does make it look a little confident. Now let me get the first three economics questions from my two economists quickly going. First, Kanika, rate cut. After all, there's fiscal discipline delivered. So, rate cut?
Yes, Lata. A 25 basis points rate cut expected next week, and a repeat of another 25 basis points in April.
Okay, Dr. Pant?
I'm on the other camp. More than rate cut, the easy liquidity. Because that easy liquidity will take care of it. Because what is happened till now, we don't know how the US and tariff is going to play out. The weakening of rupee has added pressure on the inflation. So I think this is the time when the caution is required. So, and even if you look at the relationship between real rate and real investments is very weak. So if yes, there is a demand boost, the rate cut should follow, but not rate cut should not precede the demand. Demand has to come and then the rate cut.
But, I'll tell you the argument of the other camp, and that is related to my next question. That's why I'm asking you that. The other camp says, see, Indonesia cut in the face of, the dollar strengthening, and that currency didn't go rudderless. Secondly, they also point out that the money that's coming to India is not debt money. It's not coming because of interest rate differential. India is always a growth magnet. People come here because it's a growth economy. And a rate cut normally prods on growth. So that is my question to you. Is this budget good enough to bring us back to the growth path? After all, we have skid down from the 7% plus 3-year track record to 6.4 in the current year. Is this consumption boost enough to give us back a higher growth?
Look, Lata, if you look at it, which are the growth engines? So growth engines, external growth engine is not there. But we have to look at the internal growth engine. Internal growth engine right now is consumption and demand. So consumption, yes, this has given a big boost. Now with the consumption boost, right, how the inflation is going to behave. If I go to the theory and say like your inflation respond to the demand, and if already with the low consumption demand, then inflation was high with the 1 lakh crore kind of consumption boost. Yeah, and everything will not be consumed, but there will be consumption. Ultimately, unless the inflation comes down, the significant or sustained consumption boost is unlikely to be there. So I am in the camp where wait and watch. Yes, the inflation is coming down. Yes, the government has given the boost. There will be demand. But if you look at the economic survey, 6.4 to, even if I go at the upper end, 6.4 to 6.8, that is not significantly different demand. And what we had seen, both consumption response and the investment response to the real interest rate is not very strong. When we talk about the investment, it's the demand which is there, which is more predominant and which respond to investment respond to demand more compared to the interest rate.
Okay, fair point. Kanika, the same question to you. Actually, that's the central question. We have to get our growth mojo back. Does this budget push the envelope in that direction?
So, Lata, let's twist it around a bit and let's look at the discussion we were having yesterday. When the economic survey came out, we said 6.3 to 6.8 looks relatively credible. At least they're acknowledging that maybe 7% is difficult. But even this may face a downside risk.
No, my pointed question. No, Kanika, my pointed question to you is, will we grow faster in FY26 compared to FY25? And can the roots be traced to the budget? My pointed question is that does the budget push the envelope on growth?
So in my view, Lata, yes it does. And on 3 counts. First count, sentiment booster. For the first time, we see the budget talking about the word trust and deregulation coming to fruition via high-level committee. That's actually declogging a big issue of ease of doing business in the economy. Of course, execution is important, needs to be watched, but at least a positive sentiment. Second, demand side, when you say below 12 lakhs, the income tax rate has been reduced to 0, what it means is that people with a maximum marginal propensity to consume are being given maximum income surplus in their hands. That's a big positive. Third point is that somewhere it starts to oil the system when you're looking at labor intensive sectors, MSME, labor intensive sectors, again a big focus area. So in my view, yes, execution needs to be watched, but at least the initial starting point is key and is a big positive. So if you're looking at only 6%, below 6.4%, closer to 6% growth in this year, there is likely to be some kicker in FY26 versus FY25.
Okay, well, that's very important if you're thinking that growth does get a kicker, but we'll have to wait and see. I mean, there are enough people betting because of global headwinds that the pickup may not happen. There has been a boost given even to tier 2 cities to allow more GCCs to come in. If things work out as expected, then perhaps the global headwinds will not hurt as much, because in any case, we are not a goods exporter. Our services exports have actually surpassed goods exports in the last data, in the last available monthly data, that is December. So we can perhaps keep our bets on over there. The final question for me to both my economists is on rating upgrade. Dr. Pant, first of all, your comment, there is a nice glide path given
Sorry,
pages.
Lata, because of compliance and it's a different group altogether, I'm sorry, I'll not be able to say anything or comment anything on that. Coming from a rating agency.
All right, I can understand. I forgot.
Yeah.
I forgot you're from a rating agency. I'm sorry. I just looked at the two economists I have with me. Let me ask Anika on that. There is a glide path given on debt to GDP. Do you think that this puts us in a good position for a rating upgrade at all?
So, Lata, frankly speaking, I would say just 2 to 3 points more. First point, at least the finance minister has acknowledged that they come from a long-term roadmap perspective. They have tried to marry the debt dynamics with fiscal numbers. Focus on fiscal consolidation remains, which raises the possibility of a rating upgrade at the current juncture. But there was just other metrics to watch out for in that rating upgrade as well, which was a rise in the per capita income. In fact, even ease of doing business is also taken into account. So if you look at other indicators, maybe they also will be crucial in deciding on that rating upgrade, but purely on fiscal dynamics, given the firm focus on fiscal consolidation, positive move in terms of rating upgrade in my view. Thanks.
Okay, well, fair point. I would think that the situation is propitious, but we have to deliver on growth. I mean, ultimately, India is a growth story. We got away with a higher fiscal deficit compared to other countries rated BBB minus because we had growth. We always said that our rate of growth, nominal rate of growth, is higher than our rate of interest, and therefore we shouldn't worry about the higher fiscal deficit. We have to get that growth mojo back. Dr. Pant, what is your growth forecast for FY26, and has it changed because of the budget?
Yeah, no, because some amount of this was in the forecasters' assumptions. So we are at 6.6%. Yes, the income tax exemption limit going to 12 lakh. I don't think anybody has expected that. Most of the people were expecting a couple of lakhs of maybe going to up to 10 lakh odd or so, but it has come at 12 lakh. We have to see, because ultimately if the more is coming from the upper end, for say for example, more benefit is coming to all three people who are in this program, unlikely that it will have major impact on the consumption. At the bottom end, the people at the 12 lakh or so, they have a benefit of I think 30,000 rupees. We have to look at how that will translate into what level of consumption growth, but unlikely that there will be major difference in the growth number post budget.
Okay, so what is your number exactly?
6.6.
Okay. And Kanika, what are you
6% of
working with for FY26, correct?
Yeah.
Dr.
Yes.
Pant?
Yeah.
Okay. And what is the
6.6 for FY26.
just for curiosity, what is the FY25 number?
Ours was 6.4 on 18th December 24. It came in at 6.4.
Fair enough. Okay. Yeah, we'll have to wait and see now. We will know on February 28 whether we can bank on that 6.4 number. There are some who are a little worried after looking at the corporate results, whether the third quarter will deliver what was expected of it. But let's wait and see. Let's ask you also, Kanika, what are your two numbers? FY25, FY26?
Yeah. So for FY25, we were also at 6.4, but that assumes 7%, around 6.8, 6.9% for H2. December tracking 6.2 makes us believe that the 6.4 will be closer to 6.2, 6.1. And FY26, we are maintaining at 6.5 at the current juncture. Yes, we'll watch out for the impact of budget announcements, which looks on a slightly positive bias.
Okay. All right. That's at least a confident number. 6.6 sounds better than the 6.4 number. We will wait and see whether we are unable to or able to make that number. Dr. Pant, do you think that we have heard anything in the budget to resolve the food supplies problem? You know, our inflation is not really a core inflation problem at all. That's been running under 4% for quite some time now. It is a food inflation issue, and there were specific references to vegetable growing as well as to pulses, to the oilseeds mission. Given the gamut of announcements, are you getting a sense at all, and of course given the Rabi harvest, that we have got the inflation beast under control, that starting from Jan we are going to see a lower inflation reading?
So Lata, there are two things. A, are you talking about the budget? In budget, I heard about some block level and other
both. Sorry, both. Both. There were. I wanted to ask you a budget impact as well on incentives given to agriculture and horticulture, because there was a mention about FPOs. About oilseeds mission, about pulses. So there were some statements here.
Yeah, I think if these things, as we discussed earlier, the execution is the key, and if we start building the warehouses and all those, it will take time. So if I look at next 3 to 4 months, how the food inflation will pan out, it will be more on back of increased supply or the better Rabi harvest or the winter period where the vegetable prices goes down. We have this mission for isopom from, I don't know, from 2 decades or 3 decades. It hasn't helped much. It hasn't helped much. Because at the end of the day, you have the limited area, and that cropped area has to, so it has to be allocated between different crops, and the farmers do their own acreage allocation based on their own judgment and what kind of market prices they are getting. So until unless there are productivity gains in the agriculture, where with the less area you can grow more. Till that time, this kind of, whether the top spot, OTP, whatever one may say for tomato, onion and potato, and the pulses, edible oil, this will keep on having pressure on food inflation.
That's right. Yeah, I know it's a much larger problem. It's also a question of our minimum support price almost becoming now a structural problem. There is no way the MSP is falling, it's always rising. Thank you very much, Dr. Pant and Kanika, for giving us the economic backdrop. It is the last 20 minutes of trading, and so we have to come back fair and square to the stock market. The economic backdrop has been analyzed where economists are slightly positive. Both of them have a slightly higher economic growth forecast for next year compared to this year. So to that extent, we have a positive handover from the economists. Let me invite our stock market expert, Nilesh Shah of Envision Capital has joined us. And in the studio in a minute, I will also have Prakash Devan, the independent expert, with me. Nilesh, thank you very much. I know it's been a hectic day for you, and I'm deeply grateful for the way in which you have handheld all of us across Network 18. But first up, the budget looks like is a big bet on consumption. Until last year, the first 3 or 4 years, it was a bet on capex. Now it's a bet on consumption. Would you buy the bet?
Well, thanks, Lata, for having me on the show. But clearly, I think obviously over a period of say 5 to 7 year period, at times you do have differing allocations. It's just that the tax cut for the middle class, which is raising the income tax limit, clearly I think is a huge booster dose for consumption. But having said that, it doesn't mean that it doesn't do enough for the capital goods kind of space, because the government is still basically budgeted for an increase in the capex. Within that, of course, for some sectors, some subsectors, there would be probably lesser allocations, for some a few more. But on the whole, the cap goods opportunity, the cap goods story, or the growth coming in because of capex, I don't think that's materially altered. Yes, it's a bit lower versus market expectations, but I clearly think that probably in a day or two, the market will essentially digest that. And the order books have been, increasing for a lot of the companies in the cap goods space. But yes, I totally agree that this is essentially a budget which is expected to deliver a booster dose for consumption. And because the raise in the tax exemption limit is quite material, quite substantial, and is going to kind of positively benefit a whole kind of a very large section of the population. So clearly believe that yes, this budget is clearly scores totally in favor of consumption.
Okay, well, let me just take that one step ahead, because this is something which most of the experts whom I quizzed are not giving such an all-out yes to my question. That is on retail loans. Every target customer for a bank now has about 70,000 to 1 lakh rupees more in his pocket if he is earning between 12 lakh and 25 lakh. That's enough for a loan to start with for a consumer durable. So how do you look at the finance sector itself? NBFCs, they're all giving personal loans. Anything in that space that becomes extra attractive?
Clearly, yes. This again, budget, basically the tax cuts or the raise in the tax exemption limits totally increases the eligibility for loans for retail individuals. So to that extent, banks or NBFCs or fintechs, which are into both giving loans or in distributing loans, that as a pack clearly I think benefit. It clearly means more business for them. But again, out there, Lata, a couple of things are we will have to watch out for. One is essentially what the Reserve Bank of India does next week in terms of rate cuts, whether it goes in for a rate cut, and second is by how much. So that's one. Two is clearly for retail loans, individual loans, personal loans, unsecured loans, there have been some kind of a bit of a pullback from the regulator in terms of the regulatory restrictions, in terms of the limits, the capital provisioning, or I would probably say maybe some bit of advisory as well, saying is, guys, be careful on giving these loans. So we'll have to see if there's any message which is coming in from the Reserve Bank of India next week on this front as well. I think if the message is loud, clear, positive, constructive for retail loans, personal loans, then I probably think that you will clearly see again once more buoyancy or vibrancy in amongst the lenders, the banks, the NBFCs and the fintechs.
No, it's a fair caution what you're saying from an investor point of view. All I can say as a Reserve Bank reporter is that, the Reserve Bank's caution was not misplaced. They saw unsecured loans growing at 30% when nominal income of the country is growing at 10%. So it was well-deserved caution. I don't think they were against unsecured loans. They were against the scorching pace. Prakash Diwad is with us. Prakash, rather than me putting stocks in your mouth, you tell me, at this point in time, if I gave you 100 rupees doesn't get you any far. 100,000 rupees. Where will you go? Where will you go?
Well, I'm okay with 100 rupees as well. So I think as Nilesh was also explaining, the budget has thrown up a lot of opportunities. Some of them could probably be a bit distant in terms of timelines. There's nothing that you need to scramble and buy today.
but the consumption juggernaut would take its own time to kind of feed back into the economy and make things look positive. From that perspective, look at, so I was telling somebody, this is a budget which actually talks about kharchega desh ka. That's what they want. That's what they want each of us to do. And from that perspective, if you look at hotels, airlines, QSR, retail, apparel, footwear, everything could probably do well, but all of it will take some time. The other good thing is that they've also tried balancing investments into, channelizing investment into the right way. The TDS limits from 50,000 to, I know personally what happens at home, the TDS
big pain, yes.
inhibitor to place more FDs in banks and all that. Money could come to the banks at the right time.
Especially for senior citizens.
Yes, it is.
And they are the FD-oriented people.
Yeah, there's a huge percentage of them who actually avail of FDs as a allocation. Look at how AMCs could benefit. Mutual funds will probably take away a big share from the insurance ULIP substitution. You'll probably have the new product, the 10 lakh product that's being kind of conceived. So overall, all of this is going to be positive. But I think the smart money is going to wait till 7th of Feb.
That's another. For what Nilesh
that's another milestone. I don't think you need to be in a hurry to kind of chase consumption. Yes, FMCG stocks from a valuation perspective have been soft for quite some time. They've come off 40-50% from the peak. So you will see a recalibration out there. But it all depends on how the RBI policy supports this. So then it becomes proper tailwinds for the economy to chug along. But very positive. I don't know why the market didn't like it. Probably it's a semi-holiday kind of a mood. So a lot of the institutions won't be active. And the second thing is there were too many expectations built. Morning we were talking about capex, we were talking about defense, we were talking about those things. But that might continue a bit at a pace which is moderate.
That's exactly what Nilesh was saying, right?
It's just relative expectations vis-a-vis what.
So what are you buying? You didn't give me my list.
So I would buy Indigo, I would buy Thomas Cook, and I'll tell you, I was looking at Thomas Cook attempted to get into medical tourism a few years back, and then the pandemic kind of upset the thing. Great balance sheet, it's off 40% from its peak. Very good company, good pedigree. These are nuggets that you would start looking at, but it'll probably be a bit more bottom up also. But yeah, I mean, so Indigo, Thomas Cook, Bata on the footwear side, and I do like smaller names as I said.
I think ITC
hotels
is screaming for attention, while the main ITC is probably taking away all the attention. But I think hotels, Indian hotels, ITC, smaller ones also, the way the Kumbh Mela has demonstrated the cascading effect of religious tourism, if I were to use that term, there's going to be a lot of replication of that you'll probably see a lot of festivals happen with much more fanfare now. So that's the thing. And look at mining, there's been so much of an impetus, we need all of that. There's a company that's into recycling, for example, does a lot of lead recycling called Gravita, again very good business is available. So I have a lot of stocks which are coming to my mind in terms of appropriateness in that sense, but of course you have to do your due diligence in terms of valuations and all of that. But this year we are going to be busy buying a lot of new things, sectors that probably were not very abuzz.
That is even without
additional spend, I am quite positive on it given its fundamentals. So that's the kind of thing, you'll have a more bottom up thing eventually. Right now you might be doing a top down thing, but wait for 7th and then we'll have a slightly more decisive list of sorts. But I just want to recall 1st of Jan or 31st of December when we were doing a show of skeletal team strength, and I was very hesitant, very reluctant to name any stocks because I said this is not the time to buy. And I continue with that the valuations are kind of getting in that comfortable zone. So we'll definitely make up for that.
I snatched Nilesh from my CNBC colleagues. Now my CNBC colleagues want to snatch you from me. So thank you very much.
My pleasure. Yes. Thank you.
And, Nilesh, I've got you with great difficulty, so I'm not going to let go of you very easily. Consumption, would you still prefer discretionaries? In the morning you were extremely gung-ho on the e-commerce guys. Does that still remain your best bets? Nilesh, if you can hear me?
Yes, I can hear you.
Yeah. So e-commerce, would that be the first bet? And within the consumption, are you at discretionary or are you with the staples?
So clearly, Lata, I think, consumption is the bedrock of the Indian economy. We still remain a substantial consumption-driven economy. We probably have the largest pool of consumers globally. So probably, it's the best probably opportunity that any investor has. And within that, I clearly believe that all the platform companies with the use of technology have created digital platforms, which is helping them to reach out to hundreds of millions of consumers right across the country and offer them different products and services. So clearly, I clearly believe that within consumption, the top pick would essentially be the businesses which have created very successful online digital platforms. So that's really the top choice. If I were to kind of move on to basically the consumer product companies, it would clearly be the discretionary companies. Because I think the days of, businesses around soaps and shampoos have become relatively mature. Those markets have already probably reached about 70% or maybe 75% penetration levels. However, we are in aspiring India, we are a growing India. I think the consumption patterns are changing, consumption basket is changing, and this clear shift towards more of the discretionary stuff, which is around travel, which is around beauty, which is around personal care, which is around probably bakery stuff, all of that kind of stuff. And so clearly, within the consumer product space, we're betting more on the discretionary stuff versus the non-discretionary stuff.
Okay, fair point. I mean, it is a K-shaped recovery after all. I take your point on that. Well, let me come to the capex segment as well. There was no mention much about defense, and those stocks anyway had run up. But in that entire non-consumption side, manufacturing capex side, is there anything that still draws your attention?
So we continue to be very constructive, Lata, on the entire capex side, and there's really lots to pretty much pick and choose from and focus on. But clearly the three or the four favorites have been clearly around railways, defense, water and energy. I mean, these are really the four sectors where a lot is happening, a lot of investments are happening. And probably the market today is reacting as if there were no allocation to railways or defense or some of these sectors, but clearly there is a growth in allocation. So clearly I think this space is fantastic, and within that, in fact, some of the bellwether cap good company stock prices have corrected by 30 to 40% from their peaks. So clearly a lot of the excesses are out. It's more a question of these companies kind of delivering 1 or 2 quarters of more steadier performance, which probably will get the price back and get back the investors' interest. So I'm not too worried about the space. We continue to like it and see this current correction as an opportunity to kind of be positive and buy into them.
Okay. What about insurance? The market sulked a lot because everyone will go to the new tax regime, and so they won't get into insurance because of the tax set-off. That kind of worried the insurance stocks. But in the finance space, broadly, you said that you will like the personal loan lenders only after you hear the Reserve Bank on Feb 7th. But what about the insurance piece?
No, I clearly believe, in the entire financial space, there are different pockets. We still continue to like the retail lenders, the payment companies look attractive, and the insurance space also looks very attractive. It's just that versus the insurance providers, it's essentially the insurance distributors or the online platform for insurance has been, more attractive for us over the last maybe, 2 to 3 years, and we've been liking that more. And that has led to, underperformance of a lot of the standalone insurance companies. But within that, I think the health insurance companies, standalone health insurance companies, I think that's really a segment one has to start to get constructive about, in addition to the online distribution platform. And why I say this is because, first of all, health insurance is growing at a significantly higher pace, number one. Number two, FDI in insurance has been raised to 100%. That means that a lot of the standalone health insurance companies, which essentially have no domestic ownership, but probably are probably well targets for FDI and 100% FDI. So they get access to capital as well. There probably could be M&A opportunities there. So that's the second one. And the third is that we've talked about this whole tax exemption limit being raised for the middle class, and we've been only talking about, the discretionary spending. But I think as part of the discretionary spending or as part of non-discretionary spending, I think healthcare clearly is becoming an important part of that spending wallet. And so, as the middle class has more money left, some bit of it is going to go into healthcare, some of it will go into health insurance as well. So I think probably it's time to kind of now start looking at the insurance space in a constructive and positive manner.
Okay, got that. Before we started the budget, we were also speaking about the EMS companies in a big way. FM has promised a package for the electronic components later on. It's expected in a week. EMS did fall a lot. I mean, Keynes fell, I think, 33%. It's one of from the all-time highs, it's down 33% this year. Likewise, we've seen some kind of correction even in stocks like Dixon. In the entire EMS space, does that still thrill you?
Well, absolutely. I mean, the opportunity is humongous. I mean, I think EMS, in terms of the potential and the ability and truly the whole government's priority of Atmanirbharta, I think resonates very well when one looks at the EMS space. So clearly, I think it's a fantastic opportunity. Also, we look at it in terms of our share in terms of exports of electronic goods. It's still kind of a fraction or a minuscule, even when you look at countries like Taiwan or Vietnam. So we've got a long way to go, and I clearly believe that the government will continue to support the sector through various initiatives, through PLIs or through a lower tax rates or maybe any other kind of benefits. It's just a question of the valuations getting more realistic. It's good that these were movers of the last 1 or 2 years, and they've got a bit shaken with the start of the year. I still probably think there's room for more correction out there, but that's probably more to do with higher valuations versus prospects. Okay. I think once valuations kind of become a bit more realistic, my view is that it's probably time to kind of then get back into this high potential, high growth space.
Okay. That leads me very nicely to the last and most important question. Earlier in the morning, you were not very sure that if I gave you 100 rupees, you would even put it in shares. You said you would wait, keep it in cash. Because I take your point. After all, we are a growth economy, and unless you see growth delta going up, you wouldn't want to go and invest. Have things changed for the better, or are they on the cusp of making you want to invest? Either because of the budget or because, the rupee has fallen enough. Foreigners didn't sell much on the last day. So, for whatever reasons, are we on the cusp of a recovery?
On a lighter note, that the 100 rupees resonates with the world of sachet investment. So obviously, I welcome.
Not even shampoos. Okay, I take your point. Okay, 100,000 rupees.
But micro lending is not in fashion, but surely micro investment is pretty much the need of the day. But anyway, moving on. But no, I think clearly, I think the opportunities still, are huge. I think what this budget does, I think it reaffirms India's growth trajectory. A 10% nominal GDP growth rate still makes us the world's fastest growing large economy. 2 years of obviously this tax exemption continues to, showcase the government's kind of commitment to kind of increasing the purchasing power. And third, I clearly believe that there are adequate investments which are being made in infrastructure, which will make India's manufacturing in India as a place to do business more competitive. So on the whole, yes, I think I kind of walk away with this budget with a lot of positivity. And I think with some bit of correction, I think in the general market, I think that kind of makes one even more comfortable with investing into Indian equities from a medium to long term perspective. So on the whole, yes, I remain constructive.
Okay, thank you very much. I take all those caveats in place. In the medium term, very shortly, will become attractive. Yeah, I take that caution. We have to keep that in mind, especially when we are in an extremely uncertain geopolitical atmosphere. We have just been saved some tweets today, but who knows, in a few hours the tweets may come back. Thank you very much, Nilesha, for joining us and helping us understand how to pass the budget. The market is ending on a very, very flat note. The Sensex may end up 5 points, the Nifty may end down 10 points, and the Bank Nifty may end down by about 50 points, which is really saying nothing. So it's a very, very flat market. The market has taken the budget in its step. And of course, we'll look forward to global cues come Monday. We'll have to wait and see. With that, we wind up this stock market discussion. Let us leave you with some expert opinion that we got through the morning and through the afternoon. After that, it will be time for some commodity analysis.
एक नया ऊर्जावान युवा भारत के सपने को साकार करने का हर एक क्षेत्र का, चाहे वो कृषि हो, चाहे वो मैन्युफैक्चरिंग हो, चाहे वो सर्विसेज हो, चाहे अधोसंरचना हो, चाहे इनोवेशन हो, चाहे कृषि का क्षेत्र हो, यूरिया से लेके एक एक, चाहे बीज की बात हो, चाहे नदियों को जोड़ने की बात हो, हर एक विषय पर पूर्ण रूप से अध्ययन करके एक नया मानचित्र तय किया गया है। और सबसे बड़ी बात कि हमारे जितने भी टैक्स पेयर्स हैं उनको इतनी बड़ी राहत दी गई है, 12 लाख रुपए तक कोई टैक्स नहीं, और हर एक ब्रैकेट में आप देखोगे तो करीब करीब 40 से 25% की राहत हाई इनकम टैक्स पेयर के लिए तक भी दिया गया है। तो ये एक कॉम्पोजिट बजट है, एक बजट है जो भारत को आगे ले जाएगा, और एक ऐसा बजट है जो भारत को केवल आत्मनिर्भर नहीं लेकिन भारत को एक विश्व गुरु के रूप में स्थापित करेगा।
No, I think frankly the applause you heard from the BJP benches was for the middle class tax cut. You look at the details and that may be a good thing. So if you have a salary, you may be paying less tax. But the important question is, what happens if you don't have a salary? Where is the income going to come from for you to benefit from income tax relief? You actually need jobs. Unemployment was not mentioned by the finance minister in her speech. And the generation of jobs becomes vital because in our country, not only do we have record unemployment, youth unemployment is particularly grim at the moment. We have the world record in youth unemployment and in college educated unemployed. So what is the method to generate jobs for these people? Then they can get salaries and they can share the tax cut. But those who don't have salaries are not going to share the tax cut. The other concern that many of us clearly have about the budget is that the overall problems that are facing the economy were not addressed. Where is investment coming from? We've seen a decline in foreign direct investment, and we've seen no investment, no willingness on the part of the domestic investors to come in. 23,000 Indian millionaires have left this country and gone to foreign countries. Where is the investment coming from that will in turn generate more manufacturing that can lead to more exports? You can talk about manufacturing mission and export mission, but how do we get there? I think those details we need to study more clear, but I have not heard in the finance minister's speech enough to cheer in those areas.
So not for announcement for Bihar?
Well, with elections coming up in Bihar, it's hardly surprising that they seem to be giving sops there. Ironic that the party that wants one nation, one election is actually using each election, each state, each year to give them more freebies. They may as well have multiple elections so they can get more applause from their allies.
Well, that of course is the reaction coming in from various ministers and opposition on this budget, but overall the budget is seen as a positive. When I talk about commodities itself, well, there are a lot of conversation that we saw coming for agriculture, whether it was from the allocation part of it and whether it was about self-sufficiency in pulses that the finance minister spoke about. There also was a conversation on a Makhana board that is created, seeds availability, seed viability, and of course climate change is something that she touched upon as well. But pulses is going to be quite important because, you know, in 2024, the import that India has done in sense of pulses is double of previous year and was at a record high. Is the reason the finance minister really had to come out and talk about the self-sufficiency when it comes to pulses. I will talk about all of those commodities, but in the meanwhile, Nandita, my co-anchor, is ready now to talk about the wrap on the market on how it has reacted to the budget. Nandita.
Lot of push for agriculture and also consumption, right? Of course, we've seen the reaction in the market, a shift away from capex to consumption, the big cut in taxes as well, which led to a very sharp rally in consumption stocks. The entire consumption basket as a whole was on fire today. You look at stocks like Trent gained somewhere around 8% or so. But on the index level, first of all, we saw big swings today. Although the close has been very flat if you compare it with yesterday, just about 23,500, we have shut shop around that level. So big swings but flat close. That was the story from the market today. Heightened volatility, but index India VIX itself has cooled off by 12%. That's a big cool off coming in on the India VIX index. The breadth, however, towards the end of the session, we saw breadth or NSE advance decline ratio at 1:1, but it was tilted in favor of gainers. Even the mid-cap index, flat, but ended with a negative bias. Sensex, by the way, just about managed to end in the positive zone. Looking at some of the movers and shakers, railway stocks came under severe pressure. Capex unchanged, and which is why stocks tumbled anywhere between 8 to 10%. So if you look at the likes of IRFC, RVNL, all these stocks came under extreme pressure, and so goes for the defense pack as well, right? Although the defense allocation was higher than the revised estimate for FY25, but stocks nevertheless came under pressure. But the story today was consumption, as I mentioned. So look at Trent, Maruti, Tata Consumer, Eicher, Bajaj Auto, ITC, all of these stocks rallied quite a bit. Of course, no changes in cigarette taxation as well, which is why stocks like Godfrey Phillips also rallied quite a bit. On the index level, if you look at the losers, all the capex related stocks which were expecting a big bump up in capex, they tumbled. The likes of Bharat Electronics, Power Grid, L&T, even some names like Cipla, Grasim, these were under pressure. But some stocks saw wild swings, in particular life insurance stocks, so to say. HDFC Life, SBI Life, after the announcement on FDI in insurance being hiked to 100%, we saw a good uptick, but soon after we saw most of these life insurance stocks give up their gains. I think it was after the announcement of personal tax cut that we saw a drop in these share prices. Aside of that, Dixon Tech is one stock, even that stock saw wild swings. Titan, Kalyan Jewellers, these stocks also managed to recover from the day's low. I'm sure Manisha will touch upon what really triggered this rebound in late trade. Aside of that, if you look at some of the other movers on the Nifty 500, consumer durables were doing well on the back of the cut in personal taxes. So Blue Star was one stock that did well. DMart, a stock like DMart was up 10%. So all these staple names across the board saw very good gains. But will this up move continue on Monday as well? That's a question that that's in fact something that we get to know only on Monday, because FIs, remember, were absent today, so they will be making a comeback on Monday. And Monday, as you all know, is a new day and a new week. Let's see how things really pan out. But a good budget, a good reaction as well. Although no big cheer on the headline index front as of now. Let's see as the markets digest all these announcements, how things really unfold from here. But with that, Manisha, back to you.
Nanda, thank you for that, for the complete wrap-up on how did the markets react to all of that budget. But well, as I was talking about agriculture, and we saw a lot of headlines onto this one, markets were anticipating some of these, but policies, as I was telling you, it has been a bit of a concern because we imported a record amount of pulses in 2024. Self-sufficiency is something that we've been talking about, and that really brings me to my first guest here, Sumit Gupta of McDonald Pills. Sumit, hi, thank you for joining us. And pulses and self-sufficiency are words that you perhaps can't use in the same line, but that's exactly what the finance did today. The kind of allocations that we've seen and expectations for some of those pulses like Tur, Urad and Masoor, how did you read those lines, the fund allocation or the point that the government is putting out? Do you see all of that being executed on ground?
Manisha, a very warm good afternoon, and thank you very much for bringing this topic in. And the interesting part is government today in budget, the second statement in the budget was about pulses. Okay, and I will request you to read this budget in line with the economic survey which was published yesterday. And very critical aspect of the economic survey, government to begin with, they spoke about inflation. And inflation because of pulses and horticulture, especially tomato, onion and potato. But critical part in that was tur dal and masoor and urad. Second, government spoke about climate variability, and because of that how yields are suffering. And the third aspect in that was government supply side interventions which government has done by duty and other aspect to keep the inflation low. And when you coupled yesterday's economic survey with today's budget schemes, okay, and specifically when finance minister started talking about Atmanirbhar impulses, to your point, you started this show by talking about demand. And you know how much India spend approximately 50% of their income on food. and out of food, pulses are a very important component. So if we are talking about a demand revolution in this country, pulses will participate from the demand side also. Today, when government spoke about Atmanirbhar Bharat, they spoke about increasing allocations to increase production. Okay, but on the other side, I believe demand will also go up. In especially the schemes which government came up with, and I would like to mention annexure.
My one point to you, Sumit, is do you think self-sufficiency in pulses is something that we can achieve in next 3 years, 5 years or 6 years as the FM spoke about?
Manisha, I will say we cannot achieve self-sufficiency in pulses irrespective of situation because our demand is growing at a faster rate than supplies. Even with government schemes, I don't believe that we can achieve self-sufficiency in pulses in the coming days.
And what is your sense on the National Commission that the FM has put out? Do you think there is enough allocation, or this is conversation, sentiment positive, but not so much on ground?
Allocations which government has done is around 1,000 crores for the pulses, mission on pulses, and it's a very good scheme in which they have targeted 100 districts, rice fallow lands to bring in the pulses cultivation. But it is not only about bringing supplies, but it is how you are going to build an ecosystem. Because you need speculatory money, you need traders' participation, you need international integration, which all is missing at the moment. Because as of now, we are only focused on pulses either from the demand or supply point of view. And specifically, if you see what we have done last year by letting pulses in, as you mentioned, imports have doubled. It has actually crippled the trading segment in the country. So we need to bring this ecosystem back and do a lot more than only supply side intervention as we spoke in this budget at the moment.
Fair point that. Sumit, thank you so much for joining in. So that's the point really, that while the finance minister did talk about pulses, an important level as well, but will it really convert to much on ground is something that there's a bit of a question mark, as Sumit put out as well. Well, that's about pulses, but I want to introduce Supreme Kothari, a partner ELP now, because the big confusion in the day today was about the import duty on gold and silver. We did see that one paragraph showing that it would perhaps be content-wise, it would perhaps be a different tariff line that the government is introducing from 1st of May. Supreme, hi, thank you so much for joining in. I mean, I've been on phone calls with you since that paragraph has been highlighted in media and otherwise. How have you read it? What we understand is that there is no import duty hike in gold and silver, because that is exactly what led to many of these jewelry stocks declining. But as clarity came that there is no immediate import duty hike, but this is a different tariff line, the markets have taken cognizance of that, but there still is a lot of confusion. What are you reading into this?
Yeah, hi Manisha, thanks for having me and good afternoon everyone. So I think effectively the change that led to this kind of discussion was a change that was proposed in the finance bill. Now the effect of that change was to sort of change some tariff entries. And in doing so, obviously there is a tariff rate ascribed to gold, silver and platinum. But that tariff rate effectively is not the rate at which imports are taxed, as we see. So because of that, there was a confusion. The intent in making that change was to create new tariff entries, and this fact is also documented in the TRU letter that is accompanying the budget. So the intention was to create tariff entries to distinguish between precious metals which contain more than a certain percentage of that precious metal and vis-a-vis the other kind of precious metal. So that also had a background, I'll come to that. But effectively, the rate at which duties are levied have to be looked at based on the existing exemption notification. So there is an exemption notification 50 of 2017 which is still prevalent and which has force. Now basis that, the rate, even if it were to be applied based on a certain tariff entry, would be 5% or whatever is the current rate applicable in relation to different items. So there is no such intention at all that the rate in relation to gold or precious metal will be increased. This is only a change in the tariff entry and tariff structure, and specifically to create more entries to reflect the component of purity of gold or any other precious metal. And also the other objective was to sort of prevent certain abuse that was happening in relation to certain alloys of platinum which had higher content of gold, and yet they got classified as platinum, and hence were able to claim certain exemptions which are prevalent. So that was the whole objective. This will not have any bearing on the customs duty rate applicable. In fact, we have seen historically that gold is such kind of a product. If there is any rate change, that will form part of the budget speech itself. The fact that it did not form part of the budget speech itself demonstrates there is no change in the rate of taxation of customs duties applicable on gold.
All right, that is good to know. My second question really, just to get deeper into this, Supreme. So is it about content then, when you talk about different tariffs and different tariff entries, is this very, very documental on the back end of it, and would you say that the markets really don't have to bother about this?
Yeah, so there is, firstly, it is basically just the way the structure operates. There's a tariff, there's a notification, you have to read both of them to arrive at the applicable rate. So it's just a structural change that has happened in terms of creating different categories. The idea behind creating different categories is, today if there is an import of gold which contains 99.9% of gold, or which contains slightly lesser amount of gold, both get categorized under one tariff entry. The idea is to have statistics of different nature of gold that are being imported, so that if there is any abuse or even for any other reason, there is statistical data which can be looked at the stage of import itself or later. That is the only purpose that it has right now.
Does it have anything to do with the content here? I mean, as you said, whether it is about gold being imported at 99.5, 95.5, or silver or platinum in that case, what already has come in, would that be changed at all? Are we only looking at statistical data, or do you think, as the notification also says, the finance bill says, this would come in effect from 1st of May? So we're not looking at the gold and silver that already has come into the market.
We are not looking at gold and silver that has already been imported prior to this date. We are looking at a prospective change that, as you said, would come into effect from 1st May 25. And also, when that change happens, even the existing exemption notifications will also be realigned so as to not impact any change or not lead to any change in the duty structure, because that is not the intent. So that will also happen as we reach closer to 1st May 2025.
Apart from that, Supreme, have we seen this happen only in these metals, or are you looking at these happening for others as well?
So as of now, I think these are the metals, and as I said, there is a specific chapter note in chapter 71 to the customs tariff that effectively states that if there is an alloy of gold and platinum that constitutes 2% of more of platinum, then it will be regarded as alloy of platinum. This historically is there because originally and decades back, platinum was considered to be more premium than gold, right? But now over a period of time, things have changed. So I'll give you an instance of a customs exemption under the India-UAE SEPA agreement, where platinum could be procured without a TRQ, that's a quota license kind of, and could still enjoy benefit of concessional rate of duty under the India-UAE SEPA agreement. Now, because of this chapter note, what was happening, it's